Morning, everyone. So SPY is a bit higher. We're up $1.35. We got a few stocks lower. Applied Materials reported. And that stock is lower. John Deere, let's see what that looks like right now. It was higher earlier. John Deere reported. Okay, if you like industrials, John Deere's up 12 bucks. Don't chase it, take profits. A lot of people took profits yesterday. We were recommending. I hate using the word recommend because I'm just telling you what I'm doing. I've been taking profits into strength. Okay. We had a lot of stocks up. I took profits into strength. Hopefully, you did some of the same and maybe kept some trailers on. Anyway, John Deere's higher. I know Stephen was trading Caterpillar. That's up $3. Cat up $3. On the back of John Deere's earnings. John Deere. Okay, John Deere, that's up 1375. Okay, so John Deere is higher. Applied Materials a little bit lower right now. Looking for an opportunity to buy some Applied Materials. Foot Locker is off. I guess people not buying shoes. That's off 10 bucks, 25%. Okay, Foot Locker minus 25%. Foot Locker. Okay, we've got Farfetch, FTCH. That's higher. Let's see if it's still holding. So these stocks, you'll see people taking profits off the tables. Farfetch is a $4 stock. It's up 18% or 81 cents, trading at $5.15. Expect some profit taking. Okay, first 15 minutes, we don't do much of anything except take profits off the table. If you were doing that yesterday, I was taking profits as well. There was a lot of stocks. Listen, it was pretty obvious yesterday. Breadth improved. We had 3-to-1 up volume. The number of stocks, there was like 350 stocks up to 100 stocks down or something like that on the Mark Smith homepage. You can check that for free. If you don't have Thinkorswim, just check it out. And we had like 3-to-1 up volume. A lot of stocks from different sectors were working. You can see John Deere's higher this morning, Caterpillar. So maybe the industrials start to work. If you look at what we were seeing yesterday, improving. Okay, you can see here is growth still outperforming value, but the fact that value is back above the 21 EMA in the lower panel, you can see we're accelerating on the growth side. Now, everything was up yesterday, or a lot of things were up yesterday. So I'd be careful buying anything first 15, 20 minutes. I'd be waiting after 10 o'clock. Wait for the opening range. It's Friday, so maybe people took a lot of profits off the table. It's an OPEX, okay, for the month. If you read Gamma this morning, we have a lot of option Gamma rolling off today. Okay, I think we see, where is the number here? Oh, that's the wrong date. Let me go to this one here. I posted the update in the Gamma channel. Gamma. We did breach the call wall yesterday, by the way. Let's see. Several call walls popped higher, and a great deal of this has been driven by short-dated positions. 30 to 40% of near the money strikes expire today in the queues. 30%, 30 to 40%. That's a lot. And 50% of the 422 SPY call wall expires today. The point is that these aren't really long-term call bets being made. They are speculative short-term momentum trades. It very well could be that real money is out buying these AI names, but the trade is being turbocharged by these short-dated call activity that we're seeing. Okay, so let's watch for some follow-through today. I would give it a 15, 20 minutes before doing anything. Wait till about 10 o'clock. We saw 39% of yesterday's single stock options volume being traded was tied to today's expiration. Those are 50% of the options volume in 0 day. Uber, AMC, Meta, Pfizer, Microsoft, Intel, Riot, Tesla, Nvidia, AMD, Mara, Netflix, AI, Carvana, RK, and Coin. There's a lot of stocks moving. There's a lot of meme stocks as well. With the AI also. We've got 4 minutes left to go for the opening bell. I'm your host, Cousin Benny, coming to you from theclosingprint.com. Give it till about 9:30, 9:45, 10 o'clock. Let's see what starts moving today. If we got breadth improving again, that would be awesome. Okay. Yesterday we had NIMO move up through zero line after spending 3 to 4 weeks below the zero line. All right, we're just plus, excuse me. We're only +6 at this point. We are, I'm sorry. We are pulling away from volume, VWAP, anchored VWAP, we're pulling away. We closed right near 420 yesterday. The call wall for the spiders moving up. We have a major expiration today, so we'll see how it turns out, but I won't be doing anything the first few minutes of the trading day other than taking some profits off the table, profits that I didn't take off yesterday. I had some trailers on. Was telling you yesterday we were taking profits into strength, looking for some follow through, but right now, let's see what's going on. Service now is down 3. Still looking for that to follow through. Um, I'd like to see the biotechs catch a bid. That'd be nice. Get LABU, IBB, and XBI higher. We got 2 minutes left to go for the opening bell. 2 minutes left to go. First 15 minutes, I'm not doing much of anything except taking profits off the table. Reassess the markets after 9:45. See what transpires into the opening range and beyond. Looking for stocks with high relative volume. At least 2 times that of the previous 5 trading days on average. We're looking for stocks that are moving that have plenty of room in their ATR, or if stock gaps up and it's got an ATR of 10 and it gaps up 10, the likelihood of a fade is pretty high. Stock gaps up a buck and it's got an ATR of 10 and it starts trending with high relative volume, you got $9 of ATR. So it makes sense that you should try, look for buy signals on stocks like that. Look to capture some of that $9 in ATR, that average true range. Okay. So one of the questions we get a lot very often is, am I chasing? You're chasing if you're buying the high. You're not chasing if you're buying dips on a stock that's otherwise bullish. Okay, let's get ready for the opening bell. All right, folks, good luck. Did we just open? Damn it, Janet, this is the second time. No, we're not open yet. All right, so I'm looking for the opening bell. All right, there's the opening bell. All right, so watch LABU gapping up, Apple gapping up, AMD gapping down. Meta is moving higher. Meta. Okay.
High took alert plus 800.
Microsoft. Let's see. All right, first thing I want to do is check the FANG group. Let's see if we got a buy signal or not. And we're moving lower a little bit, so let's wait a few minutes. Check your stocks that are on the move for potential. You might want to take some profits off. Devon Energy is on the move here. Devon, DVN is on the move. Devon Energy.
Iraqi Minister Russian cut outspoken affirmed commitment to OPEC plus voluntary production cuts. That's according to Iraqi state news agency.
Google's on the move. Remember,
this stream is sponsored by TickStrike. TickStrike allows you to actually hear order flow in futures, forex, and stock instruments. Get a free trial at tickstrike.com.
all right, remember Dan Loeb bought 4.75 million shares this week in Google. All right, so Google's up. Google's on the move. Google's climbing. Google, watch Google here. All right, so we got some profit taking in the SPY. All right, let's see if we get a better entry on a dip. All right, Google's on the move. All right, maybe take some profits on Google. That's up quite a bit. Let's see if it follows through. We'll get a dip to buy. Google, a dip to buy. Okay, so Google, let me get Google up here. All right, so that's good. Google. All right, so take a little profits off, it looks like. SPY's starting to bounce. Okay, yesterday it was very obvious. Lots of stocks were in play. All the FANG stocks were working for the most part. Meta kind of dragged its feet most of the day, and then it took off in the evening session. Meta. AMD, that hit 108 yesterday by the close. It gapped down a little bit. It's down $1.50 right now, $1.60. We're looking for an entry or more day trades on AMD. There goes Oracle. Oracle on the move. Oracle's on the move here, following through. Okay, AI is on the move. AI is on the move. C3 AI. There goes AI is on the move here. blasting higher. There goes IBM. IBM. All right, Vantair is looking for 42.12. Futures, 42.12. We're up a little bit above that area right now. Tick cumulative is green. Okay, I'm looking for buy signals on the FANG stocks for quick trades in the morning session. There goes AI. AI is on the move. Google. Yeah, Google looks good. Looks like it's not going to stop here. All right, Google. Following through. Google is on a buy. There it goes. Google. Okay, Google off the screen already. Wow. Okay, so we're really blasting here. Google. Meta, let's see. The FANG stocks as a group. Watching for the New York FANG to give us a buy signal. Meta's on the move. Meta on the move on buy signal early. All green, 15, 30, 60 minute. Okay, looking for Google to follow through. Meta, all right, still early. It's the opening range, so you know that algos are taking care of imbalances. NVIDIA pulling back, that might be an option for a buy on a dip. Netflix dipping after a big move yesterday. Looking to get back into Netflix if you took profits. I am too. Apple dipping. Buy, waiting for a buy. Tesla's pushing higher. Tesla. Okay, Google looks good so far. All right. Tesla. Let's see what you're doing, Tesla. Wow, that's a big move on Tesla. Tesla, the 180s. The 180s were active yesterday as well. Some of the Okay, Tesla on the move here. All right, looks good. All righty, nice Tesla. Okay, Tesla's flagging at the highs. We've got the Qs look good. Yesterday, IWM looked good. Let me go take a look at IWM. We get very few blocks, by the way. That's the first thing I noticed is that we have a third of what we had this time of day at the start yesterday. We had about 3 times as many blocks, and we had quite a bang out day yesterday. So we want to see breadth improving again. Let's go take a look at growth and value. Growth and value. Let's see who is doing best right now. Okay, growth. Both of these are pushing higher. They're both above the 21 EMA. They're breaking out of patterns. Value is moving sideways in a range. So if we don't get rejected here at the high from 3 weeks ago, watch the stocks like John Deere, which is had some reported earnings. It was up big pre-market. There goes Google. Google going again. All right, Google's on the move. All right, so Tesla is continuing higher. Tesla's on a buy signal for the last 8 minutes. Tesla. Meta looks like a buy, but it's flagging at the moment. Tesla's still going. Tesla looking beautiful, Tesla. Okay, Tesla, let's see. What's the news? Tesla serious on establishing India production. Innovation base. Okay, Wall Street bets stocks mostly up pre-market. Palantir yesterday was a big one. Okay, have some nice moves today. I'd be taking some profits off, reassess after 10 o'clock. There goes IBM. IBM's a bit higher. IWM looking good. Close that. Okay, IWM looks good. That was a nice move there. Devon pulled back a little bit. AI, short spurt towards 2750, got rejected. Let's see if we follow through. Google's still going. Google going to the moon. Don't forget, Dan Loeb this week bought 4.75 million shares of Google. That's a big upvote for Google, AI, and all the other things that Google's good at. I've been messing around with Bing. It's ChatGPT. All right, SAP, no follow through. Activision, Blizzard, looking for a follow through. Yesterday, Take-Two was big. All right, LABU trying to push higher. Looking for biotechs to perform. Let's see. We've got 75% of sectors are green so far. We're 20 minutes into the trading day. It's 9:40 on the East Coast. I'm your host, Cousin Vinny, coming to you from theclosingprint.com in rainy, overcast Myrtle Beach, South Carolina. Enjoying the weather, enjoying the profits. We banked a lot of profits yesterday. Google's still going here. We've got 75% of sectors green. Number one sector is small cap and large cap biotechs. So that's going to fuel some IWM if we can get financials and energy, small cap energy to perform. Okay, let's see. Crude oil is up a bit, 0.5%. Small cap energy is up 0.75%. Biotechs look like the top of the list right now. Biotechs are climbing up the list. All right, Google. Nice move on Google. Okay, Google, you're doing good. CRISPR bounced finally. That one's been a dog for the last couple of days. CRISPR, it had a nice run previous couple of weeks. There goes Carvana blasting higher. Carvana blasting. Carvana's on the move through 12. Okay, let's go take a look at Carvana. In a few minutes, we're going to check and make sure what is moving exactly. All right, Carvana. While it looks good on the 5-minute chart, Carvana is still below the the 200-day moving average. 1370, 1265 are next pivot levels that we could see some resistance. If we get 12 through 1265, maybe we take 1370, and then maybe the 200-day. But Carvana coming off the 9 EMA, higher lows over the last few months. Looking for a higher high to confirm that we're going to start to see phase 2 complete a little bit more. It looks like a big base in here. You can see the volume by price bands. Once we clear 12, 13.
Just a heads up for later on for users, Fitz Powell and former chair Bernanke to take part in a panel discussion during a monetary policy research conference.
You're too loud, dude. You're too loud. Let me tone you down a little bit. Okay, so Google still going here. Wow, Google just reversing here now all of a sudden. All right, a little profit taking into that move, Google. Okay. Looking for Google to continue higher though. Somebody's taking profits right there. IWM still trailing off IWM. The Qs were above The call walls, wouldn't be surprised to see a little fade here. SPY still pushing. Come on, Google, let's see you bounce. Let's see you bounce here. All right, so NYMO is at plus 23. NYMO for the last 3 weeks has been below zero. That told us that breadth was really crappy. There was only a handful of stocks, 15 stocks on the FANG, New York FANG, that were performing. I don't want that. I want this. New York FANG making new highs. New York FANG index making new highs this week, or starting to flag out. Most of you probably took some profits into strength yesterday. All right, there goes AI. AI is moving. AI going. AI is going. Okay, Google looking for a dip to buy. Google. Carvana. Carvana at highs. Devon Energy. Look for that to follow through. IBM. IBM breaking higher. All right, so IBM broke out of a channel, a descending channel we pointed out earlier in the week. IBM, let me check it out real quick. Okay, so it's pretty obvious now that IBM is breaking out. Double bottom held. IBM, a double bottom held. Now we're following through. We got 6 trading days off of this low, pushing higher. First target would be 382 in this pivot right here at 129, then 130.83. And then after this completes and takes out the pivot here at 130, we're looking for a continuation in phase 2. That's generally the longest phase, 4 phases. We're coming out of phase 1 right here, accumulation, the base, institutions buy after a dip. Phase 2 starts. That's where we want to watch the 9 and 21 day. We don't want to buy the highs, to be clear. You want to be buying dips back to the 9 and 21 day. For those of you who are new at trading, all right, there's no hurry. You're always waiting for the markets to give you the best opportunity. Chasing generally never is a good idea. All right, IBM still pushing here. Watching IBM. Okay, so this is just one out of many. We're going to check them out real quick, see who's doing what. You can see, though, IBM, see relative, the VWAP is tilted up and to the right, up and to the right. Price is moving away. Look at the relative volume compared to yesterday at the open. Okay, looking pretty good. IBM still going. You don't want to buy it right here. You want to see if this continues and gives us more of these flags. Okay, now let's go check and see what's working right now. Okay, let's see. Yesterday, if you remember, market carpet was mostly red. There was a few things that were green. And then towards the middle of the day, picked up. Big change in yesterday. Yesterday, this was exactly the opposite. All right, so we know that breadth is improving. All right, so this is good for starters. It is a Friday. That's on the unfortunate part is that it's Friday. Unfortunate in the sense that, you know, we don't have the rest of the week for this to play out, but this is really a good start. Okay, let's check. Up down volume is 2-1 on the NYSE, 1.5 on the NASDAQ. 2.3 on the NYSE, 1.5 on the NASDAQ. So we want NASDAQ to pick up a bit more. Tick cumulative is green. That's telling you that a trend. Institutions are buying more stocks on the uptick than they're selling on the downtick. So tick cumulative is moving higher. All right, Google pull back a bit. All right, shaking people out, testing their fortitude and their conviction. All right, so NVIDIA pulled back, AMD, watching AMD. Watching for momentum traders. Watching Netflix here. Netflix is on a buy, but the 15, 30, and 60 are not green yet, so we can wait. So anyway, look at the dark green here. John Deere up quite a bit today. John Deere, Occidental Petroleum is up. Catalent, CTLT. Remember that one gapped down recently. Catalent, CTLT. CTLT, that gap down twice. Now, is this stock that trades near 100 better at 35, 60% lower? I would say so. Might be worth a shot. MACD's crossing. Catalent, keep an eye on it. Okay, we're watching Catalent. This might be a nice entry. MACD cross. Catalent, let's see what this looks like. Okay, so it's launching here. Wait for a little dip. We'll look for more stocks to see if they continue. Right now, the indices are flat. They're higher, but they're flat current prices. All right, so what I see here is a lot of energy names. Oxy, EOG, COP, PXD, Devon gapping up. All right, what's Exxon Mobil doing? Exxon, some of the big names. Oxy. All right, so these are bouncing off the 200-day. These might be good swings. Oxy's turning the corner. This is one of Warren's largest positions. Chevron, looking okay. PXD, Pioneer, higher low. Okay, so here's the thing with these stocks. Now you can buy these with mean reversion in mind, but keep in mind that these are pretty much range bound. Okay, you can see the range. Okay, now look at NVIDIA for the weekly. See that trend? All right, so automatically I'd be looking at some of the semiconductors just because of the trend versus what we're seeing in energy. Yeah, you could probably make some money on energy. Think about your probabilities, though. I was doing a lot of thinking about this over last weekend. So let's look at AMD weekly. The difference? Trending versus range bound. Now, we got a higher low, so you probably got a pretty good shot, but you're more than likely going to run into resistance at around 230, which is fine. If you want a $20 move, that's fine. But I would rather focus on what's working. Tech is working. So I'd be looking at some of the semis. Micron broke out of a big pattern yesterday. Look at Micron. What do you see when you look at Micron? I'll tell you what I see. I see a trend first of all, and also see a big cup. I see the right side of this pattern forming. Now you could wait until you get all the way to 97, or let's say you wanted to have 1,000 shares of this Micron. Maybe you do that with 10 options equivalent, controlling 1,000 shares. I would buy close to the money, and as it moves higher, I would continue to roll it higher. If I was going to buy options, maybe I would do some spreads, or I could sell puts below this as a bullish trade, sell the near the money put and buy a dollar or two out of the money for protection. That's a bullish trade. You get a credit and you just keep doing that over the months ahead. But Micron looks pretty good. This is what I see on Micron is a turn, a rounding bottom, and a move higher, but it's trending. It's above the 10 EMA since the beginning of the year and continues to move higher. It technically broke above a pivot resistance that was being pointed out by a number of people. I note the wick on the top of the candle, so that's telling me that Micron is lower this morning. The point I'm trying to make is it's early in the trading day. It's a Friday. What is your stock doing? Is it trending? Or you're buying on a day where it's just coming back and touching the 10 EMA or the 9 EMA? Or you're buying at the high and have the probability that it's going to pull back against you? You should always ask yourself this question or look at the stock that way. So look at AMD. AMD looks beautiful. It's an inside day. It could pull back to the 9 EMA first. That's what we're anticipating. Tuesday didn't happen. Wednesday didn't happen. Thursday it didn't happen. We had a hard time trying to buy on a pullback unless you did it intraday. And some of you did that yesterday. We had buy signals on AMD Tuesday, Wednesday, Thursday, as most stocks were moving higher. So right now we got 2-to-1 up volume, so that's still good. We got breadth improving. So I know I'm yapping away right now. I'm just trying to provide information for people that are less skilled, perhaps. For those of you who are more skilled, you're sitting and waiting for the opening range about to complete and looking for high relative volume. I'm just scanning through the FANG stocks. Google has yet to bounce. The FANG stocks have yet. Okay, we got Netflix bouncing. Netflix might be a play. It still hasn't seen the 15, 30, and 60 go green. If you're using Grover Scripts, I'm looking at the 15, 30, and 60. So right now we got a bounce. That's probably just shorts covering. NVIDIA getting it a little extended to the downside, looking for a buy signal on NVIDIA. Same thing with AMD. SPY's on a buy, but we only have the 60-minute green. The S&P 500 is on a buy signal. It's near resistance. All time frames are on a buy signal, 15, 30, 60. Tesla, all time frames are green, 15, 30, 60, but we don't have a buy signal. We had a buy signal at the open. Tesla could launch here and move through 180 pretty quickly. Keep an eye on the volume. Let's see, Tesla. It might not seem like a big deal, but if you're paying attention to stocks, are they trending, especially the weekly? Are they trending? Are they above the 10 EMA? If you're thinking long, the odds of longs working are better than shorts working. Now, obviously, we could see a short back down to the 9 EMA, but I'm talking about the longer term trend, higher lows, higher highs. Weekly looks good. Biotechs are doing well. Let's look at IBB. Okay, you can see biotechs are sideways. Okay, let's look at LABU. LABU should be the same. Okay, flat for 12 months. Every once in a while, we'll get a little spurt. But on average, your probabilities with LABU is not that great. Let's look at the sectors. XLI, we know industrials are okay, but they're range bound. XLC, trending. Okay, what's in XLC? Meta, trending. See that? I mean, that should be very obvious. Okay, so you've just created a higher probability success trading if you're just paying attention to this one thing. All right, so 10 EMA is moving sideways. Yeah, industrials look okay. John Deere's doing well, but it's in a descending pattern. It's going to take 2 or 3 weeks for this 10 EMA to turn up like it did in June and July. Then you've got a good probability. Yes, you could probably try to game John Deere, but the probability is not as great as if you're looking at, say, XLC Communications, Meta, Charter, Okay, these are all trend. Charter's not trending. Fox, I misspoke. Fox not trending. Netflix, communications, trending ever so slightly upward. You know that Netflix yesterday announced a pay for service tier. Okay, a lower price, but you don't mind advertising. You can access all of Netflix's content, which is huge, and it continues to grow across multiple languages. Everybody knows it's a Netflix subscriber. So they have a pay for tier now. So that's probably going to work out really well. So this is XLC communications. Biggest winner here is most likely going to be Meta. You know they're going to be on top of AI. They've already said so. Other other names like Roku, perhaps. I don't know how that's doing. No, you see, it's range bound. So why would you want to try Roku when your probabilities are much greater with Meta? Just don't buy the high. Okay, let's look at the daily. All right, trending. And then, of course, you want to check the 60-minute, remembering it's a Friday. 60 minutes above it's 21 EMA, the green line. The For reference, we have the daily, that's the dotted red line. That's for reference only. This is a 60-minute chart. So if these two are in agreement, then you want to be trading this. You want to be looking to buy this. Okay, Tesla's pushing higher. All right, so let's look at XLY. Okay, so consumer discretionary. As much as CNBC and the rest of them tell you how bad consumers are, it's trending. So I don't know what to tell you. Let's look at the weekly. Weekly, it's trending. It's above its 10 EMA. For the last 8 weeks, 9 weeks, 1, 2, 3, 4, 5, 6, last 8 weeks, it's been above the 10 EMA and it's starting to accelerate. What's XRT look like? Retail. They told you retail was bad. It is bad. It's below the 10 EMA. What about consumer staples? Pull back this week. Okay, so everything is kind of quiet here. What's going on?
Where we got two messages from Fed officials, Jefferson and Logan, and they were different. Logan, seeing Lori Logan of Dallas Fed seemed much more.
Okay, so XLY. So XLC has the most promise right now, from what I can tell. XLC is trending. XLB sideways range. I mean, this should be pretty clear. I mean, there's a couple of ranges going on here, right? You've got this range here, which is the overall, and then you got this, and we're right in the middle. All right, so if you want to trade, you might see a move up to was that 60, 84? Need my glasses. But the bigger range, maybe you see it up to 88. So you want to trade it for $8, or you want to go to something like XLC, which is trending already. Let's see, XLE. All right, so that's in a range.
Like the data this week has not
So,
been
increase your probabilities and trade sectors that are
still pretty strong. And what we
looking the best. Let's look at SPY. SPY weekly. What's that tell you?
Two-year yield has made a
Although
big
SPY is
rise
pulling back right now,
this week. That's the one that's close
the
to
weekly is trending
correlated with interest rate expectations.
since October. Higher highs, higher lows. What's Google doing? Google is trending. It's above its 10 EMA. You just don't want to buy the high. You know that Dan Loeb bought 4.75 million shares this week. So that's a lot of shares. That's a lot of shares. That's a lot of conviction. All right. I know I've been yapping away. It's 10 o'clock, so we're not really missing anything. It's a Friday anyway. Fridays, you don't want to be rushing into things because people are taking profits off the table. Most people, like us, were taking profits yesterday. Devon Energy, higher highs, higher lows. Google, all right, still looking for a bounce in Google. IBM, looks like it wants to try 127.50, IBM.
However, and you know I always highlight this, David, got the Fed balance sheet data, and stress still lingers in the banking system. Turns out the Fed had combined 96.
I don't know. Would you consider AI technology / communications?
We're well off the peak that we saw in March during the acute phase of this crisis.
Mostly technology, I guess.
Billion was borrowed then, but it was a new high in the Bank Term Funding Program, the BTF.
All right, let's take a look at some things that we've been looking at for some time since November last year, December. We've been, for those of you that are long term, we've been in TRBCX since late 2022. And look at the gains were made. Now, here's something to think about. Okay. Okay, so we presented this to you back in late December. I know some of you took this long. I'm not sure who in the room is still long, but there's no reason to sell this. You're up 27%. Okay, 27%. All right, so that's not a bad gain. All right, so TRBCX, the T. Rowe Price Growth Fund, one of my favorite long only funds. You can trade this. Most likely you can position in this in your 401k, IRAs, or some equivalent. It was down 43% from the January 2022, late December 2021 high, all the way down to the low. We liked it down here because we started to see a higher low setting up. We're up 27%. That's not bad. That's not bad. Okay, so
investors willing to pay a higher multiple for those earnings at Morgan Stanley because of the belief that they are.
The COVID low was 118%. We never made it there, but that was, I just need to take this off. There's no reason for it, actually. Just take that off. Okay.
A signal. You do that when you feel good about the outlook, right? About not just Morgan Stanley, but it, if you saw a hurricane coming, I don't know that you would announce in 12 months that.
No, although he did make a comment, I believe, and I can't quote it directly, but that if current conditions sustain. In other words, the idea being that if we were to find ourselves under crisis, it might not be a move that they make within the next year or in the next 12 months. Let's get over to Leslie Picker now, get a little bit more on this, including I'm curious, Leslie, in terms of the early
okay, that's really no importance to us. COVID, we never made it to the COVID low, so 27%, 28%.
These three gentlemen have been speculated as those to be heir apparent to James Gorman. You've got some different backgrounds here. Simkowitz, as you mentioned, his background in capital markets, now running investment management. Ted Pick is running the business of basically does sales and trading.
Look at the 10 EMA, though. That's the most important part is the 10 EMA.
several years or so. So, I've been talking to sources this morning to get a sense. I think it's still these three candidates that, are being considered. And, it'll be interesting to see as the months progress, kind of if any of them come more into the forefront from here. But to your point, Gorman also talked about at the shareholder meeting, he does feel optimistic about the future of Morgan Stanley and the broader economy. As such, he's making this timeline public now for the first time, which is the real news here today, that within the next 12 months, we could see a new CEO of Morgan Stanley.
Got it. Leslie, thank you. Leslie Picker with some.
Good morning.
There.
Good morning.
And look at Foot Locker. It's getting slammed this morning on first quarter. Retailer.
Okay, Fridays are good for that, Seth. Fridays are very good for yapping away and telling people what's going on.
Its full year earnings guidance. I just spoke with CEO Mary Dillon about the latest results and outlook. I asked her what happened here.
Glad to hear you're
We announced our first quarter earnings
with us.
and lowered our guidance for sales and earnings for the year, really driven by two factors: softer customer demand than anticipated and elevated inventories. I want to reiterate, though, I am extremely confident about the lace-up plan that we unveiled to investors in March, about 6 months into my tenure here, and it's designed to drive long-term sustainable growth for Foot Locker. And, we believe that by simplifying the business, leveraging our assets, and investing in the right capabilities, we'll be able to drive that growth. We're in this great growth category, all things sneakers, and Foot Locker is at the center of sneaker culture. And I see green shoots of the plan already starting to show up. Having said that, tougher start to the year than we anticipated. Softer customer demand, as well as elevated inventory. So while that is disappointing, we're adjusting to that reality, but remain very engaged and energized about the future. So we'll take the short-term action that we need, but it doesn't deter us from our long-term belief in our strategies and targets.
I think the market was willing to forgive a weaker quarter. As you had been talking about the softness, we saw the tax refunds come in late, but the guidance is really what surprised everyone, and lower margins as well. What has it surprised you, the shift in trends?
Yeah, I would say that at the end of the day, the consumer is showing some weakness. And I think we've seen this building for a while. Our customers come out.
All right, so
and we're delivering, I think, great, exciting opportunities for them on those. But we saw
the markets are just moving sideways. So you don't want to take any risk on when the markets are not trending. That's the first order of business. What are the indices doing? Are they trending?
While abating is still quite high. So when you think about things you have to pay for, like rent, like gas, like food.
Okay, we know what the communication sector looks like.
We've seen some increase in uptick in the use of credit, and of course, there's less COVID benefits. So while we were
Yeah, see, Grover reporting that breadth is moving flat to slightly lower. Tesla, we're watching for a follow through.
We just had a great Mother's Day where we elevated our entire women's business. And a Jordan Retro launched the For Thunder last week, and that had a lot of excitement and demand. So really what we're doing is trying to be realistic. We think that pressure is going to continue for some time. We don't know exactly when it won't. We also need to really address the fact that our inventories are elevated. We came into the year 30% higher. I think with our sales plan, that was manageable, but really we need to get more aggressive, and that's to your margin question about really providing discounts and promotions to clear that inventory so we can get in a better position for the latter part of the year.
How long is that going to take?
I wish I had a crystal ball today, but I don't. So we're trying to make the best call that we can. We're managing expenses. We're preserving our investment into the future because we see a bright, bright future ahead. Like I said, disappointing. Of course, nobody wants to lower guidance, but we're trying to give the best call that we can at this time. But really, we see, like I said, in our lace-up plan, a lot of early encouragement and improvement on many of the things that we're doing to improve our store portfolio, our digital experience, our loyalty program, et cetera.
That was just a small piece of the interview with Mary Dillon. We're going to play a lot more for you in the next hour, 11 a.m. hour of Squawk on the Street, including how she's going to turn it around and how long this is going to take. I also asked her, Carl, about Nike in particular, which is obviously their biggest, the biggest presence in a Foot Locker. How much of it was Nike versus other brands? She got into it a little bit because we are seeing the impact today. Nike,
all right, so we're flat. It would be really cool to see the markets rip higher on a Friday. and close at higher prices. You know, this is an OPEX, obviously.
So they're very
We know that
experienced
few
in
sectors are really doing much of anything except moving sideways, except for, say, communications. I didn't check them all, but look at the weekly time frame. Is it trending? Then you probably have, not probably, you have a better probability of winning trades.
After they saw the lower refunds, it got worse. Clearly, they're on the wrong side of inventory. It's up 25% at the end of the quarter, so they're going to have to do deep markdowns. So that's going to hit earnings. And
Yeah, you know, Seth, you can't be in a hurry. You can never be in a hurry trading. You might, you know, when I first started trading, I felt like, oh my God, if I don't get in right this second, I'm gonna miss something. But if you step back and you think about it for a while, you know, there's so many factors that can actually be hurtful if you're in a rush. So many more things that could be hurtful if you're in a rush. I mean, I still make mistakes from time to time. I'll buy options at the market and I don't slow myself down enough to realize, oh, geez, if I do that, I'm going to buy it for 30 cents more than I need to by just putting in a limit order. And depending on the time of day, I mean, I do that from time to time because I want to get into something on a dip. I did that to something recently. I forget what it was. I'll think of it in a minute, but should never be in a hurry. The markets are not going to top or bottom in one day. If you find a trend like we see in XLC and start looking at the stocks they're in, I mean, Meta's down right now. Is that a bad thing? All right, so let's go take a look at Meta a little bit closer. All right, so let's say we're thinking about a position in Meta. Let me get rid of this banner here. Okay, change this back to, yeah. All right, let's take a look at Meta. All right, first off, all right, Google's starting to bounce. All right, so we got an A pivot already on Google, perhaps a B pivot. Google. Okay, you got A up here, you got B. So now what we're looking for in a stock that you know, without a doubt, you know that people are buying. Okay, so where do you want to buy? You want to buy up here at the high, chase it, or you want to, okay, I'll wait a few minutes. You wait a few minutes. You got an opportunity. Look at stochastic RSI. Now let me go take a look at some scripts here. Google's on a buy signal over the last 8 minutes. Google's on a buy, 8 minutes. But 15, 30, 60 still red. Signals. All right, so that just tells me to wait a few minutes. Okay, so here we are here. Google, watching Google here. All right, so you can see A. There's A pivot. There's a B pivot. What are the other FANG stocks doing? Yesterday it was really awesome. I mean, everything was working except for Meta. Meta wasn't moving till end of towards the end of the day, midday. All right, so it looks like a B pivot on Google.
Disney perhaps up in the ante in its ongoing feud with Florida Governor Ron DeSantis, citing, quote, changing business conditions. The company scrapping plans for what would have been a $1 billion Florida campus, which would have employed 2,000 people. Disney also pulling shows from its streaming service and closing its immersive Star Wars Galactic Star Cruiser attraction this September. Joining us now, Guggenheim's Michael Morris. He has a buy on stock. Let's just start off on sort of this move. What's the reaction to it? Was it
All right,
part of
so
the cost-cutting
there's a
plan
B.
overall, or do you think it is a
That's a B pivot right there.
specifically to DeSantis?
I think it's really part of the cost-cutting effort. I mean, it's hard to dismiss any sort of mix with respect to the political situation right now, but Disney, I think, is playing the long game here with respect to how they're structuring the business. And I think they already had pushback internally from the employee base on some of the move from the West Coast to the East Coast. And the most efficient and simplest path forward is to move on from that approach.
And what are your expectations when it comes to cost cutting overall? We cited a couple of other things. One, of course, the
There's
Florida
B.
hotel attraction, so to speak. But where are they in terms of how much Iger has promised to take out? Not just for the content.
Okay, so you're looking for a higher low C. Watch Grover. Watch Google here.
Across content and a number of infrastructure and underperforming sort of parts of the business. And it's such a complex company, as you know. I heard what
IBM, I like it. Acceleration, I like it.
agree with a lot of the sentiment that you
I like IBM. I think you have a pretty good eye for what I'm looking for as well.
Mostly media and overhead right now is the areas where this company and probably most of the media industry at large has been overspending for the last decade with respect to serving their consumers. And now is just the time to start right-sizing that. And really, I think the company's on a good path, but expectations for their ability to do that still remain very high.
Yeah, I mean, across the board when it comes to, let's call it old media, I hate to say that, given where I sit right now, but the decline of linear networks only seems to be increasing. We talk often here, it's certainly about cord cutting, which seems to actually be picking up speed, not sort of reaching some kind of slow end. What are your expectations? The pressure is that putting on not just Disney, but Warner Brothers Discovery, Paramount, my parent company, to continue to sort of cut costs when it comes to the direct-to-consumer that's consuming so much of the cash flow?
Yeah, it's a great question. So there's a tremendous amount of.
You're looking at NSC, you said, David? NSC. All right. NSC. Norfolk Southern. Yeah. Weren't they the one that had the spill in Ohio? They're coming off these lows.
Maybe we have a differentiated view here. It's not about cutting costs to try to keep pace with this rate of decline. It's about an
AA.
business model.
What do you say? 750s? I'm not following. The 10 call? No. June 40 calls on AA. Yeah, I see it. I see it. It's below the 50-day. Thank you. Thanks, David. Microsoft, watch Microsoft here.
I think the assets that they have in sports are very unique, though expensive, and they need to figure that out. And general entertainment, they do have a very healthy general entertainment business, but they have to really make the decision if they want to compete with Netflix and HBO in that space, and not just have their general entertainment business tag along with the success of Disney and ESPN.
Michael, there are reports that Governor DeSantis is about to announce he's running for president. Is that going to be an overhang on Disney stock in any way? Are you bracing for bad headlines?
Interesting question. You're just bringing it up to me right now. The way I think about it is that the governorship in Florida is generally at most an 8-year cycle. So that's still several years for Governor DeSantis. If he were to leave earlier and pursue something else, I think that's well within the realm of possibilities. But the bottom line is I think Disney is in this state for centuries.
Okay, so you got mostly red signals on the fangs for now. So we're sitting waiting for more green signals. For starters, SPY and the Qs are just sideways. All right, so we did triple up on our volume, our SPY volume. Blocks, a lot of SPY blocks today in the last 45 minutes. Actually, about 4 times as many blocks as we had when I first mentioned it this morning, 9:45 or so, 9:40. Got 4 times as many blocks now. Most of them are 419s. Okay, so note that most of these blocks are 419. I'm going to post this in the trading room. Note most of these are 419s. Four 1921s. All right, so that's pretty interesting. Bullish above 420. I hear a kitty cat. 419.50. All right, so hopefully everyone's having a good day. Yes, sir. Yeah, I know. I remember when you took it there, Grover. Yeah. Okay. So here's SPY blocks. Okay, so Google looking pretty good here, actually. Now, what the next thing that could we need to look for is a flattening of VWAP and price just sitting here and doing nothing, because Google had a great week, remember. So you're going to have Friday people trading this, chasing it, probably bought up here instead of waiting until 10 o'clock. You're going to have people chasing that missed Tuesday, Wednesday, Thursday, where Google was banging out some nice profits. Okay. All right, so people that are trying to chase Google here are missing out. So they got the news that Dan Loeb was buying 4.75 million shares, but he bought it back over here. Okay, you can see where the volume was. This is when Dan Loeb, among other people, were buying Google. You know, you got like what 300 million shares trading hands in 2 weeks, and price went from 105, 106 up to 126, so 20 points. You think that's all they want, Dan Loeb? You think he wants just 10, 15 points? I would say he's probably in this for looking at the weekly. I would say Dan Loeb's in this looking at these highs up here. This is where I'd be selling up at 150-ish, another 25 points. So he'd make 50 points at that point, right? Around 50 points. Meta, no follow through yet. So we don't have a whole lot of momentum. Watching AMD changing direction. Apple is trying to do something. I have no position in Apple. We took profits into strength yesterday. Most of you most likely took profits into strength. Yeah, it only takes one trade. Only takes one trade a week. So the other thing is, if you're a new trader, try to limit the number of trades you're going after. Oh, Vinny bought this. Oh, Grover bought that. Oh, LA bought this. Oh, Crimson bought Crimson. Cayman bought this. Susie bought that. Frano. I mean, you could, if you follow every single trade that's in the room, you know, you can have a dozen positions in one day. You know, come into the day, you know that XLC is trending. Okay. So let's take a look at communications. What's in the communications sector, right? Let's do that. Let's go look at communications. I didn't break it up yet. So let's go to media. Media got some of the same names. Advertising, media. Where'd it go? I'm missing some. Oh, broadcasting. Okay, broadcasting, entertainment. Okay, so we know that XLC is moving higher. It's trending. You know, I need to do that. I need to go Discovery, Dish, Discovery. All right, Dish trending lower. Okay, MCHX, Netflix. So that's the obvious one, Netflix. Grupo Televisa. That one's turning the corner. Okay, let me just real quick check. Let me just check this real quick. XLC Communications Holdings. All right, so the markets are not going anywhere, so we're in no hurry to buy something right now. If you're going through withdrawal and you feel like you ought to buy something every day, you know, I would suggest taking a break, wait. Let's see. The communication services sector, let's see the top. Holdings, there we go. Alphabet, top index holdings. Meta, Alphabet, Netflix, Comcast, Activision. Okay. Horizon, that's the top 10.
Welcome back to Squawk on the Street. I'm Contessa Brewer. Here's your CNBC News update this hour. Ukrainian President Volodymyr Zelensky will appear in person at the G7 summit in Japan this weekend. Other world leaders at the summit have already announced new sanctions against Russia. And a senior Ukrainian official said Zelensky's
Tesla's still going. All right, so we had to wait for Tesla this week. Finally getting the blast higher today. Tesla's still going.
The Centenary Courage Award at the Pan American Gala yesterday. He says it's nice to be back, as opposed to not being back, which was also a possibility. New York City's Roosevelt Hotel is opening its doors to migrants today. Mayor Eric Adams said the hotel eventually will provide as many as 1,000 rooms for migrants who are expected to arrive in coming weeks following the expiration of the pandemic-era policy Title 42. New York City is facing growing pressure to expand its shelter system. Sarah? Contessa, thank you. Contessa Brewer. Checking in on
Tesla having a pretty big day. It's up 2.5%, $4.70.
The S&P 500 right now. Energy is near the top of the list today. That sector up 1.4%. Healthcare, real estate, utilities, but also some strength in the cyclical groups that are tied to the economy, like materials, financials, industrials. What's not working today? Consumer discretionary. Big pressure on retail, part due to Foot Locker's very disappointing quarter and guidance, raising some concern about further retail earnings to come in the next few weeks. Investors are also anxiously awaiting Chair Powell's speech, the Fed chair, at the top of the hour. Our next guest says the economy remains remarkably resilient. Joining us now is Moody's Analytics chief economist Mark Zandi. Mark, I feel like you've been calling for a Fed pause, disappointed in the last hike, and now, you know, we've gotten a bunch of stronger data than expected. Does it make you rethink that position? Do you think they should be done?
Oh, they should be done. Yeah. I mean, Sarah, the key here is inflation. And in my view, inflation is coming in. You know, consumer price inflation peaked at 9%-ish back last summer. We're at 5%. I feel very confident. We can talk about why that inflation is going to be closer to 3% by the end of the year and back close to the Fed's target by this time next year. Obviously a lot of uncertainty around that, but I feel as confident in that forecast at the current rate of interest than I have in a long, long time. So and of course there's a lot of other things going on. Banking system still under a lot of stress. Economy's slowing. Recession risks are high. You add it all up. I don't think there's any need for another rate increase. Not now.
I think the market's been on board with that view, Mark, and then you just get some confusing data like what we got from the University of Michigan inflation expectations over the next 5 years jumping to 3.2%, the highest we've seen in a while.
Yeah, I don't put too much weight on the University of Michigan survey. I mean, it's a small survey, jumps around all over the place, and I'm not sure what to make of it. I mean, if I'm going to pick a confidence survey to look at, it would be the Conference Board Survey of Consumer Confidence, and that's rock solid, very close to its long-run average, hasn't budged. Feels like it's saying that the economy's in pretty good shape, but doesn't need another rate increase. And inflation expectations more broadly, they feel like they're coming in slowly but surely. I don't think it's a straight line. I mean, especially for consumers, it's going to take a while for them to truly believe that inflation is coming in because they've been through a lot over the past couple 3 years. So, but I wouldn't read.
Okay.
Why are you so confident that the inflation rate is coming down to 3% when it's more than double where it should be on the target, and Fed officials don't seem as convinced as you do?
Yeah, two reasons. One is the cost of housing services, which is a very large share of the inflation pie, particularly in the consumer price index. That is, I feel this with a high degree of confidence. That is going to come in. We know that rents have gone flat to down in many parts of the country. A lot more supply hitting the market. There's still a record number of multifamily units in the pipeline going to completion, and they'll get completed. And demand is weak because of the previous surge in rents. So we have now demand destruction. Households can't form because they can't afford to buy a single family home or to rent. So that means lower rents, and that translates into lower cost of housing services over the next 12 months. And the other factor is vehicle prices. There, the really great news that came out of the last CPI report, Consumer Price Index report, was a decline in new vehicle prices. We've been waiting a long time for that. Finally getting enough production in Japan and Germany. Their supply chains are now finally getting back in order. They're producing more cars, and that means more cars on dealer lots, and that means weaker prices. And so that's the start of some consistent price declines here, I think, over the next 6-9 months. So, and that's another big part, a chunk of the pie, of the inflation pie. So those two things by themselves, Sarah, I think argue very, very strongly that inflation is going to come in here in a reasonably graceful way, at least through the end of the year into next.
Certainly getting backed up today, Mark, by this New York Fed paper where Williams talks about R-star and long-term structural inflation pressures and the idea that it's not impossible that we go back to an era of very low rates.
But did John say that? I missed that. I haven't seen that.
Yeah, that's Williams today.
Yeah. I'm
Google drift. All right, we're looking for a C pivot now.
I do think that we've gotten rates back up in the post-pandemic period. They're probably where we want them to remain. Long-term rates 3.5%, 4%, R-star around 2.5%. That would be ideal. So hopefully that's where we stay going here going forward. But I agree. Hard to know. Whether it's going to go lower than that. If we go back to the kind of the pre-pandemic world that we lived in before, very difficult to know.
Apollo had a notion today, Mark, that basically said we could see what they call a non-recession recession, and that is we printed a bunch of money. It changed asset prices, maybe didn't change the economy, so to speak. And as you unwind it, the economy, again, won't change that much, but it's asset prices that will revert. What do you make of that idea?
Well, that's what we're observing. House prices, commercial real estate values, stock prices, of course, bond prices, all, was kind of skyward in the environment that we were in. And now they seem to be reverting back to kind of more historical norms. Still a long way to go. Valuations are still pretty high across all asset classes. So I think we still have a lot of adjusting to do, particularly in the commercial real estate market. It feels like we've got a lot more price weakness there, dead ahead. But it feels like we're moving in that direction. That does pose risks. Obviously, once asset prices rise and they start coming back in, that does create problems for bank lenders and for the owners of those assets. So they have to adjust to that. But so far, so good. Things are kind of putting together reasonably well. And the economy, again, seems to be weathering that storm, reasonably.
All right, just sitting here scanning through stocks.
Thanks for weighing in today, Head of Powell.
Sure thing.
It was good to talk to you. Mark Sandy from Moody's Analytics.
As we go to break, check out some leaders on the S&P 400.
Tesla looks like it wants to go some more.
Right around 40. 42.08, about half an hour, 20 minutes, let's say, away from Powell. We'll just watch the indices here. Back at 3.
Tesla having a good day. Looking for a B pivot, B and C pivots. Google. Looking for a C pivot now. Looking for C right here. All right, so looking for a C pivot on Google, higher low, and press towards the highs. You know, there's a lot of people buying. Last couple of weeks, we've seen about 200 million shares trading hands in Google. So not surprised to see it follow through. And the market's still moving sideways. So we need the markets to be moving in our favor.
Fans, please direct your attention to the pitcher's mound for an honorary first pitch. David Faber is the award-winning anchor of CNBC's morning show Squawk on the Street. He's also a lifelong Mets fan and a Queens native. Our honorary catcher is his son, Jonathan Faber. All right, David. When
So
you're
cute.
ready,
Yesterday,
it's
David got the
yours.
chance to throw out the first pitch at the Mets game at Citi Field with his son Jonathan as catcher. What happened there?
Well, I got on the mound. That's all. I mean, it's like I had not practiced on the mound. I'd been throwing. My arm was fine, but you get up there. Everybody says don't, and I didn't adjust for the verticality.
You have a 5-year-old T-ball game happening tomorrow.
Yeah. You want? Well, don't take any. I used to be able to actually. I mean, it's the one game I could play. Now, clearly, from watching even my arm action there. I mean, what the hell was that? Oh my God!
It was a little off center.
It was horrible. But great, a great day. Oh my God!
And they won. I heard.
They won. Actually, they beat the best team in baseball 2 games in a row. And so, I mean, even the angle there was just terrible.
You sort of look like a little
That's
kid.
terrible. That's what happened.
That's for you.
Yeah,
They're booing him.
Yeah, you can't bounce a pitch. Cohen told me don't bounce it.
We'll just run this. We're just going to run this
You look
image
better.
right
You
now.
Run
look
that.
better
Yeah, I can. Yeah, I know what I'm doing. I can catch the ball. I used to be able to, again, it was disappointing. But the rest of it was great.
So my
and my
father-
God, our colleagues were there. Everybody came out. Friends.
nice.
It was so much fun. Thanks to the Mets as well. And my boy there.
Tesla, looking for a higher low on Tesla.
My 5-year-old son
Tesla.
and I think he can do better.
going to get another chance because we're going to go.
We're pulling away from VWAP, so hopefully we push a bit higher on Tesla.
Do it in the playoffs. How
Yeah,
about that?
and so I'm going to come back in the postseason and I'm going to throw.
I don't know. On Tuesday, the Sports Illustrated models were throwing
I'll
the
get in
pitch,
front
and
of
that's
the
when they started winning.
Don't ever get on the mound if you have a pitch. It's just unless you've been practicing from the mound. That's my advice.
Good job, anyway. Pretty
Thanks.
epic.
Thanks, sir.
Target raising eyebrows this week on another note, saying it has taken a more than $1 billion hit to profit since last year, largely because of theft, organized retail crime. Target isn't alone in its fight against this problem. Foot Locker mentioned it this morning as well. Courtney Reagan has more on the story. So what is happening here, Courtney?
All right, we got some shorts covering here on the Bang stocks, watching shorts covering.
David Rainey told me organized retail crime is an issue bigger than just the retail industry. Target is taking the very rare step of quantifying loss from shrink, saying it's being driven by this type of theft. Home Depot has also been calling out material levels of shrink since 2019, the quarter's biggest pressure on gross margin. Dick's Sporting Goods, Lowe's, Macy's, and Ross stores have also called out theft-related shrink. The National Retail Federation estimated total shrink cost retailers nearly $95 billion in 2021. That was $3.7 billion more than 2020, with 37% of that total, or about $35 billion, from ORC. Now, 71% of retailers surveyed by the Loss Prevention Research Council say ORC has increased. 81% report somewhat or much more violence associated with it. This week, New York City Mayor Eric Adams said retail theft grew 44% last year over 2021, with repeat offenders responsible for nearly a third of all arrests. Nationwide, the median ORC fencing operation handled about $250,000 in stolen merchandise prior to being apprehended. Adams says social media amplifies the issue, and nearly half of offenders use online marketplaces to resell stolen goods, though peer-to-peer apps are increasingly being used. Facebook ranks as the most problematic by retailers, followed by eBay, OfferUp, and Amazon. Now, Congress is trying to curtail the issue. The Inform Act requires online marketplaces to collect, verify, and disseminate high-volume marketplace seller information. That starts at the end of June. Review.
Court, appreciate that very much. Nice setup here as we get into some more discussion of retail with Michael Lasser from UBS. Michael, it's great to have you. You know, every retail snapshot is complicated, and this one has weather, it's got SNAP, it's got tax refunds, it's obviously got the consumer mindset. Is Foot Locker a decent lens or not?
I think the lens is that discretionary retail is already in a recession, Carl. We've seen that consistently in the reports that materialized this week, and it's likely to get worse before it gets better. In addition to all of those factors that you mentioned, there's going to be looming headwinds in the months ahead. Number one, in August or September, those who have student debt are likely going to have to start to repay those loans. That alone can be a $7 to $8 billion hit to consumer spending per month. In addition, the best estimate we have is from the San Francisco Fed, noted that.
All right, watching Google for C pivot here. Google, Tesla. Tesla trying to make a higher low. It looks like it's printing a higher low. Tesla.
As we get into the back half of the year, and those factors are going to put what is already a difficult situation for discretionary retail into an even further difficult spot.
So I know some of your favorites include Walmart and Dollar Tree. Is that on the notion that they are going to continue to get some audience from income levels higher than
SPY sideways. Big change from yesterday. SPY.
It's in a good spot, if only
Qs.
because, it's benefiting from a unique trend, really the micro influence trend.
Yesterday we had a very nice trend, pretty obvious. Today we have no trend, flat VWAP. Okay, let's look at a few other things. Let's see what's working right now. Okay, communication sector, we already talked about XLC a few minutes ago. You can see Comcast is trending. 21 EMA, a bounce yesterday at the 21 EMA. Look at the weekly. Comcast is trending, so it's a $40 stock. CMCSA is in the communication sector. Both are trending.
We're paying particular attention to next week that we think are compelling ideas.
Finally on this shrinkage issue, Michael, has it ever been worse for the industry? And if in fact there's progress made, is it going to lead to some unexpectedly more profitable quarters for some of these companies?
Well, first, David, hopefully my pitch right now is as good as your pitch was yesterday.
Second, mine was not as good as I wanted it to be. But
I thought it was
Michael.
good.
Yeah,
I thought
it was fine.
Good. The second issue is shrink is worse than it's been for the retail sector. And at some point,
Comcast is trending, looking good, just off the 9 EMA. Activision reversing.
That puts pressure on municipalities to enforce the regulations.
Okay, Google obviously. IPG, Interpublic, trying to break out. Interpublic, $40 stock.
Technology to help prevent theft. Or third, if those two first things
Live Nation, LYV. Let's take a look at that one.
paying the price for this,
That's trending.
pass along the higher costs.
LYV.
So eventually this get worked out. It is an issue right now, but over the long term, this should find
Double bottom on LYV. Similar thoughts to what we saw on IBM, where you had a double bottom here, trend break, IBM moving to the upside. Same thing with Live Nation, double bottom, trending above the 10 EMA. Just buy the dips. You want to buy dips. You don't want to buy, well, they see they already bought the dip this morning. So if you look at Live Nation, these are all communication sector names. Okay, it's sideways. They bought the dip though. Live Nation. Warner Brothers not going anywhere fast. Take-Two with earnings yesterday. News Corp, that one gapped up earlier last week. Omnicom. Paramount Basing. Netflix, obviously. News Corp. Big base. Still needs to push higher. Could be construed as a range. So it needs to break out of the range. I would rather be in Meta. Meta is definitely trending. Buy dips on Meta. Should be fine. Just buy dips on Meta. You should be fine. Most recent earnings. A lot of people were expecting the earnings gap to be faded more. The thing with Meta, okay, so we're only 2 quarters into this whole new mindset that Mark Zuckerberg heard the things that Brad Kirshner was one of the biggest investors in Meta, what he was saying when he wrote that letter to Zuckerberg. Forget about metaverse, or at least focus more on the main business. Zuckerberg heard it. The first gap up after that letter faded more. Okay, so 197, 167. All right, so you got a 30-point move. And since then, the most we do is come back to the 21-day or the 9 EMA. And now, lately, in the most recent quarter, this is what I see. Notice that this entire time into the previous earnings and last earnings, RSI has been above 50. It's staying up there. So the strength of this trend is pretty impeccable, really. Let me go take a look at Ichimoku. Okay, so we should be trending. Solid green cloud below. You got Chiku above price. 26 periods behind price. This is a double check using the Ichimoku trending system. We had the breakout back in late December, early January. And since then, we've just been above. There's no crossovers. There's no, like we see right here in January, this bullish Kumo cross. We don't have anything there. So it's still trending. So buying the dips in Meta makes the most sense. All right, so we're dipping today. Maybe you get a better entry at 240. No hurry. Bank stocks are just sitting here doing not much of anything. Oil and gas stocks are pretty active today.
It was difficult, even,
CTLT, DXC, EOG resources, don't buy the gap up, just wait. This looks a little better. It's closer to a recent low. Pioneer. Okay, base. BXP. Boston Properties. Real estate. Everybody said that the real estate market was going to go to hell in a handbasket. Maybe commercial. Retail. Boston Properties has a lot of retail, right?
When you go talking to them about borrowing, they say, what kind of business you're in? Restaurants, high risk business. So a lot of them don't.
Oracle hanging in there. Looks like it wants to follow through. Snap, still looking for it to get above 10. Snap. Home Depot. A lot of stocks look like they're just worn out from a very bullish week. FANG stocks not going anywhere. Mostly red signals on the FANG stocks. So, all right, I'm going to take a little break here. The markets aren't going anywhere fast. I'll be right back. Let me get some coffee.
Things that do need to pull through too, right? We've got the employment data that's still kind of, creating a little bit of heartburn for the Fed. And as long as that stays up, we've heard George say many times that, mathematically speaking, it's just impossible for us to move into a depression, or a recession, as long as we see these unemployment numbers, as it were, like they are. And so, that's another thing that needs to come into play. But, the overall sentiment as we've come out of this week, the overall sentiment of the market's actually been, I think the word to use is quite joyful, right? I mean, we've seen a lot of good things happen in terms of sentiment. Now, whether that sentiment is making an accurate assessment on the companies that are reporting earnings and the things that are happening, I guess that's yet to be seen. But as long as that sentiment's there, the stock market will continue to move. And I think that the Fed will have to, I agree with Nick, that the Fed will have to respond to that sentiment for sure.
All right. By the way, I didn't even realize we're actually up to like 37% for a hike in next month's meeting. So the odds are moving up here. Market seems to be shrugging it off so far. Maybe 50 will be the magic number. Yeah, real fast, Nick. You got about 30 seconds.
No, I just think, Oliver, we started off the week talking about kind of how the higher end retail, where you and Jenny hit that, Walmart's unchanged, Home Depot is down. I think we expected to see kind of lower end retailer do really, really well here. That's not coming through either. So I think it's just one more kind of feather in the cap that inflation is still hanging in pretty solidly.
Okay. Appreciate it, guys. Thanks for the thoughts, Scott Durfee, Nick Theodorakis, Trading 360. Caroline Woods is up next. I will see you on Monday. I'm off this afternoon. And have a good weekend. We'll definitely be watching the close, though, so maybe look for some tweets. I think the second half can be very interesting today if Jerome Powell actually addresses that rising chance of a hike next month.
Welcome back. We are just moments away from Fed Chair Powell delivering remarks on the economy. Let's go to Bob Pisani right now and get a quick look at what the market action has been so far, what it is ahead of Powell's remarks.
Well, we started very optimistic that maybe we were shifting into some of the cyclicals early on the strength of Deere, but that's been a tough call in the last hour or so. So good news is energy, materials, industrial generally started stronger. That's a nice little shift over the dominance of tech that we've seen. And tech is still flattish to slightly down. But take a look at the cyclical group. Deere started really strong on terrific earnings, and middle of the day just drooping lower. Caterpillar was much higher earlier as well. GE was at a new high. Eaton was also positive. The big cyclical global industrial names all were starting very strong and have been weaker just in the last hour or so. The issue here is there an opportunity to move into cyclicals and trim technology that's been such a leader. What's different is these bond yields have been rising at the same time as the stock market's been rising. And that may be signaling reduced odds of a recession, maybe some optimism about a debt deal. But at any rate, it's not bad news. If you look at the S&P 500, it's finally broken out of that trading range we've been looking at for a long, long time. This is the highest for the year right now. And what we need is broader market participation. We've been whining about how the tech stocks have been dominating things. How about getting some of those cyclicals moving? And you can see energy, EOG, and some of the other big entities moving to the upside today. Carl, back to you.
I appreciate that. Important morning. And in fact, welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Sarah Eisen, live at +9 of the New York Stock Exchange. We are awaiting the Fed chair set to speak at the Thomas Lawback Research Conference in Washington. You'll see Bernanke on the right side of your screen as well. When they get going, we'll take you there. In the meantime, markets on obviously holding cards close to the vest. Dow's been up about 100 for most of the day. We've been hovering right above 4,200. Mike Santoli, Steve Leisman with us. Sarah, the question is whether he backs up his prior comments at the presser about that tweak to guidance being meaningful or leans into the Lori Logan and now Bullard camp today.
But the fact of whether he's going to signal anything at all about the June meeting, given the fact that we still have a key inflation and unemployment report for the month of May. Little bit of disagreement from the Fed members about whether June really is a live meeting for an interest rate hike. I think this all importantly comes against the backdrop of a week where stocks rallied, and importantly, stocks rallied as yields rose. And we certainly saw that yield rise in the 2-year yield, which is sensitive to Fed policy rates. Probability for a June hike went up some 40%. The dollar rallied as well this week. All signals that a lot of the data has been surprisingly better. And if you came into May expecting weak U.S. data and strong China data, it's pretty much been the opposite. And that's what's driven a lot of the dollar rally, Mike. And what surprised people about what the Fed may or may not do?
Yeah, and it is really only the last couple of days that all those the firm data points are filtering into Fed expectations. I don't think there's a lot of that. Maybe Stephen has a different view that June is live, but the question is, what is the kind of default assumption of what they're going to do? If the pause is the central assumption, or burden of proof on a pause is pretty high.
Yeah, Steve, I hear a lot about should they skip it? Should they skip instead of pause? Would that be a good compromise for those like Lori Logan who are still not satisfied that inflation is coming down fast enough? Steve?
I'm sorry, guys. I was just listening to them louding Thomas Lawback there. You want to repeat your question, Sarah? I'm sorry.
No, just whether there's been a bit of a conversation shift, and this morning there's a lot of talk about whether they should skip June instead of pause June, meaning skip June and maybe hike July, or at least telegraph that that's on the table if they're really eager to pause, but not eager to, call it quits on the rate hikes, given some of the economic data has been stronger.
That would be the hawkish pause idea, which is out there, and the idea being whether or not they back up this idea. They've been downplaying a bunch of the positions we've spoken the last couple of days. The banking issues, and that's kind of clearing the way for them to start to talk about the possibility of hiking. There's two things going on, Sarah. I'm sure you've noticed. One is them saying inflation is too high, but a new issue that's come up is they're saying the progress in bringing inflation down has slowed. Both Jefferson has said that, Logan said that, and Bullard, of course, has been clamoring for another interest rate hike. So we'll be listening to Powell, who I think right now is talking about Thomas Lawback, the Fed advisor who died several years ago and who's being honored in this conference for his work on natural interest rates, among other things.
Steve raises a great point, and it's shown up in some of the regional Fed surveys, this idea that if you look at prices paid, maybe you have wrung out as much disinflation as you can. Investors talked about this. Others would counter, we'll just wait till housing and shelter catch up.
Yeah, you're waiting for the shelter numbers to filter into the headline. And I guess the question too is, we're going to have an update to the Fed's outlook in this meeting, and that means they're going to have to probably reprice their outlook for better growth. And what do they mean? What does it mean for terminal rate and inflation? So all that stuff. There's some suspense, I would say, building. Although what's fascinating is several months ago, Powell said he didn't really want to pause and resume tightening.
That was, and I think because it suited his message at the time, they didn't want to signal a pause at all. And now it's sort of like a different conversation.
Yeah,
Talk about that, in light of what Australia's done and some other central banks around the world.
Yeah, which you brought up. They have to, if they're going to be data dependent, they have to be flexible. I think the problem with Steve being data dependent is you don't exactly know what the Fed's reaction function is.
No, that's definitely true. And the other thing is you can't sort of plan and say, well, I'm going to put into my model another bank going down or something like that. The stresses in the banking system are kind of like where they were. A slight increase on the drawdowns at the Federal Reserve window and the new banking fund. I talked to a bunch of bankers this week in Washington. They seem like, they have issues. They're on alert, but they didn't seem like they were in kind of crisis mode right now. And I think that's the kind of feedback the Fed is getting, that it's at least opening the door to the possibility. Look, there's obviously some more data to come. But I'm going to say this, Sarah, we're about 33% probability of a rate hike in June. It's been as high as 40% this morning. Yields, as you know, are on the move. I think we're one bad inflation report to this market pricing in another rate hike. That's where I think we are right now. And I think the Fed would take it if the market gave it to them. And I think that's something that could be shaped by what we hear today from Powell. It could be shaped by Fed.
Steve, how likely do you think that is, given some of the hopes that the Doves have, at least about base effects on this coming round of prints?
Carl, who's been right about the economy yet? Send me that report that I haven't seen. But I was just given a speech the other night, and I was.
All right, watching Apple here. Apple's on the move. Could have something going here. You can see the Qs are starting to move. Apple's starting to move. Google. Still looking for that C pivot and a D. SPY is still moving sideways.
You also had earnings estimates getting slashed. Now they're perking up again. So there's a different storyline, a different source of energy in the NASDAQ stock, specifically the valuation that's based on yields. But I agree. At some point, the market might notice that the yield.
Watch Snap. There might be something on Snap. Starting to move here. Snap.
The question is, how much more dovish, and what's the cost to the economy for that more rapid pause? We don't know the answer to that. Remember, 3 months ago, we were talking about 6% terminal Fed funds rate because we got that hot January number. We're still not there. Yeah, we're not back there.
Right. I mean, we looking back at January, we sort of make fun of those numbers.
Exactly. Yeah. Right. A little bit. And then I do think it also gives you pause about what the predictive value of looking at things like the 2-year note yield, because it has been absolutely all over the map, moving much more quickly than it probably should, based on how slow the economy and inflation.
Which is why it's important that the KRE, the regional banks index, has moved up this week. It showed signs of stabilization.
Exactly.
We know the Fed has been watching that, and everybody's watching that to figure out what kind of panic is still, I guess, in the system. It's better, although there's evidence that there's still stresses and that the credit squeeze is happening.
Right. It's
And
just a
we know the Fed
question
is
of
watching that.
people are confident to be able to play that through for effect on GDP and therefore inflation. Steve's point about nobody's been able to predict the economy correct, but inflation has been coming in pretty close to forecast. The inflation surprise index is like at 0, which means that we nailed it in the last couple of months or so. So we'll see if that continues next week. Steve? Yeah, real quick, a couple of headlines from Powell that are not barn burners, but I'm going to just tell you what they are, then I'll tell you what they're not. He's saying inflation poses significant hardship. Inflation is far above the Fed objective. The Fed is strongly committed to returning a 2% goal. He did not say in his opening remarks the banking system's a real problem here. And here he is. He's going to talk now, but I just want to tell you, so far he has not emphasized the banking issue. That's the one that will lead you to more dovish conclusions rather than inflation, which leads you to more hawkish.
Steve, appreciate that. Let's get to the Fed chair and back then and the former chair.
Have inspired and really demonstrated that understanding the connections between financial sector, credit markets, and banks and the real economy is critical for even understanding traditional business cycles. So with that as background, we have just experienced a period of stress in certain parts of the banking system here in the United States. So I want to get your take on those developments, how you think they match up compared to some previous episodes, and what they might mean for the economy.
Well, in some dimension, the recent crisis has followed the standard sequence. I don't know anything about Silicon Valley Bank other than what I read in the paper, so please don't misinterpret this. But it was a classic situation where they had assets that were subject to risk, in particular as interest rates rose, the value of their long-term assets fell and their capital fell. They had hoped to hedge that by their deposit franchise, where as interest rates rose and interest rates moved more slowly on deposits, that would partially compensate, but they were dealing with customers who were very social media savvy, and that didn't really work. So after the decline in capital, you had the second stage, which is runs, people taking out their money, which ultimately led to the collapse of the bank, despite, I may add, good efforts of the Fed and the FDIC to provide liquidity and provide support for depositors. The third stage of a banking crisis is contagion. People looked at other banks and said, oh, they look sort of vaguely like Silicon Valley Bank. They got the same number of letters in their name and all kinds of things like that. And that caused people to begin to remove deposits elsewhere. And finally, the reason this is important is that it ultimately affects credit conditions. And the Federal Reserve is, of course, looking at the effects of bank problems and other financial issues on the extension of credit and therefore on the real economy. So, in that respect, I think it's very similar to other crises. I think it's different from the global financial crisis in many ways, including its scale and scope, of course. But I would mention a couple of things, a couple of important differences. One is that the impaired asset in this case was U.S. Treasuries, which are very different assets in kind from subprime mortgages, in that U.S. Treasuries can always be valued accurately. And so there's not the uncertainty that was associated with subprime mortgages. And secondly, as the economy declines, if it does decline, U.S. Treasuries actually become more valuable rather than less valuable. So there's kind of a counter-cyclical effect. So that's one very important difference, I think. And then the other worth mentioning, but very important, is that relative to
Low tick alert minus 800.
Low tick alert.
Borrowers are in much better shape, than they were in these previous episodes, and that makes a big difference, both in terms of the stability of the banks and also in terms of the impact on consumer spending and
Extreme low tick alert.
All right, markets are playing off of their conversation. We know that 420 is a major level, so a fade from here and give back some of the gains from this week wouldn't be surprising. We haven't taken any new positions per se.
Start by saying, though, that the
and well-positioned to deal with the challenges they may face now or in the future. So, as you pointed out, we do have separate tools, monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation, this is the separation principle, separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated, financial stability affects macroeconomic stability and vice versa. We saw that clearly at the outset of the pandemic. As a result, the tools that we use to address concerns in either arena can will affect both during extreme circumstances. That said, yes, the tools are separate. They have individual purposes, and most of the time, each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, discount window, and the Bank Term Funding Program to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate need to rise as much as it would. That is highly uncertain.
Thank you. Of course, that
Low tick alert -800.
This is reflected in the fact that the FOMC has actually raised interest rates twice since the emergence of the banking strains. Of course, and the purpose of that is to confront the inflation issue.
Extreme low tick alert.
Which is in fact inflation. In the pandemic and the aftermath, we've had many renewed discussions of the important and classic textbook distinction between supply shocks and demand shocks. And in particular, the particular challenges that a supply shock can present to a central bank. And that's also raised a lot of questions in academia and in policy circles as to whether or not the inflation process post-pandemic is going to look quite different than prior. Jay, maybe we can start with you. A number of folks have argued that we are entering a new period where supply shocks will be more frequent. Would love to hear your views on whether you think that's a possibility and what that might mean for central banks.
So it's a great question, and it's one that we've been dealing with for quite a long time. And I'd say it's certainly possible that we'll see continued supply shocks. I also think it's just very hard to forecast that with any confidence.
All right. Powell speaking. Bernanke was speaking. The two of them pretty much not interested in doing anything in the markets at the moment. Had a really good week, so I don't want to give it back.
I will say that, though, that some positive supply shocks related to globalization largely probably contributed significantly to the period of low inflation that either ended or was interrupted by the onset of the pandemic. And I'm thinking there of the increasing global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem likely to be repeated. At the same time, the drivers of the current inflationary surge certainly included a sequence of large negative supply shocks, the global supply chain for goods, which also experienced a large and persistent shift in demand from services to goods, and also the supply of workers. On top of that, Russia's war against Ukraine brought further shocks to global supply chains, particularly supplies of energy and non-energy commodities. So we can't know how persistent those shocks will be or whether further negative supply shocks will come along. Will globalization be partially or fully halted or reversed? Will it resume again as the pandemic mercifully recedes into memory? We can't really know that now. But for policymakers, the bottom line is that central banks will continue to be responsible for providing price stability, and that will require us to navigate whatever additional supply shocks do occur. So as Tomas and Ben and their co-authors wrote in the inflation targeting book, what a central bank can do is control inflation, and that is true over time, even in the presence of supply shocks.
Ben, I'd love to hear your views on this.
So unusual events which disrupt normal economic functioning often are followed by inflation. Examples are World War I, World War II, Korean War, and now the pandemic. And the pandemic just makes it harder for policymakers to understand what's happening and to react appropriately. In particular, the pandemic scrambled the labor market, made it harder to judge the state of the labor market. The opening led to a very extended rise.
All right, market muscle, tick cumulative, price action, telling you just to chill for a while.
Low tick alert -800.
So there are many features of the pandemic that made this an unusual episode and a difficult episode to address. That being said, I think that, and I've done some research on this with Olivier Blanchard that we're presenting next week. The basic mechanisms, I think, are still the same. If you have a bunch of bad shocks, that's going to give you a problem. But the underlying mechanisms of supply shocks and tight labor markets and so on are really the same. So I think, I don't think there's been a major change in the underlying process that generates inflation, only a series of shocks related to the pandemic that gave us this episode. Going forward, I agree with Jay that we can't predict, what new shocks will come. We've got new technologies out there that might, make big changes in our economy.
Dollar just dropped like a rock.
We've got, green investment, things like that might affect the price and availability of fossil fuels. And so there are many, many things that we can't predict. But I think that broadly speaking, that the inflation process has not changed, and it's one aspect of that, which is very good news, is that the Federal Reserve's credibility has helped keep inflation expectations, particularly longer-term inflation expectations, reasonably well anchored, which is always sort of the first step in getting control of inflation.
You mentioned the role of
Watch gold. Dollar just dropped pretty dramatically there. All right, gold's starting to bounce. Priced in U.S. dollars. Gold is ripping here.
At the same time, inflation was kind of struggling to get up to 2% on a sustained basis. Here we are in 2023. The unemployment rate is roughly at the same level as it was prior to the pandemic. But of course, inflation is far above 2%. So in that context, should we be thinking about the relationship between slack in the labor market and inflation differently? Do we not have the right measures of slack? Is it the problems with understanding what the natural rate of unemployment is? Or is slack really not the key to understanding inflation in the first place? Okay, you want to take that one first?
As I was talking about before, I think that the pandemic, to some extent.
All right, watch the GLD here. GLD popping on a drop in the dollar.
When the labor market matching processes did change, then the unemployment rate. So there has been some scrambling of signals. That being said, it's not true that even in people who've understood since the 70s that there's not a simple inverse relationship between inflation and unemployment. In particular, what can break that relationship is supply shocks. And so during the 70s, we didn't particularly have tight labor markets most of the time. We had high inflation, because we had oil price shocks, which the Fed did not respond to adequately. B, because inflation expectations were not well anchored. And there was a strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist. But the remedies might be, depending on the situation, might be
Ray, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic inflation unemployment very low, close to 3.5%, but then we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it's changed fundamentally after the pandemic? And my answer would be tentatively no to both of those questions. I think what really is different this time was the series of unexpected and persistent supply shocks that featured in the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in spring of 2021. By contrast, I do think that labor market slack is likely to be an increasingly important factor in inflation going forward. In particular, inflation in non-labor services is showing signs of real persistence. In this highly diverse sector, labor costs are a high proportion of total costs, and that sector happens to account for more than half of the core PCE index. But all of this, the point is, all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the natural rate of employment probably rose sharply as the pandemic severely disrupted the labor market. And the implication of that would be that an unemployment rate of, say, 4% indicated a much tighter labor market in 2021 than it did in 2018. And as Ben mentioned, of course, after the pandemic, we began looking at much more closely at alternative measures, particularly vacancies, but also quits, which have been signaling even greater tightness than the unemployment rate alone might have thought to signal. I mean, to put some numbers on it, we at the end of 2018 and the end of 2021, we had 4% roughly unemployment in both cases. In 2018, the vacancies to unemployment ratio was 1 to 1 essentially. In 2021, it was 2 to 1, and that was a much better indicator, obviously, at that time of the simple.
It's not much to do as these two guys, Bernanke and Jay Powell, speak.
The other thing is, it may also be the case that the Phillips curve has steepened, meaning that inflation has returned, at least for now, to being more responsive to changes in the labor market slack. But the Phillips curve was once thought to be fairly steep to flattening. Relationships in the economy, like the Phillips curve, evolved. So I would not characterize that as a problem for our understanding of inflation.
Very good, thank you. Maybe we can pivot here to the topic of central bank communications. It's widely understood now that the better the public understands the conduct of monetary policy, the more effective it will be. But fostering that type of understanding really requires a lot of communications, and of course that can be hard. Both of you have been powerful advocates for advancing monetary policy communications, both with an eye toward making policy more effective, but also for the purposes of promoting transparency and accountability. Ben, you've obviously played a critical role here advancing the FOMC's communications, including the introduction of press conferences after FOMC meetings, the introduction of the summary of economic projections. So what changes over this period since the communications revolution began would you highlight as being some of the most effective, most important, and where does remaining challenges exist?
Well, let me talk about communication, because I think you need to understand that it serves multiple purposes. I mean, one of its purposes, the narrow purpose, is to try to align market expectations with the Fed's own thinking. I think that goes back to Alan Greenspan. You go back to 1994, the first FOMC statement. I mean, since then, the Fed has tried at least to give some indication of what it's thinking and what it sees as the risks to the economy. But beyond that, you mentioned transparency and accountability. This is a powerful institution. It's very important that it be accountable to the Congress and to the public. And the best way to do that is explain what we think, what we're doing, and how.
Low tick alert -800.
There's other reasons for communication. One I would talk about is feedback. We're having.
To be clear, I'm not doing much of anything right now as these guys continue to talk. There's really not any trend in the markets. We are fading. We had a great week, so I'm not interested in doing much to give anything back.
How monetary policy affects them. One final thing I would mention is diversity of views. Because the Fed has a consensus culture and there are very few dissents normally, the outside perception is the Fed is subject to groupthink, which of course is possible, but with people talking about their own views and explaining why they see the economy as they do, it does, I think, at least to some extent, show that there is a range of opinion on the committee. In terms of tools, I guess I do feel proud about the press conferences, which I introduced 4 times.
We're going to step away from the Fed chair, the prior Fed chair.
Yeah, good idea.
Of course, monitor our headline for you, but we are getting some news to bring you on the debt ceiling and those negotiations, which have been ongoing. Kayla Tausche in Washington with more. Kayla, what's happening?
Well, Sarah, negotiators from the Republican side and the White House side have been meeting every single day, and the meeting between those negotiators just broke down with GOP Congressman Garrett Graves leaving that meeting and saying that Republicans were going to press pause, that the talks were no longer productive. And according to our NBC News colleagues who were outside the room where the negotiators were meeting, he said, until people are willing to have reasonable conversations about how you can actually move forward and do the right thing, we are not going to sit here and talk to ourselves. Now, it's unclear exactly how long they're going to press pause for. If that means the talks are just completed for today and they'll resume tomorrow, or if there was a breakdown in substance over the conversation about exactly how much spending to cut or which programs to introduce.
Low tick alert -800.
We're efforting more information. I've reached out to White House sources for their reaction to what happened inside that meeting. And we'll bring you more as we have it, but it certainly is a fly in the ointment of what had been quite a bit of momentum in these talks in recent days with both Republicans and Democrats saying that they were headed in right direction.
Extreme low tick alert.
That passes the House as soon as next week, that the Senate could take it up after that, and all crisis would be averted. I know Treasury Secretary Janet Yellen spoke yesterday to major bank CEOs who are in Washington. She said that a positive path was emerging, according to 2 sources who were present at that meeting. But certainly it seems like
VIX on the move.
Direction today. Carl and Sarah?
We can see the market reaction, obviously, in equities, and there's a look at gold here. We were talking schedule-wise, Kayla, about Sunday because of the president's trip getting cut short from the G7. I guess, is there a feeling that it bleeds into next week that is a mark of failure, or we had already begun to see some fraying from groups like the Freedom Caucus and some progressive groups?
Well, it depends on where you sit, Carl. I mean, I think there had been some who viewed the noise from the Freedom Caucus as well as Senate Democrats saying that perhaps that means that the 2 sides are moving closer to a deal when they're compromising, when they're introducing things to the agreement that that both sides don't like, and perhaps that means that they're actually making progress. President Biden at the G7 left a dinner early overnight to be briefed by his team on the status of negotiations. He's giving a press conference Sunday morning, very early Eastern time, where you would expect him to comment in depth about the status of the debt ceiling talks and whether they've made any progress. Certainly, the expectation was that negotiators were going to keep talking throughout the weekend. And certainly, all of next week is long. They have, several days that they could continue meeting. But I think, Carl, the clock is ticking. And if there is not an agreement soon, then I think the market may have its own say about what needs to happen here.
A lot going on right now. There was also a headline crossing. Yellen told bank CEOs that more mergers may be necessary. That was according to CNN. But it's very sensitive here around some of the headlines.
Low tick alert -800.
We saw the banks, the KRE, the regional bank index, which we watch as a litmus paper, turn negative on the day after those Yellen headlines. Not sure if you know any more about just what was said between Yellen and the CEOs.
Well, I know that the discussion was
Extreme low tick alert.
This is a regularly scheduled meeting by the board of the Bank Policy Institute. It happens every year. And so, they have a broad discussion about the state of the industry. And it's only natural that recent consolidation, recent emergency measures, and forthcoming changes to regulation would have been on the agenda.
GLD moving higher.
People who were inside the room, they said that, they were talking more about the health of the economy. And I'm also told that Secretary Yellen reaffirmed the June 1st X date, but there was no additional wiggle room privately behind the scenes when talking about any potential flexibility that Treasury may have
to pay its bills or prioritize its bills if these talks didn't have progress. So certainly there was a conversation and would have been a conversation about regulation, about the banking industry writ large, but also very big concerns from these companies to essentially, keep the treasury market moving about what exactly is going to happen in the next few weeks.
Kayla Tausche, Kayla, thank you very much for the update. Of course, we're breaking down those debt ceiling negotiations, a lot hitting the market right now. And of course, bank consolidation, if there's more of it, means, we're reminded that more banks might fail, like there might be more stress in the system. So a little sensitive. As far as the Powell remarks so far, Carl, not much. He did make one remark about the developments in the banking sector, which he said may mean that the policy rate, our interest rate, might not need to rise as much to achieve the policy goals. I guess that's dovish, although he said some similar things before.
Yeah, that was maybe, I don't know, for dovish, one of the more constructive headlines we got in the last 30 minutes. I was struck by the number of times they talked about supply shocks, given the fact that supply chain pressure indices are actually back to levels we last saw around.
All right, so the dollar dropping off, the 10-year dropping off, VIX is spiking.
Low ticker minus 800.
Gold is spiking, moving the opposite direction of the dollar right now. The dollar's producing a bear flag. And response, gold is moving higher.
Ceiling dynamic, we had for a while seen this sort of split where the White House would talk constructively about the pace of negotiations, the speaker would say otherwise. Then the speaker appeared to come around in the last 48 hours and say maybe a deal will be possible in principle by the end of the week. The president talked about potentially maybe having a press conference on Sunday, at least around the time of his return. Now we're back to a period again where this morning the White House sources told the wires that talks had been going well. Now hearing otherwise from the side on the GOP.
And time is running out. June 1st is the so-called X date set by Treasury Secretary Yellen, where we need to have a deal to raise the debt ceiling, or else technical default, tough decisions are going to have to be made. We were getting a lot of promises and hopeful signs, and that's part of the reason when you talk to market participants, Carl, the market rallied this week, and we saw Treasury yields rise, and we saw the dollar strengthen, all signs that it's a little less risky here. So, on a Friday with talks breaking down, it's not necessarily good. It's not a surprise that the markets turn negative on the session.
And on top of that, we got the options expiration as well.
GLD continues higher.
Of about 0.5% though. Let's get back to the Fed chair.
One in which inflation comes down much more quickly than the committee participants think is most likely, perhaps due to a significant downturn. I would say also, so far,
Bear flags on SPY for now.
Committee's view that bringing inflation down will take some time. Moreover, something we often don't remember to think about is that market prices always reflect both expectations and compensation for risk. And what market participants say in surveys of their expectations is actually closer to the views in the SEP than what is reflected in market pricing. So ultimately, my colleagues and I have our forecasts, and market participants have theirs. Our role is not to advocate for our forecast. What we can do is be clear about our expectations for growth, unemployment, and inflation, and the likely implications for policy. As well, we want the public to understand
Low ticker minus 800.
the path of the economy were to differ materially from our expectations. And of course, we do lay out our individual forecast.
Extreme low ticker.
Then what would your takeaways be for the past couple of decades use of forward guidance as a policy tool?
Well, Charlie Evans and co-authors have made a useful distinction between what they call Odyssean and Delphic forward guidance. Odyssean forward guidance is a forward guidance, which is rarely used, but typically at the lower bound, where the central bank promises to do something and its credibility on the line that it will follow a certain path going forward, and that's a way of getting more stimulus. And I think, again, that goes back, again, to Alan Greenspan, I think, to indicate that a certain path was very likely, and that actually helps achieve the objectives. Delphic forward guidance is basically just a forecast. Here's what we think. It's Tomorrow we might think something different, but we're just trying to, as part of our transparency, we're just trying to give you a sense of where the economy is going and how we think policy will react. Now, as Jay points out, there are some problems in practice. People don't understand the difference all the time between a commitment and a forecast. That's something that Jay has emphasized, and I think should be emphasized. And others, people underestimate the amount of uncertainty involved, which is enormous. So I don't think you can do without some forward guidance, because the idea of transparency says, here's what we see. And here's why we're thinking. And so the idea that there's no guidance at all, most of the time, I take March 2020 as a counter example, but most of the time you do want to give at least a sense of where you think the economy and accordingly policy are heading. I think
SPY is still on a sell signal.
I think one of the issues is that the FOMC is so large and geographically dispersed that it's been
SPY is still on a sell signal from 11 o'clock, 11:04.
We tried to do that when I was chair. The dot plot is a compromise, which is not ideal. Other banks do other things. Sometimes they have collective committee forecasts that are voted on, or they use market rates, or they publish stat forecasts. There's different ways to go about this.
Just want to zoom out here as we listen to former Fed Chair Ben Bernanke in discussion with current Fed Chair Jay Powell. Stock market continues to lose steam. We're down 170 now on the Dow. I want to bring in Steve Leisman, our senior economics reporter, to hear, Steve, what do you make so far of the comments? Obviously not a major headline making discussion there, but the Fed Chair reading from some notes, but you gleaned some important information.
Yeah, so I think you mentioned the most important thing. He's reading from notes there. He's really giving us stuff that he wants us to say. These are not off the cuff. And there was something he said while we were talking about that important Treasury news I want to read out here.
Extreme low, take alert.
Down the middle, Powell is being. He says, we've come a long way in policy. Tightening the stance of policy is restrictive, and we face uncertainty about the lags effects of our tightening so far, about the extent of credit tightening from recent banking stresses. So today, our guidance is limited to identifying the factors we'll be monitoring as we assess the extent to which additional policy firming may be appropriate. He's not really, you've had officials, Logan, you've had Bowman, you've had Bullard say, we need to do more. Powell is not there. He is really taking a neutral stance on this. He's not guiding the markets either way. And what's happened in the process, and I want to give you a fresh quote on this, Sarah, the probability of that June hike was been as high as 40% this morning, now down to 15%. Obviously, it's a very volatile market. A little bit of trading can move it a lot. But right now, that what Powell is doing is baking out or reducing the market's assessment of whether or not there will be a June rate hike. So, and I think he's doing it quite purposely, Sarah.
Yeah, I think when he said that the policy rate might not need to rise as much as it would have to achieve our goals on the banking crisis.
That was earlier, right?
Yeah, and also, Steve, the fact that he deliberately, and this feeds into your point, did not use this as an opportunity to publicly try to convince the markets one way or another. For instance, he could have used it as an opportunity, like he's done in the past, to say inflation is way too high, we're not going to tolerate it, more policy action may be necessary. That whole script, which would have been hawkish and moving the markets the other way.
Super point, Sarah. And one way we can emphasize that is by contrasting what Powell's saying versus what Bullard's saying. Bullard said outright that he thinks that the banking problems are overstated. He also said that he thinks the bigger story for the market's economy and monetary policy is the decline in yields. Powell is still holding on to this notion that there's some unknown amount of credit tightening that's coming to the economy from the banking stress. Dismissing this. Logan was a little bit more in the Bullard camp on here. So we'll see. Lori Logan and Bowman have surprised me, Sarah, as two people who you would think would be acutely hawkish when it comes to the idea, or acutely concerned about the idea of banking concerns, and neither really has elevated those above their concerns about inflation.
But both pretty hawkish on inflation. Yeah, to your point. Steve, thank you.
Right.
Steve Leisman. Let's go back to listen to some of the final minutes of the Fed Chair, the prior Fed Chair in Washington.
In actual policy making, you don't even know what the current quarter GDP is, because it's going to get revised, several times down the road. I remember when I was was sitting on the just as a member of the board, and Greenspan was in the chair, and we had responded to some inflation data, and a little bit later, it turned out that inflation change had been revised away. And I asked the chair, do you think we can revise our interest rate policy? It is very difficult. I mean, I've got to laugh with that, but, just trying to make policy, it involves not just uncertainty about, the data, about the model, about all the things that can happen, about the social and economic and political environment. So it's very difficult. And unfortunately, or fortunately, given that monetary policy works with a lag, given that there are risks on both sides of the modal forecast, there's not much choice but just to accept that uncertainty and try and do the best you can, being ready to adjust as to it.
Very good. Thank you. We're getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as the community as well as some policy?
Well, I guess I would start with the labor market, and what we talked about earlier, vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles, most prior cycles. So that's going to be a question that we will resolve empirically. But I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was very, at the beginning, very focused on the goods sector due to the rotation of demand from services to goods and the tremendous amount of support that goods purchases got from fiscal and monetary.
All right, everything's starting to reverse now.
Through really into the service sector where it now significantly resides. I think we're seeing much progress on goods, and we have progress in the pipeline on housing services. But where we see persistent inflation is now in the service sector. So what is the mechanism by which what are the implications?
Ben, you have the last word.
Well, I think one of the things that I would urge researchers.
All right, we just heard a very academic conversation between Fed Chair Powell and former Fed Chair Ben Bernanke there at a Federal Reserve conference, largely focused on sort of more cerebral issues of monetary policy. So how to think about supply shocks, how to think about.
All right, so if we're going to see any kind of downside continuation, look for a rejection here and a rollover. Look for a bear flag. It's just shorts covering for now. Microsoft, nice turn.
Well, I think it was pretty much down the middle in the summary statement, talking about the need to bring inflation down more, but also the lag effect of the interest rate increases that have already happened, and also some of the strains in the banking sector, which perhaps might slow the economy and bring down inflation more than anticipated. So I think the summary was a little bit down the middle. I think this emphasis on the labor market and those alternative measures, especially the vacancies and how much they're focusing on that now, I do think that adds a tint of hawkishness to the commentary that would otherwise be down the middle. And also, again, the reiteration of the 2% target and how much the Fed is committed to that, really hammering that in. I do think that the Fed is looking at its dual mandate and saying that we already have maximum employment, and now the question is price stability. So really a heavy emphasis on price stability.
All right, stocks are turning. Lots and lots of stocks are turning. It's more than just shorts covering now. Looks like buyers coming in.
Michelle Bowman, Fed Governor Jim Bullard. So the fact that he did not do that, I think to your point, makes it a very
Wild card, watching Snap for a pop above 10. Snap. If SPY is going to continue, it needs more buyers. If this is just shorts covering, this will roll over and continue with a downward sloping VWAP. So it's a bearish kind of look to the markets at the moment. Need to see a follow through.
Too aggressive in the marketplace here, and there's already a lot priced in terms of some of the positive news that's taking place recently.
For now, it just looks like shorts covering for the last 4 minutes, 5 minutes. We need to see this follow through.
Long-term potential. I just wonder whether you think the market's leaning too much on it, and not just U.S. by the way. It has huge implications for example, why the DAX is at a record high.
The market is leaning very heavily on the Tesla. There's no doubt about it. That's where the enthusiasm is. That's where the perceived stability and growth is. I don't know in terms of whether or not we could say there's a mini bubble in AI.
Google held up very well, flat VWAP.
Certainly a lot of enthusiasm is taking place in the tech sector, and that narrowness of the market presents a risk itself.
Earlier in the week, of course, the story was, maybe we're getting at least a small taste of broader leadership as we see things other than technology supported by the bulls, and then we cracked through 4,200. I wonder whether you think after all those attempts, this one was more meaningful.
Well, it's nice to see broader leadership when it happens, but I think you really need stability in the banking sector. And say Janet Yellen's comments about greater consolidation. Yes, it's going to happen, but I do think we're starting to see elements of greater stability in the banking sector, deposits stabilize, and I do think that is the precondition for getting a broader base rally here and more participation from, especially from the mid caps and small caps and greater span across the industries or different sectors. So, I think that that's probably the key here. We need to see that stability. It's happening, but perhaps not happening as quickly as people would like.
Yeah, and certainly not linear, given a little step back in this action today, especially as you said, thanks a moment ago. Young you, thanks. Good to see you. Have a good weekend.
Thanks, Carl. You too.
Let's get to the stock story of the day, and that is Foot Locker. Shares are plunging this morning. That's down more than 27%. The company missing earnings and revenue estimates for the first quarter, and also really surprising the street, lowering its full-year guidance thanks to the difficult macro backdrop. I spoke exclusively this morning with Foot Locker CEO Mary Dillon, who gave us some insight into the numbers. I started by asking her about the softness in the consumer and whether it was continuing into this current quarter. Here's what she said.
All right, SPY, no follow through yet.
Up through, the beginning of the year, we saw some deterioration, and we thought it would improve, but frankly, it didn't. In April and continuing to May, we're seeing soft demand, and softer demand than we anticipated. It's as simple as that. So we're managing that by putting in front of our guests the best offers that we can that make sense to them, but we've seen some deterioration. Again, it's around the discretionary spend availability, and, you have...
All right, FANG stocks are looking better, higher highs, higher lows. All right, let me look at Microsoft. Microsoft still in a range. ServiceNow. ServiceNow. Flat VWAP starting to push higher now.
I noticed that you also mentioned shrink as a pressure on profitability, something we heard from other retailers, including Target, putting a big number on it this week. What exactly is happening? Where and how do you deal with this issue of rising theft?
Yeah, I've seen this. I've been in retail now for over 10 years, right? So it's been a growing issue. We are certainly not immune to it. Sarah, the most important thing, frankly, is to keep our customers, to keep our stripers and our employees safe, because we can't have folks get hurt in these situations. So, we're working with other retailers to do everything that we can, whether it's putting in trackers and working with local law enforcement to try to deter at that level. Of course, you know about the Inform Act and trying to deter at the resale level. So again, we're just really focused on making sure that our strikers stay safe, but working as an industry to try to get after this because it absolutely has margin pressure at our business as well.
Yeah, it feels like a growing problem across the U.S. Back to sales for a moment. How did Nike products perform specifically versus non-Nike products?
Yeah, well, you know what? We have, as you know, a great array of brands that we sell to our customers, and we have all sorts of things that work really well for us. I just mentioned, like, basketball, signature basketball with Nike is a real strong common point between Foot Locker and Nike. And we're seeing some real strength there with new players and new shoes. I also mentioned that, you know, the Jordan brand, of course, you know, stands the test of time forever. And a really cool launch last weekend with a black and yellow colorway of the Thunder 4 sold out immediately. So we are working off of less allocation than we've had in the past, but our sell-throughs continue to be really strong. Having said that, there's other brands that are doing well in the category. New Balance is showing a lot of strength. We had a great Grayscale day. People are looking for performance running options. Hoka and On, which we have in a growing number of doors, also performing very well. So it's really across the board where you see specific items and events that work well, but overall lower demand for the category that I think is transitory. We believe it will be.
A lot of people want to know an update, Mary, about your relationship with Nike, because when you came in, there was a lot of hope that would be fixed. On the last quarter, you did say there was a renewed relationship. Can you give us any more specifics about what that looks like since it's such a key customer?
Sure. I mean, it's a long journey, and Nike is so important in the industry, so important to customers and to us. And so what we're really focused on is, yes, we're in the midst of a reset in the marketplace, which we understand, and eyes wide open. And I would say that what we're focused on now is really together building our future for growth. My team was just there in Portland all week working on, you know, growth plans as we move forward. So we expected this to be a reset year. And now as we continue to do two things, sharpen the points that we have most commonality, basketball culture, sneaker culture, and kids, where Kids Foot Locker is really the biggest player in kids, and really working with the Nike team to really drive those future growth plans. We're doing, I think, an even better job on data sharing, marketplace planning, and as we continue to invest in our retail proposition, I think that raises the boat for everybody.
So very clearly you're in the middle of a turnaround and it's hit a speed bump with the macro environment. How do you talk to investors about the timeline? Investors that have been very excited to see you come in and want to see the kind of Ulta-like results, whether it's on the loyalty program or just shareholder returns.
Yeah, well, I'd say, you know, I'm just as transparent of a leader as I can possibly be. I'm extremely confident that we've got the right strategies and right team in place to deliver on the strategies and the targets that we put out for the long term. It might take a little longer, okay? Life is not perfect, but I see the green shoots starting to happen. And just for me, like what I love about retail, and especially Foot Locker, is we employ over 40,000 young people in stores across the U.S. and across the world for whom this is often a first job and a career. I am so committed to making sure that we stay the course, that we're patient, and we continue to deliver on what our investors are looking for us from. And I recognize that. That's my job.
And what do you say to the skeptics who wonder if this is a Foot Locker specific problem? Because while we've seen some uneven results from retail lately, what we keep hearing is that the consumer is still in decent shape. We have a very low unemployment rate. There still is this excess household savings from the pandemic. It's not like we're seeing a collapse. The GDP for the second quarter is tracking almost 3%.
Well, again, I would say as we look at our customers, you know, we have a wide income range, but really we skew more middle and lower income where the pressure is higher. I mean, the facts and the math are that, you know, pressure is going to be different depending on the household level of income. So again, I think we're seeing more pressure. I also am seeing some really strong signs already with improvements that we're doing in our digital experience and our loyalty program that we are putting more things in our control to continue to drive that demand as we go forward. So, you know, I'm optimistic. I know that our customers are going to be with us and our brand partners as well.
Our thanks to Mary Dillon for talking through some of the numbers, which are getting a rough reception on Wall Street. Keep in mind, there have been high hopes for her and for Foot Locker. So, and we've seen some sharp swings in the stock before, 20% upside on the last quarter. But clearly, and she said it, pushing out the timeline for recovery. She said she still sees some green shoots, but a lot of it has to do with the unexpected weakness in the consumer. They thought that the consumer was going to come back after the weaker tax refunds. Didn't really come back. And the important point, is that they're almost 50% exposed to low income consumers. That's people under $50,000.
What did you make of Kramer's take this morning that she might just be clearing the decks the way she did in her early days at Ulta?
She had set a precedent with her work at Ulta, and it very well could be the case because it was a big hit to guidance. And there are issues there, like high inventories. They're going to have to do promotions, like the shrink, which we talked about, which continues in the consumer. But no doubt, it's a turnaround story, and the bar just got higher. But perhaps she's trying to bring on the bad news in hopes for improving on there, which a lot of early, CEOs do for sure.
That's an incredible way to end a busy week of retail. We're off the initial, those post-conference lows, obviously, and the news about the debt ceiling. We now heard from the Senate Majority Leader McConnell. He tweeted a couple of moments ago. The president waited months before agreeing to negotiate with Speaker McCarthy on the spending deal. They are the only two who can reach an agreement. It is past time for the president to get serious.
Okay, we're rolling over.
Meantime, the tape now has a statement or a quote from a White House official saying if both sides negotiate in good faith, they recognize they won't get everything they want. A deal is still possible. It's funny. A political cynic would say, after yesterday's protestations from the Freedom Congress, you kind of want to show that you're tough. You're walking out, even though you might still be on track for something.
As a market participant, though, where there's a risk of a technical default in under 2 weeks, you wonder what to do with that. Look, overall, market's higher for the week, and the broader theme of the week has been McCarthy and Biden being positive on negotiation. And if only they can handle it, we got to wait till he comes back from Japan. He's still in Japan at G7.
Right. Meantime, next week we will get durables and some personal spending. We'll try to put some macro data on top of what we heard from.
A lot of retail earnings as well. Yeah. And a lot of folks are worried about the retail earnings after Foot Locker because we heard from some of the stalwarts, the ones that have consumer staples exposure, like a Walmart and a Target this week. What happens next week?
Let's get to the judge.
Appreciate it, Carl. Thank you. Welcome to the halftime report. I'm Scott Wapner, front and center this hour. This midday move in stocks as the debt ceiling duel appears to take a bit of a negative turn. We're watching that along, of course, with the Fed chair who just finished.
Okay, looking for a higher low to print here and a higher high.
Steve Weiss, Bill Baruchas with us today, and our senior economics reporter, Steve Leisman.
All right, Meta with a bounce.
So, Brent, we're watching 4,200 very closely on the S&P 500, which we gave up on those headlines about the debt ceiling.
Meta buyers at the low of the day. I just don't see the risk reward as good as it was Wednesday and Thursday.
Yeah, well, I think all eyes really are not on the S&P, but on the NASDAQ. So the further away you are from AI and AI derivatives, the worse your performance is. So, the NASDAQ just broke out the past couple of days. It's August 2022 levels. And so it has broken above, but it's extremely overbought. And so, we've talked about this a lot, the extreme narrowness of the market. I think some of it's warranted. I do believe that this seismic AI shift is real. We all see it. Unlike cryptocurrency, which we couldn't really understand, we see this, know how to use it. It's going to generate real efficiencies. That being said, I do think it's too fast. And so I think for my positions, I would like to put on some calls, some hedges, especially in these names that have run so fast, so hard. And I think that the cherry on the Sunday will be next week when NVIDIA comes out.
Low tick alert minus 800.
Sprinkle in a Sunday debt ceiling hike. I'm not surprised the market's is going to go into Friday weaker just because of the huge run we've had on top of, once again, the nonsense of politics.
Looking for a higher low.
Yeah, but we weren't weaker. Steve Weiss, Apple, Alphabet, Meta hitting new 52-week highs. Stocks are coming off their highest close of the year. We're nicely above 4,200 before we got the headlines from Kayla about the debt ceiling talks breaking off for the moment. So how do we see all this now on a Friday morning or mid-afternoon?
Well, first of all, I think Britt puts it perfectly, is that if you're not in the NASDAQ, you're not in those few stocks, then your performance is not doing particularly well. NASDAQ's coming off basically a month of great performance, and it's been narrow. So selfishly, I'd like to see us go right up to the wire on the debt talks, the debt limit talks, because then the market will really trade down and I'll get a chance to buy some more stocks that perhaps I've missed. I don't think we're going to default. But you take what the interview that was just with the CEO of Foot Locker, and you see it's really two worlds. The luxury area continues to do well, right? That's an impregnable category of consumer, but yet everything underneath, including not just those that live paycheck to paycheck, which is most of the country, but also the middle class starting to feel the pressure. We've heard that constantly. We looked at Deere earnings today. The stock traded up 4%, and then it went negative as they talked about the back half of the quarter, down next quarter for earnings, and then believing we're going to be better. And Deere is well positioned because they've got lots of new products. They're reinventing farming. So the point of it is that the weakness is there. It's been delayed a little bit because we've had free money for so long. But I'm more on the fence talking to people, some of the same people you talk to that are there, that were not just Steve Cohen, who you had mentioned, Wednesday was on the show, his comments. But, I think the bait everybody's going for is, okay, is my weight, should I be impatient? Should I throw the towel in on bearishness, right? And say this is going to be, this is another bull market, or is the delay in the impact of the Fed, just extended versus prior cycles? I don't know right now, Scott. So how that's coming out. So I'll continue to pick up, equities where I'm getting paid to pick them up, meaning that they're so dislocated. Deere may in fact be one of those. When it, if it comes down some more, or even right here. I sold the stock at about 410. It was a great sale. I sold Microsoft at
SPY trying to make a higher low right now. Keep an eye on your favorite stocks. If we do get a higher low and higher high, we could see some of these follow through, like ServiceNow.
decision put in front of me, which is real fear, as I said, as I started, over the debt ceiling, and then I know I can get in. Right now, it's sort of like, 6 1/2 dozen.
Leisman, if not for these debt ceiling talk headlines, I wonder what the market would be doing based on what the Fed chair had to say, because he certainly seemed to not be on the same page necessarily with the Bullards or Logans of the world, whom we've heard from earlier this week. If anything, he sort of leaned, I feel, a little bit dovish.
I like your analysis, Scott, because I was also just trying to bear down into the tick of the market to see if the downdraft came as a result of the walkout on the debt talks, or if it came in response to what Powell said. Powell started off a little bit on the hawkish side, mentioning inflation, not the banking stuff, but he kind of cured that later on, and he took a firm stance in the middle, if you will, where he said, like, we've not made any decisions. And I'll just give you some of the headlines that I heard from Powell, where he said tighter credit conditions could ease the pressure to raise rates. That's something he said before, but in the context of what's been said by other Fed officials the last couple of days, was a direct shot at them and a more sort of dovish solve to the market than what they've been hearing. He also said the stance of policy is restrictive, and we face uncertainty about the lagged effects of tightening. And he went on to say the risks of doing too much or too little are becoming more balanced. And you'll remember, Scott, that was something that had not been the case for many, many months, where he kept saying the risk of doing too little is worse. And what's happened as a result is that the odds of a June rate hike, which had become elevated as a result of comments made by Logan, Bullard, and Bowman the week before, they had gone up to as high as 40%, where you might have argued the pause is in peril. And now you can say the pause is back in play. Right now it's down to 14%. So, and I just want to emphasize, Powell at that point was reading from what seemed to be a prepared remark. So what he said he meant to say, and it sounded to me like it was a direct kind of redirect, Scott, of the market back into the middle from the tendency that had been going on. Which is
Looking for a higher low to print here.
You make a good point too, reading from
Give it a couple more minutes. If we break above 419.25, that'll be our higher high. We'll confirm this higher low.
Algos don't necessarily listen all that well to the nuance of a Fed chair who may not be in step-by-step agreement with Fed speakers of earlier in the week. Yeah, the Fed has to be a surgeon here, and that's really, what you're saying. You're getting the headline reaction. I think more in the debt ceiling, as you and Steve Leisman acknowledged. But we've heard from the Logan, we've heard from Bullards that they are more hawkish, and they're playing this Jekyll and Hyde sort of narrative. They can't let the algos, they can't let the managers really lean to one side on the position because of the market. They call it the market's reaction function. So they're very, very careful right here to talk about it. Maybe they pause. I don't think they hike, although earlier in the week I thought the odds were a little too low. So getting up there to 20 to 40%, become a little more balanced and put the market on its back foot. But you can't ignore what's really kind of going on within the market itself, and Bryn acknowledged that it's the NASDAQ. Tech is running. We've seen the narrative shift away from the Fed more so, and there's other tailwinds that are there. Earnings have been solid. You look out at some of the tech companies; they're being priced at 2024 now. It's not about right here, right now. The capitulation took place last year. We're in a bull market, and I penned a note to clients to start the month. By in May, this bull market is here to stay, and I think that is really what you got to look at, because at the end of the day, the Fed's goal was to bring down inflation, and the Cleveland Fed inflation nowcast for May is 4.16 right now, headline. So we're coming down, and it's going to improve. There'll be a 3 handle through the summer. Steve Leisman, do any of these remarks today around credit issues and the bank and the outlook for where rates may have to go or not, the fact that the Fed chair said what he did today about the policy rate might...
I'm just sitting here watching. There's really not much to do. Markets are not moving. Yesterday we had just about everything was moving. So when I say just about everything, the FANG stocks, all the FANG stocks were firing except for maybe Meta until later in the evening. So that was a pretty clear sign. Today, everything's flat. So that's telling you to just chill. Don't give money back. You had nice gains this week. Let's not give any back. Could roll over here and test some of the lows, test some of the range that we put in. We know that 420 is a major level, the call wall.
Say you were to raise the interest rate on a loan from 6 to 7%, then you would have a predictable decline in lending. When it goes nonlinear, lending could crash in the result of higher credit standards and stuff like that. That's what policymakers worry about. So Powell seems to...
Here's the NASDAQ. NASDAQ 100. 13,800. 13,900. And 14,000. So there's 100 points between each. The Qs
would necessarily balk at a rate hike in June if the data were to accelerate again. But if you get
with 340 as the high,
discussed from the CPI numbers and the inflation numbers coming up, pause will be back in play.
Yeah, I mean, maybe it just means that the meeting's going to be more live, so to speak, than maybe
340, 335. We're currently trading right at 336. Here's 338 just overhead. So if we get above 338 on the Qs, look for 340. Stocks are just not doing anything at the moment. Momentum stocks like ServiceNow haven't followed through.
Stocks, and I know it's so early in the game, but growth has just pushed past value from such a tremendous degree of late.
Yeah, I agree that it's a bubble in terms of what it's done to a lot of stocks, but I also agree that it's here to stay, and that I do buy into it being an industrial revolution, the fifth one. So, I think it would be positioned. Look, I didn't have time to talk to Patty before the show, our esteemed supervising producer, but I did nibble on Microsoft. And the reason I did Microsoft, I hate the multiple, right? But I want to get involved, and it's very, very small. But I'm comfortable owning it because it's a perennial compounder. And when I buy stocks, I look for perennial compounders rather than a moment in time. So, look, I sort of hope I'm too early in terms of an impending market correction that I could really size up on. As I said earlier, horrible decision selling at 250 after I owned it for so long. So AI is here to stay. However, you know, I meet with so many private companies, and all of a sudden, everybody's got an AI approach. It's not going to work for all of them. As I said months ago, 90% of companies that say AI, and it's nothing new, have nothing to do with AI.
No, well, it's why the pure players are the ones who are out distancing themselves, at least initially.
Like an NVIDIA.
Here's the S&P.
Tenders, but the ones who are seemingly
Nick, here's the S&P.
to mention AI being a part of
4,200's major level.
stimulator for their growth.
Exactly. And, you know, I can't tell you how many meetings I've been in where people talk about NVIDIA. They don't talk about anybody else except NVIDIA and their chips. So I keep asking myself,
SPY. No follow through. Q's, no follow through.
with the local Microsoft, I just can't bring myself. You don't know how much I'm hoping, no offense, Bryn, no offense to anybody else who owns it, hoping that they really miss the quarter, that they really miss it. And I get it.
But what are the chances of that happening?
Not a lot. Not a lot. You'll see it in their data center business. You'll see it in their other business, their gaming business, in other areas. You won't see it in the chips, but the chips are not the biggest part of the business right now. AI chips. So that's my hope. Could be wrong. Not going to buy it if they don't miss. So
Yeah.
that's my only hope.
I mean, and this doesn't justify in any way whether their valuation, we're talking about NVIDIA, of course, at this moment, because it's doubled this year, along with Meta. But
SPY
its valuation
hanging
is
on.
the highest of this core.
I could see a test lower first and then a run back up to 420.
It's for you to say, not me. You know, it has run a lot. And I've been on the show over the last couple
Just watching the FANG stocks, that the top 5 FANG stocks. Microsoft is dipping a little bit more, Apple dipping. So I wouldn't be surprised to see SPY dip a bit more. AMD is starting to move a bit. AMD is starting to move.
to the user, it's going to be there. And NVIDIA is by far the leader. Their software suite is just knocks everything else out of the water. I think, will raise guidance. I think there's going to be a lot of positive tailwinds behind the report. Bryn, what about you? You own it.
Yeah, well, so I think we all have to understand also is these other big companies have all been working on their own chips. I know Microsoft and Amazon are absolutely working on their AI chips. And so I think
AMD looking better.
NVIDIA is clearly in the pole position.
Still a flat VWAP. If this starts to move above 106.50, maybe a play there. SPY just flat at this level.
Google is an advertising company. Please don't forget that. And so to me, ultimately, embedding their BARD and their system and their ecosystem actually would make me want to search less because I can just go straight to the answer. I'm sure they'll figure out how to monetize it, but to me, it's not so clear. With Microsoft, it's crystal clear because Copilot, which they're going to launch inside of all of their offices.
AMD looks like it wants to go here, AMD.
Inside of Azure, it's going to make them so much more efficient. And as an Outlook user, we're just going to see that in our daily lives. So I think that even though Microsoft has had a really nice run this year, I think the ability to turn that into profits for Microsoft, I think is a very high probability, and I think they will turn that on sooner than later. So I would still say along Microsoft, and although it's run, I definitely don't. I think it's the early innings of them being able to monetize it, especially when they come out with their own chips, which will be enough.
All right, SPY starting to bounce.
Tried, Steve, to write off Alphabet, I think rather quickly. No, you know, they took comments from the CEO on 60 Minutes along with the announcement from Microsoft about ChatGPT to assume, or at least to make the investable leap that somehow that Alphabet missed the boat and that they were going to have to play such a tough game of catch up when Alphabet's stock year to date has outpaced Microsoft. Yeah, it's at 39%. Now, they've all had great years thus far, but it's not like Alphabet hasn't been rewarded for any of this at all.
No, that's true. Part of it was was that it was so oversold and it's got the lowest multiple of all of them. So people say, let me go there, and they got there in a hurry. And there's some good news on Alphabet today, which is that Samsung is not going to replace them, not considering replacing them with Bing anymore. So that's not actually the stock price today, but think about that. That was a real threat. Now, just to follow up with what Bryn said, look, exactly. And I don't think that being $1 trillion market for AI, which could be, right? Who cares if it's a 300 billion or $1 trillion? That's still got lots of growth. You're dealing with very well subsidized competitors that it's in their interest not to cede the market entirely to NVIDIA. And at 70 times, it's like they're the only player in the market. So others come on. In terms of Microsoft, one of the things I love about, always love about, it's recurring revenue, right? They've got their subscription model that was put in after Ballmer left. It was always a subscription model, but even more so. Think about that. They can go out by putting AI, ChatGPT in there, which is now their official partner.
All right, watch service now.
Recreate their whole office suite, so people got to re-up. So that's why I love that. That's why it deserves the multiple that it has now, and why NVIDIA, I don't believe, will keep their multiple going forward. So we're in early stages, but nobody's going to say, okay, we're going to allow NVIDIA to continue to charge premium pricing. It's up to us to create more capacity so that pricing comes down, and that will impact their years.
Do you feel like, Bill, we're in any kind of like Wolf Technicals today? They say this is the final stage of a blow off top in the NDX. The NASDAQ 100, which I mentioned, is up 4 weeks in a row. Yeah. And the stocks within it have been, especially if you're related to AI, you've been off to the races. I think this is the middle innings of the AI push. I think we've had. Are you talking about stock performance? Yes, stock performance and where we can go from here. I think we're in the middle. That doesn't mean NVIDIA is going to be the leader going forward. I think that from a stock performance standpoint, how can we be even? I mean, that middle innings. Well, we just started getting our arms around this whole thing. 20 billion AI 6 months ago. They've only invested about 20 billion market. Total market of AI. There's a lot of room to grow here, but you're now seeing a lot of the other stocks start to break out of technical patterns. I mean, but there's also it's not because of technicals, it's because of the tailwind. So I'm talking about AI in general right now, and I think we're in the middle innings there. But you also have the early innings. I think where I would argue with you, how can we be in the middle innings? We just started. I think middle innings of price. Middle innings of price of where these stocks can go from here. But if you take a step back and you look at it, it's not just the AI tailwinds. I mean, you look back to where this market was last year, the capitulation, the negativity, the people, the managers positioned off sides that now some have to chase. And I think there's money that can still come into the market, and there's very, very constructive. I think the fundamentals right now, although you could say that there's slowing consumer, I think the fundamentals can continue to be a tailwind. So I think there's a lot of reasons to look for this market to continue to gravitate higher. Doesn't mean we can't have a pullback from time to time, but I think we're looking at this is finally breaking the range, and there's a lot of room for that. What, if anything, breaks these stocks? Is it more Fed tightening than the market expects? I mean, that's part of what Harvey or Wells Fargo is talking about. You just look at 99 to 2000, sort of what breaks that, what broke it, you get Fed tightening. Right. And obviously rates go up, and just the
All right, Netflix looks like it wants to do something.
I don't care really kind of where you are in the market goes down.
Right. What breaks it is what broke here today, being up 4%, being marginally down or flat, which is that, we just put up a great quarter.
Still a flat VWAP though on many stocks.
Next quarter, and we're optimistic about the rest of the year.
I know, but are you telling me that a Microsoft or an Apple or a NVIDIA or a Meta are going to say we see softening demand?
Right. So it's the only parts a little bit about what you said. In terms of the market has broken for the majority of stocks, right? They're still down, half or down year to date, right? So you're talking about this very narrow advance. So if the narrow advance has defined the market, talk about where NASDAQ is, it's narrow advance. So what breaks them? I don't see anything breaking them. They've already reported earnings, right? Nobody's going to give up on them. We've got this whole new, era and generation of investor that's going to stay with it, who's saying, I'm retiring in 35 years. What's the difference if they go down 10, 20, or 30%? They're going to recover as they did from the pandemic, from the great financial crisis, etc. So I think those are safe because that's what this generation of investors understands and gravitates to. They don't understand the deers and the others.
All right, so let's go through some moves that you guys have made. You already talked about Microsoft.
Watch Netflix here. Maybe get something going. Netflix.
Yes, Bill. Yes. Why? Very tactical play. In a technical basis, it's breaking out, but they got a 7% free cash flow yield. They have a multiple under 20. And there was something very vitally took place on Wednesday evening was Synopsys reported earnings. Now, Synopsys does the electronic chip design or electronic design automation. I think that was a big tailwind to a lot of the chips, some of the Japanese news, and Micron as well. But there is so much good news surrounding the semiconductor space, and Synopsys, I think, was a catalyst for other semiconductors to now have that tailwind. And Broadcom is certainly one of them. Okay, Brandon, you bought more Tesla. Why'd you do that?
Yeah, so, I like to play Tesla. I like to hedge the position. So the stock has been basing out and bouncing around the 170s. And so to me, it looked like it was going to start to break out. So I bought it at 172, but I sold the September 190 calls and I got $14. So that's an 8% yield for 4 months out. So my total return, if I'm capped out, if it gets called away, is 20% in 4 months. But if I'm wrong, let's say Tesla's weak, I have that $14 that I just collected. And so I think it's a really nice entry point where I can get some upside. And I've used the source of funds was PayPal, which I sold because I don't think it's going to participate if this market continues to run.
Gotcha. All right, let's step away for a couple of minutes, take our first break. Up next, goodbye, Gorman, Morgan Stanley CEO Jim Gorman, announcing his plans to step down. We'll lay out what's next for the big bank and its investors. Halftime's back in 2.
All right, still watching for buy signals. Market's still very flat. It'll be very obvious when these start to trigger. Meta's on a buy, but the 15, 30, and 60 are still red. AMD is trying to go, but the indices are not cooperating as much as we would like to see. AMD is trying to punch through this area. Markets are having more impact, though. The markets are not moving. Apple and Microsoft are basically flat, so that's 13% of the weight of the S&P. Like to see those pushing higher along with NVIDIA, AMD, Netflix, Meta, Google, etc. You can feel the market is a definite different sentiment today. You can't feel you can feel that there's no follow through. There's a lot of blocks, but we haven't gone anywhere. We got 1,450,000 share block on the IWM a couple of minutes ago. Meta is straining to get through VWAP right here. Meta. It could go. Meta could go.
He'll assume the role of executive chairman. Our Leslie Picker joins us now with more on this and how we should think about as CEO. Leslie?
Yeah, his legacy is a pretty instrumental one in kind of changing the strategic makeup of Morgan Stanley. He oversaw several mergers, which increased the prominence of wealth management and investment management, outperformed his peers over the time frame, over the 13 years that he was CEO. And this 12-month time frame, it's been pretty well telegraphed that he did have plans to step down. I think it was
This
last
stream
year
is
where he said
sponsored
he'd
by
step
Take
down,
Strike.
within
Strike
the
allow.
next 5 years or so. And those who were in contention for that top spot also pretty well telegraphed over the past year or so. And so I think from here, it really just now centers on this idea of who it will be and when. He turns 65.
Keep an eye on AMD.
But we should have some sense, over the next 12 months, as you mentioned.
We've seen some of the, chatter around the names that we're showing on the
NVIDIA, AMD doing well. The chips doing well this week.
might be, the favorite, if you will. And, one thing that's so interesting is that, Gorman really leaned into the wealth management side of Morgan Stanley. And, the results from a share price are noticeable. So too are the way that other firms are reacting to their own businesses, because they've seen the success road as it relates to wealth management that James Gorman, drove.
One of the analysts said that wealth management actually comprises about 2/3 of Morgan Stanley's market cap at that time. They've driven higher returns as a result of just building up this business. So you've got an Andy Saperstein, for example. He runs well. He's one of the three gentlemen.
Meta trying to push through VWAP and head higher. The markets are not helping, though.
Be the leading candidate, given just the growth of wealth. But then you have KBW, on the other hand, who says
All right, SPY rolling over.
more likely choice because he runs the institutional group, which is sales and trading, investment banking, and so forth. And he's really credited with turning around their big trading business. And so he's seen kind of more as that turnaround candidate in the sales and trading, investment banking side of things.
Yeah, Leslie, good stuff. Thank you. That's Leslie Picker joining us. We'll continue to game it out, no doubt, over the months ahead, of course. You own, yes, of the three on the show today, you're the only one who owns Morgan Stanley. Yeah, what do you think? It's our only financial exposure, moved away from the banks, especially regional banks at the end of last year. More worried about the lending side of it. I think this is very prepared. It's like the Green Bay Packers handing the reins to Aaron Rodgers from
Low tick alert -800.
All right, so no follow through.
Saperstein are going to be likely the two, but 50% of the revenues come from wealth management. Do they want now take Saperstein in order to, maybe spread him thin, maybe pitch the leading candidate? But I'm not worried either way as a shareholder. I'm sorry? Do you care either way as a shareholder? You know what? I don't. I like the direction of the company. Gorman's put them, at 13 years at the helm, has put them in a great spot. They've separated from Goldman Sachs.
Everything reversing now.
First of all, I love a guy that says he's not going out like
yesterday. I really felt we were at a location where I could see the path.
Look, he's done an amazing job. If you remember, and I remember it because I was one of the doubters early on, can he do this? Can he transition the company? And he did it phenomenally well. It's a stock I look at. All three candidates, I don't know them personally. I do know them from other people. They are very highly qualified. Either can do it. Saperstein, given the direction to the company, may be the lead in it because it's a wealth management business, recurring revenue, but banking as well also. However, my touch points are greatest with Goldman. That's why I love it, because those touch points, I've never been disappointed. So that's what I'll stay with, and that's enough.
Gorman probably was throwing darts at your picture in his office in the early days. I remember that.
Yeah.
I remember that. But they really, the lean in on wealth management was a game changer for them, and certainly from a stock performance standpoint.
I mean, he executed, and I turned early on it, but just phenomenal execution. Just what a job. Think about the culture he had to change with Morgan Stanley, and he successfully did it. And think about, because I've had to manage these type of people, you're managing high-performing superstars who are highly independent, and he got them in line and built a great business.
All right, coming up, we'll do our call of the day. It's an energy stock, just got named the top pick at one Wall Street firm. It's down 20% this year. Brent owns it, which means we'll debate it. We'll do it next.
All right, so we're right back down to 417.50. AMD holding up very well.
House Speaker McCarthy, when asked about the debt ceiling talks pause, says we've got to get movement from the White House and we don't have any movement yet.
Low tick alert minus 800.
All right, we're hanging here at 417.50 SPY. Most stocks have pulled back, looking for a bounce that may not come, watching NVIDIA holding up fairly well. VIX is climbing. That's going to put some pressure on SPY. All right, shorts covering, looking for a bear flag.
Between the two superpowers hit a historic high of $760 billion last year. Hyundai and Kia have agreed to pay $200 million to settle a consumer class action lawsuit following a TikTok challenge that exposed just how vulnerable those cars are to being stolen. The settlement covers about 9 million U.S. owners, and the majority of the money, as much as $145 million, will go to people whose cars were actually stolen or damaged in attempted theft. Target has recalled millions of candles because of a burn and cut risk. The recall covers nearly 5 million threshold branded glass jar candles sold in multiple sizes and in various scents. We're just going to show you the logo, not the actual candle. Target received 137 reports of the jars breaking.
Okay, more shorts covering, double bottom potentially. Ah, that's why Devon's up. Okay.
Sure do. So I think it was a great report. I think the backdrop, well, the report really tried to discern the difference within that there's going to be security selection, not just broad movement within the space, which I agree. I think the overarching hang on these names is going into late cycle. People are worried about a recession. You know, WTI's in the 70s. And so what do? You sell energy. So that playbook is just like playing out kind of textbook. I think what investors are missing, though, is that especially in the next few months, as inflation comes down, the soft landing drumbeats get louder. I think the one area that's really mispriced is oil. Devon has leadership. They've got a great bench. You know, they're
All right, more shorts covering.
they increased their share buyback by 50%.
All right, I'm going to make something for lunch. I'll be right back.
Variable. I do think some investors were disappointed they actually did more buybacks versus pushing that through to shareholders. But the way I would have been playing it is I continue to sell calls. So even though I'm down on the name year to date, I've actually earned 9% in call premium. So for investors wanting to play it right now, I think a good trade would be buy Devon. It's around 49. You could sell the September 55 calls, collect about $2 of premium. That gives you, between capital appreciation, a dividend payment, and the option, around a 16% upside.
Okay, watching NVIDIA and AMD.
And make money from there. But I definitely think the energy sector as a whole is the one mispriced area in the market.
All right, yeah, others think that too. And broadly speaking about energy from a technical standpoint, I mean, Mark Newton of Fundstrat was on Closing Bell with me the other day and made the argument that it was ready for a breakout. But you've got Chevron, Cheniere, Marathon, Pioneer, SLB. Why no Devon? And what about the proposed breakout in this space? Well, I love Newton's work, and I think that he's right. I think we've had some capitulation that took place in the market. Now he's inviting people to come back in. So look at the revenue growth. It's down year over year in names like Chevron and Pioneer, really across the board. But really, it's also looking back at the second half of this year and looking farther out. The IEA came out and said that demand is going to outstrip supply in the second half of the year by 2 million barrels per day. The OPEC Plus is fighting that. They want to keep oil buoyant. There is the question of China coming back online or not. There's a lot of pessimism right now on China. So it means we only need less growth from China in the second half of the year to actually have an impact. So Pioneer's my play in exploration. They're in the Permian. They have less investment to make because of where they are right now and not have to worry about offshore. All right, coming up, we'll do our chart of the day. It's Deere giving back early gains following earnings. Farmer Jim owns that. He phones in with the reaction to a very interesting, and there it is, intraday move in that stock. Higher nicely, now lower by 2%. He'll phone in next.
According to the White House, both sides in the debt talks won't get everything.
our chart of the day now. It's Deere giving up early gains following earnings. Seema Modi joins us now to tell us exactly what happened. Seema?
Scott, we saw the stocks pop on a strong earnings beat, but the minute executives referenced higher than expected inventory levels on the conference call, we did see shares start to decline. UBS analyst Stephen Fisher says those comments were interpreted as cautious because Deere has previously said that without any qualifiers, they want to rebuild inventory levels. Now that messaging is starting to change. Deere did, of course, add that farmer demand, though, remains strong, no signs of a pullback. But the other concern is that prices of large equipment is expected to moderate in the third and fourth quarter. So that's raising concerns about margins in the long term. Scott?
Yeah. All right. Thanks for the setup, Seema Modi. All right. Farmer Jim Lebenthal joins us now on the phone. And I gather you were feeling pretty good 4 hours ago. Maybe not so much now.
Hey, Scott. It's good to be on with you. Let's talk to your short term and long term. Short term, today's movement, I can't explain it. I mean, Seema did a very good job just there because it did happen as soon as comments were being made on the conference call. I have to say that's completely irrelevant to what the long-term thesis is here, which is basically that there's going to be geographical changes in large size and where plantings
House Speaker McCarthy says the lack of movement by the White House is the reason for the pause.
New ag equipment is going to have precision farming capabilities with it, which will generate subscription revenue. The long-term aspect of this company is very much intact. And frankly, going back to the short term for a second, this was a blowout earnings number. I mean, they beat on everything. They raised guidance above where estimates are right now. So you're going to see estimates continue to go up as they have all year. Fundamentally, this is in extraordinarily good shape. I want to say one more thing, Scott. This is very reminiscent of you and I talking about Cisco yesterday. I don't know if you remember that, but 28 hours ago, Cisco Systems, after its earnings report, was 8% lower than it is right now. What I'm trying to drive at here is the short-term noise around earnings report is not something to pay attention to when the fundamentals are as intact as they are at Deere.
I know, but I feel like that's almost like saying, well, in the long term, stocks always go up, so who cares about the near term and the fundamental issues that may be taking place in the economy as it relates to demand and where pricing was able to go at one point, which meant your margins were able to be higher, and that sort of evaporated. I mean, that's real.
Yeah, no, I disagree, Scott. The fundamentals at Deere are extraordinarily intact. That's why they raised their guidance for this year above where estimates are. So if Deere was willing to be traded at 11.5 times this year's earnings last night, after the report today, that's a lower multiple, which means the stock should be higher. What you're seeing today is short-term noise. It's not the long-term fundamentals, which are very much intact.
Okay, let's take today out of it. Okay, stock's down 2%. Yep. It's down 14% year to date. So why, if the story's so great, why is the stock so bad?
Because every stock except for the 7 bang names are down this year. Down or flat. That's no reflection on Deere's fundamentals at all. This is a market where the breadth has narrowed incredibly.
Hello.
Everything is being sold and thrown into NVIDIA, Microsoft, Apple,
Hi.
etc.
Good, thank
that
you.
will last until it doesn't. And in turn, people will look at companies where the fundamentals are strongly intact as it's Deere, and they will say this is a holding for the long run. I don't think, by the way, Scott, this is something that let me be clear. You don't have to hold your nose to buy or hold Deere here. That's not what's going on. This company is great.
I hear you. I appreciate you calling in too. It's been a really interesting session for it. And I'm sure you had to, sort of, I don't know, just adjust the way you might be thinking about it from what looked great in the morning and what's not so great at, 12:47 on the East Coast. Jimmy, thank you. Have a good weekend. That's Jimmy.
Scott, just really think about what happened with Cisco in the last 28 hours. I'll close there.
Okay, good stuff. Jim, thanks. Santoli's next with his midday word.
that's fine. You have anything later in the day? Like 3:30. Yeah, I know it is. Thank you. Bye-bye.
At 1 p.m. Eastern Time, we get the weekly US Baker Hughes data, total rig count prior 731, and the oil rig count prior 586.
This stream is sponsored by To The Tick. Get free daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
We're back to you, markets commentator Mike Santoli joining us.
I'm just watching the markets. We're not really seeing a lot of momentum, so I'm not jumping on things. I'll just keep giving you the play-by-play.
We got this column. It's going to be hard to shake. I think everybody knows that the incentives are there to kind of sound like there's nothing going to happen, even if it's going to happen. But you also have, coming into today, the leadership part of this market, the NASDAQ 100, running really hot. So overbought, S&P exactly at the top end of the range, expiration Friday, everything coming together, yields waking up for, hey, isn't this a logical place for us to pause?
All right, we need to break through this area. If we can see SPY push a bit higher. That would be great.
That's more interesting than the fact that it looked like you took some of the edge off the buying in the morning. It's a rather muted pause, too. I mean, it's not some, great pullback, and who knows, there could be a...
AMD making higher lows as well. Watch AMD.
I'm not convinced that's, necessarily you declare victory if that happens. No, I'm not saying you declare victory anyway at this point. Exactly. There's no all clears in this business. Yeah. But I do think it's interesting that we traded down seemingly on also Powell saying, well, rates might not have to go as high because we still might have some credit issues. I mean, the Fed runs the senior loan officer survey. If he's not going to at least listen to the message that there was a little more tightening of credit in that measure and just at least give lip service to it, I don't think there's that much surprise in that. And so you still have, a pause in play, even if it's a live meeting in June.
I don't know. They don't apparently listen to their own staff who is saying there's going to be a recession. So
yeah, I mean, look, they have a Q staff, which is probably saying many different things at once.
I hear you. All right, good. All right. Yeah. We'll give them a pass. All right, I'll see you in a few. Mike Santoli joins us again, of course, on Closing Bell. We have more moves from Britain coming up, plus final trades next.
Okay, we're starting to break through areas which would indicate that we could see a follow-through. Netflix still below VWAP, but looking better. SPY looking better.
at 1 p.m. Eastern Time, we get the weekly US Baker Hughes data, total rig count prior 731, and oil rig count prior 586.
Follow the Halftime Podcast now.
All right, so a little bit of profit taking here, no follow through. Not like yesterday. Yesterday, when we got the bounce, we just continued to see constant, persistent buying. We're not seeing that today. So it's just markets are exhausted. So I don't think you should go into today assuming that it's going to be anything like Wednesday or Thursday.
We got a big closing bell coming up on this Friday, 3 o'clock Eastern Time. Former Fed Vice Chair Rich Clarida joins me. What does he think about what Chair Powell said today and what the real road ahead is for interest rates? We'll ask him, of course. Goldman's Tony Pasquarello joins as well, get his latest take on the markets as we're seeing if we can get that close and get above 4,200. That's going to be interesting. Rockefeller's Avery Sheffield as well. So we'll have a good show for you in a couple hours' time. Hope you join me then. Brandon, you have a couple moves that we didn't get to. You bought more AbbVie. Talk to me.
Yeah, so after the earnings earlier this month, the stock has really sold off hard after investors' concerns around the biosimilars around Humira. That is well priced into the name here. And so we look at the chart technically, because I really want to match technicals to fundamentals. 143, 145 is really strong support for AbbVie. So I took the opportunity to add more. And I think what investors need to realize is that the biosimilars around Humira, I think is priced in. You've got Skyrizi and Rinvoq are going to be huge drugs. They also have their aesthetics business that we would know around Botox, etc. And so I think you have a company
Shortly
that's
expecting the
oversold,
US
great
Baker Hughes
fundamentals,
data, I'll
solid
lead with the
technicals,
total rig count.
7.6% free cash flow yield, 4% dividend.
Right.
And then I sold January 160 calls.
You sold BJ's as well. You got to be quick on that, though.
No, I just use that as a source of funds.
Oh,
So
gotcha.
to buy the AbbVie.
What's your final trade?
XOP, Go Long Energy.
Okay, thank you. Bill Baruch, what you got? Synopsis, Eaton Rays, EDA leader, signed all the chips. All right. Stock's not doing too much on that. Microsoft.
Yeah, I just bought it, gave all the reasons, so that's the freshest trade I have.
So we're going to go on the weekend. I don't know, a little uncertain about where the debt ceiling talks go, whether this is simply posturing. We'll see what other headlines may come between now and closing bell. Watching that 4,200 level as well. Stocks had the highest close of the year yesterday. Can we get back to that level over the next few hours? we'll see, and I'll see you on closing bell, the exchanges now.
Welcome to the exchange. I'm John Ford in for Kelly Evans, and here is what's ahead. Existential threat and a big opportunity all at once. That's how one of our guests describes AI's impact on the cloud companies. He brings two names that he sees getting it right and one most at risk. Plus, tech has been on a tear. A handful of mega cap names propping up the whole market. But for how much longer? Chartmaster Carter Worth says it is time to trim. He joins us ahead. And markets taking a leg lower on reports that debt ceiling talks have stalled. This as the president attends the G7 in Japan, and one of our guests.
All right, looking for a follow through.
Not just for the U.S., but for U.S. allies.
Not much momentum in the markets. Got a lot of blocks.
And we slowed some momentum down because of some of those headlines that we went out with regard to the debt ceiling and everything else, John. So right now it's right across the screen, but just fractionally. So we went from fractional gains earlier in the session to these fractional losses that you're seeing now. The Dow Industrial is down about 0.25%, 75 points lower, 33,458. The S&P 500 is now pushing 4,200, and it got above there at one point today, but now back below that mark, down about 6 points, or about close to 2/10 of 1% there. Now, just to kind of put some context again, highs, we were up about 14 points, at lows down 18. So trying to find the middle of that trading range right now. The Nasdaq Composite, the underperformance,
720, 720. Oil rig 575, 575.
The headlines around the debt ceiling and lawmakers on the Republican side of things walking out saying that the president is being unreasonable with some of their demands. That particular set of headlines did drive some downside to the markets overall, but also we saw a drop in some certain parts.
This stream is sponsored by TickStrike. TickStrike allows you to actually hear order flow futures, forex, and stock instruments. Get a free trial at tickstrike.com.
Given what we've seen, there are concerns about the economy, what could happen, maybe at least shorter term for U.S. tech. Watching that. And by the way, those moves and those same headlines triggered a reversal and a sharper sell-off intraday in regional bank stocks. Now, they've had a pretty big bounce off the lows over the course of the last week or so. And because of that, we saw some profit taking. But as you can see, just around there, when some of the headlines around the Fed, Jay Powell's comments at a monetary policy conference, as well as some of those debt ceiling headlines, drove downside for the regional bank trade. We'll continue to watch that. This ETF is down about 2.25%. And then the stock of the day is a big drop, and I do mean big, in shares of footwear and athletic apparel retailer Foot Locker, which is down 26% right now. This after coming and reporting earnings and revenues that missed analyst estimates up to a cut to their full-year forecast across several metrics. The company saying that they've had
Service now moving.
Unknown caller. So Foot Locker shares very much in focus, down 26%. John, I will send things.
Hello.
Don Banks, a stumble for Foot Locker.
Yes.
And as Don mentioned, stocks taking a big leg lower on the news. Republicans are both putting pause on debt limit talks. Just yesterday, both Congress and the White House had struck optimistic tones about reaching a deal. Also in D.C. today, Fed Chair Powell sitting down with former Chair Ben Bernanke to discuss the economy, saying he has not yet made any decisions about whether rates are, quote, sufficiently restrictive. Kayla Townshee is covering the latest on the debt ceiling showdown, while Steve Leisman has more on what's next for rate hikes. Kayla, let's start with you. Is this a fundamental difference, you think, in what's happening with these debt ceiling negotiations, or just a continuation of posturing? I mean, it looked like this was going to be hard to do. Is it just still hard, or is it getting harder?
It is still hard, and perhaps this was always bound to happen, John. Negotiations over the debt ceiling reaching this impasse today after days of momentum that led Republicans, Democrats, and even the Treasury Secretary to praise the positive path emerging toward a deal. But now they're getting down to the really tough substance and down to the details, and that's led talks to be off until further notice. Here's Congressman Garrett Graves, who was appointed by Speaker Kevin McCarthy to represent Republicans. Here's Graves speaking earlier today.
Because the last
He's talked about
House passed a strong bill, but it had rate savings in it. It's responsible and it puts us on a path to get this heard. Some people are willing to have reasonable conversations about how you can actually move forward and do the right thing. We're not even sitting here to talk to ourselves.
So he's saying the House already passed a bill. Now the White House needs to be more reasonable and to negotiate from that as a basis. Well, the Biden administration is suggesting it's the other side that's being unreasonable. A White House official tells me the president understands Republicans have issues with their vote count, and Republicans, this official says, need to understand what the White House needs to deliver Democratic votes, which are required for any agreement to pass. They can't get everything they want. A spokesperson separately said there's still a path to a bipartisan budget agreement if both parties negotiate in good faith. Meanwhile, the top Senate Republican, Mitch McConnell, tweeting that it's up to President Biden and Speaker McCarthy to personally broker a deal, that they are the only people who can do this, and that time is of the essence. President Biden is being updated around the clock by staff in Hiroshima, Japan, where he's attending the G7 summit of the world's largest economies. The debt ceiling discussions have already cut his trip short, and they are now threatening to overshadow big picture discussions on Ukraine and China, and they'll also take center stage during a press conference he set to hold over the weekend, John.
Okay, Kayla, stay with us for a moment. I also want to bring in CNBC contributor and CEO of the Atlantic Council, Fred Kemp. Fred, you say, and since we're talking geopolitics and the economy, the biggest economic threat to U.S. allies is not Russia or even China. It is U.S. debt default, if that becomes a real possibility. That isn't the default itself that's the threat, or just playing with fire here and touching the stove?
Well, two things. First of all, in the War of 1812, when the British were losing the Battle of Lake Erie, which we all, of course, remember so well, the British commandant said to Major General William Henry Harrison, "We have met the enemy and they are us." And that must be the way President Biden is feeling right now in Japan, where this makes him not look like the leader that everyone wants to follow. And even if this debt ceiling issue gets solved, and it really is a bigger economic threat for this year than either Russia or China, even if it gets solved, what's lingering behind this is a reputation that the U.S. has gained over the last few years of being even more politically volatile, potentially economically unstable. And it's not just the debt ceiling, it also is our recent banking crisis. It was the political violence and instability of January 6th.
Right. Well, Fred,
and also leading up to the 2024 election.
isn't the most, I mean, I'm no political expert here, but isn't the most likely near-term outcome that the can gets kicked down the road a bit, right, as we approach the X date, that somehow they figure this is taking us longer to figure out, we're going to do some sort of an extension thing, neither one of us like it, but that's, and the uncertainty just gets extended. What does that do to the economy, to America's reputation, the ability to, move forward on the geopolitical issue?
So our allies believe that this will be solved, and I think markets by and large believe.
So Meta's Instagram ready is a Twitter competitor
And
for
so
summer
it
release.
isn't so much the medium long-term issue isn't that. It's what kind of cloud does this cast over us? The Chinese, of course, will use this as a demonstration to the people that surround them. You really can't trust the Americans. We don't know where things
Watch Meta on the move.
Part of the trip that was canceled, which you say, well, why is it such a big deal that the president can't go to Papua New Guinea? But it's a big deal because it was planned for months. No president has ever been to the Pacific Islands. They are strategically located, and China is investing heavily in them, including the potential of military presence.
Kayla, I wonder, can you tell us how the unusual structure of the House right now, as far as Republicans are concerned, plays into this? We heard from the Freedom Caucus earlier today saying, don't negotiate here. Speaker McCarthy is in an unusually tenuous position as a leader here, even if he can put together a coalition of some Republicans plus some Democrats. Couldn't that cost him his job?
Yes, possibly. I mean, he barely stitched together a vote for the bill that passed in late April, the Limit Safe Grow bill that they're using as the starting point for these negotiations. But John, even if he's able to get House support for whatever he negotiates with the White House, you still need 60 votes in the Senate, where Democrats have a slim majority there. So when I was referencing what this White House official told me earlier, which was sort of, it's okay if you lose the extremes of either party, because really the answer lies in the middle. You really need the moderate wings of the Republican Party and the moderate wings of the Democratic Party to sign on to whatever is negotiated. So yes, it's okay if the Freedom Caucus wants to make noise on the side and say, we don't like the direction that negotiations are going in, and you have a handful of more than a dozen Senate Democrats saying, we think that you have to raise taxes and use the 14th Amendment to continue issuing debt if we have to. But that's just noise at this point, because I think the White House knows that it has to broker a deal that has both sides here. And so, I think one thing that you can read from what's happening right now is these are politicians who are speaking to their base, showing that they are holding their line and holding their positions,
Understood.
even if the eventual outcome is still different.
Fred, in an ordinary session of Congress, I would find that reassuring, right? Because the speaker's position would be relatively safe. But if Speaker McCarthy does this moderates from both parties thing, he is vulnerable from any individual members of the right wing who say, hey, we don't like the way you're leading things, right? I mean, this seems to be maximum possibility of not coming to a compromise right now. And I wonder if you think the market has that fully appreciated.
Well, I think you're absolutely right. And what's interesting about this, I've seen, and these are also investors in markets, is that our domestic dysfunction has enormous geopolitical significance that our members of Congress don't seem to understand. And of course, it has market significance as well. So we're really saying domestic disturbance leading geopolitical instability, and that, of course, affects markets at the same time.
Yeah. It means we got to keep watching the numbers. Both we're talking about the votes and we're talking about the markets. Fred, Kayla, thank you.
Markets close.
And let's turn now to the other big story today, Powell's comments on inflation. Our Steve Leisman has a recap. Steve?
All right, touch base with them.
Hey, John, thanks. Yeah, Fed Chair Jay Powell countering some
All right, thank you.
with his colleagues this week.
Bye.
With remarks that were much more neutral about the possibility of a rate hike. Powell saying that tighter credit conditions from banks can ease the pressure.
All right, still looking for a higher low.
That the stance of policy is restrictive now, and the Fed faces uncertainty about what effects tightening of bank lending standards will have on the economy.
All of this effort, just look at flat BWAP. Look at it. I mean, we haven't moved much. We come off the lows, but we haven't really gained much momentum. It's nothing like we saw yesterday. Yesterday was, you had these nice trends higher. Today, not so much. So I wouldn't even consider trades today. I'm here talking about them just to let you know, but NVIDIA had a big run up into the highs. AMD had a nice reversal and a run up, but today we're just flat. There's nothing going on. I wouldn't even be considering trades right now. Come into next week, perhaps we'll get some more momentum, some clarification on the debt ceiling. I doubt it, but maybe we'll get some. We get the OPEX out of the way, and we'll have a new week. So if you're considering taking the rest of the day off, that's what I would do. ServiceNow is at the top of the list, top of the range, rather. It's still lower highs for now. Okay, looking for that to break higher. We know what yesterday's highs were. ServiceNow. All right, so you got this level here to this level here, and basically a channel down for now. So if we break out to the upside, look for ServiceNow to continue. That's the only one that really looks interesting. Meta's starting to do something right now. Watch Meta. Oracle looks pretty good. Oracle looks like it might break out to the upside. It's above VWAP, starting to pull away. Oracle's starting to pull away.
Give me your perspective on the state of today's broad market risk, particularly with the major indices and with ETFs because not only are big stocks popular right now because they're seen as safe and have their valuations gotten stretched, but they're so heavily weighted in so many indices and ETFs right now.
Yeah, it's really interesting. This year, there was a theme that has actually worked, so it's hard to argue with it, at least up until it doesn't. That large cap tech is recession proof, and so you got a lot of money flows go into that. The stocks have all gone up and performed. It's really the only part of the equity market that really has performed. And so, until it doesn't work, it's working. I wouldn't necessarily generally associate tech investing with possible.
All right, looking for a higher high now. We got a higher low printing on SPY.
We believe that there is substantial risk. I would say, look, the soft landing argument is a possibility. It's a reasonable one as long as labor holds up. But if labor is a lagging indicator, and if labor falls out of bed, then I think you have a much different scenario. But at the moment, it has. But we would weight more towards a recessionary risk in that the tightening of credit, the tightening of liquidity, the aggressiveness of the rate hikes that haven't really fully affected the economy yet.
This stream is sponsored by To The Tick. Get free daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
So, Steve Leisman, about 4 weeks from now, what is it, June 14th, I think, is when we get that next Fed meeting. What are the key data points ahead of that Powell and the rest of the committee is going to be watching and that investors should also be watching? It seems like they'd like to pause, but who knows whether they can.
I think there's a couple things that are out there. I think the first thing is watching the trajectory of growth. It's interesting. I've seen some forecasts, John, that growth may be accelerating this quarter. We did, 1 and change last quarter. We might do 2, according to some estimates. I've seen some are down at 1, but it certainly hasn't fallen out of bed. And just to Michael's comment, what's been fascinating to me is the ability of companies to make money. We know they could make money before inflation. They're still making money during inflation. And it seems like if inflation were to fall, companies could still make money. Again, to your point, depending on how and why, that's another story. We'll also have John's unemployment report, and we're watching those weekly jobless things. An interesting factor we saw this week was claims went up on a weekly basis, but continuing claims actually fell. So when people losing their jobs, they're going back to work. So the Fed will be gauging the tightness of the job market, and of course, there are those inflation reports that we're watching to see. Something the Fed official pointed us to this week, John, not just is it coming down, but guys like Jefferson and Bullard have been watching the pace, and Logan have been watching the pace at which it's been falling. And they remarked that they thought the pace of it falling had been too slow.
So many mixed messages. It's like the data is giving us an on the other hand every day. Steve, Michael, thank you.
But you need that, John, for your weekly set, for your daily segment.
I do full employment for John Ford. Thank you. Coming up, the debt ceiling and geopolitics are the not the only things keeping investors on edge. Up next, we're going to look at the big rally in big tech we were just talking about and what the charts this time say about its staying power. Plus, which names within tech are best positioned for the AI gold rush? We'll see what analyst says will win it all. Still ahead.
All right, we're getting we're getting some bids here. So Apple's starting to go.
This is The Exchange on CNBC.
Apple's some cheap out of the money calls, maybe $1 or 2 out of the money. Maybe it runs. Apple has some cheap 177.50s for today. The 175s are 85 cents offer. If we can get any kind of rally end of day, that would be kind of cool. We're stuck right at VWAP right now. Apple. Oracle's at the high of the day. Yeah, nothing's following through. Just a flat VWAP, no momentum.
Welcome back to the exchange. Just a handful of stocks responsible for the recent rally. But how long can they keep holding up the market? Deirdre Bosa has more in today's Tech Check. Tech Check. B.
Good old tech check. To get an idea, John, of just how much mega cap tech is leading the market this year, look at this chart from Bank of America. It tells you that we are currently seeing the greatest outperformance of tech versus the S&P 500 ever. We'll get that chart up for you, but you will see that the previous two times we even came close to this kind of gap. There it is. They were followed by major tech busts. Now, of course, tech looks a lot different now than it did back then. It is more concentrated in a handful of companies worth hundreds of billions and trillions of dollars with real earnings and diversified business models. And it's partly underpinned by that transformational platform shift in AI that has not been seen since the advent of the iPhone, the internet, or the industrial revolution, depending on who you ask. Given their size, though, this run-up this year has been astounding. NVIDIA, Meta, they have more than doubled in value. Google is up 14% since that I.O. event last week where it came out with this generative AI search model. And Amazon is up nearly 6% this week. So despite, or maybe because of those gains, investors, they're looking for that next big winner in the space. Mizuho, John, thinks that Oracle could be next. It's only up some 26% this year. And Mizuho says it could talk up GPU and NVIDIA chips and get a stock boost as new money comes in for the chase, and it is a late reporter, so maybe you could see that pop when they play that earnings call.
It's so interesting. There's a huge.
I will say sometimes on Fridays lately, you can wait until the last hour or so and catch some stocks that are $1 or so out of the money, looking for momentum to follow through for cheap. Other than that, though, we've had a really good week, so I don't want to give it back by doing something stupid. So I need to see momentum. Right now, we just have flat VWAP.
Gigantic balance sheets, and that's really what's different this time than those previous two peaks, is that, you know, these are fortresses. They have so much money on their balance sheets, and even though growth may come down, it has come down for them, they're just seeing a safety place.
All right. The view from Techland, literally with the data bridge behind you. Steve, thanks. Let's dive deeper now into the charts. My next guest is saying the move in tech is overdone. It's time to reduce or hedge long exposure in the sector. Let's bring in Carter Worth of Worth Charting. Carter, is this tech overall?
ServiceNow is trying the highs again.
That it's time to rotate out of because there's differences there, not?
Absolutely, just what you were citing, a major difference. But I think before the concentration issue that you all are discussing is important, but it's always with us. If you look back over the last 35 years since the beginning of the Standard & Poor's, the top 10 stocks on average are about 20% weight. But now the top 10 are 30. And of course, you know the top two, Apple and Microsoft, are almost 15. The last time we were this concentrated in two names was back in 1978, AT&T and IBM. Obviously, much smaller companies now. But what we have, of course, is a big milestone this week. The S&P 500 information technology sector just this week recouped all of its losses relative to the S&P associated with the dot-com peak. We might have a chart of that, but what it is a testament to is the problem with overpaying for something in real estate, in the market, in anything. And so that's a long time, 23 years and 3 months, just to get back to even with the general market.
Well,
Now,
that's
the
what
preceding chart you had there.
That's what it's a testament to, but I got to stop you there because it looks like this isn't the first time we've bumped our heads on that ceiling, right, or close to it. So what is it also a signal of?
Right, so the other chart you had up there prior to my coming on was going back to 1974. Now, again, in 1974, there was little to no tech, and IBM was probably half the weight of the sector, and IBM was the most valuable company in the world at one point. Before inflation exceeding a former high, any stock, currency, index, commodity will have to contend with it, which is to say, we're here at a level where you're likely to back and fill at a minimum or back away. Hence the judgment to reduce its exposure to the largest names, NVIDIA, Apple, Microsoft, and do what you maybe were intimated. Double back, look at some of the mid-cap names that have lagged and play those for catch-up.
Okay, and how are we looking in the way some of those mid-cap names or indices charts look versus, today's, flavors of the decade? You mentioned names like AT&T, for example, and IBM that are not the flavors now. Intel is still in there for a couple decades ago as well. So maybe the big names are always popular, but the big names are always changing as well.
Ever changing. And in fact, of course, we know, thinking about it, U.S. Steel, of course, now going back a long way, most valuable company in the world, General Motors, GE. And so it's ever changing. And again, this will happen too. One day, Apple will not be the thing that it is, and Microsoft as well. But for now, they are the kings. The question is, are they a little bit steep, uncorrected, or in the fundamental parlance, are they expensive? I suspect it's right to reduce exposure.
The whole market's expensive, but these larger companies are especially expensive. So does that mean X these larger companies? Maybe some parts of the market are reasonably priced when you look at the charts. How should investors at home think about that relatively speaking?
Sure. Well, we have such a bifurcated circumstance throughout the market, and not only tech versus the market, but let's take consumer, for instance. You have restaurant industry groups making all-time highs, home builders, and yet retailers are 52-week lows. And one of the problems with bifurcation is it's almost always resolved by generally lower prices. And so consider this fact: the Russell 3000, right, represents 98% of the investable capital in the United States. Half the stocks in that index are actually below where they were on the lows of October 13th. Meaning we are so dependent on just a few, and that usually ends poorly.
Well, to use the cliche that we tend to hear a lot on this network, it really is a stock picker's market then. Like, really, there you go. Indeed, when you bring out that October 13th memo, let's go hunting for those deals. Carter, thank you. Carter Wood.
Thanks.
Still ahead, an exclusive first look inside Amazon HQ2. Will it be enough to take the sting out of Andy Jassy's controversial call for workers to return to the office? Our Diana Olick has a sneak peek ahead of its opening. The exchange is back after this.
All right. Stocks are just refusing to push any higher. Maybe they get something going in the next hour or so, but just sitting here doing nothing.
The Georgia prosecutor investigating Donald Trump and his allies for possible interference in the 2020 election signaled charges could come in early August. Fulton County District Attorney Fannie Willis asked a judge to not schedule trials than in-person hearings during the first 2 full weeks of August. She did not give a reason for that unusual request, but Willis previously warned law enforcement of possible backlash during the same period. The CDC reported another death linked to contaminated eye drops, bringing the total now to 4. 81 people have been infected with a highly drug-resistant bacteria after using the eye drops. 14 have gone blind. Patients reported using 10 different brands, but the most cases are tied to Ezracare artificial tears. Jeff Bezos' space company won a $3.4 billion contract to build the lander for NASA's Artemis 5 lunar mission, set for 2029. The total cost of the Blue Origin-led effort estimated to be around $7 billion. The goal is to deliver astronauts to the moon's surface later this decade. John, back to you.
Howard, thanks. Coming up, this name outperforming the market since the launch of ChatGPT in November. Our next guest says investors are rewarding its clear AI strategy. We're going to look at the winners and losers in the space. The exchange is back after this. Welcome back to the exchange. Artificial intelligence has been a big catalyst for the big tech names recently. Microsoft up 24% since it announced new versions of Bing and Edge. powered by ChatGPT. Amazon is up 20% since announcing its Bedrock program, and Google has climbed more than 16% in the days following its I/O event. But our next guest says it's the cloud names that are going to come out on top in the AI arms race. He's got a few key companies he is watching. With us now is Tim Moran, cloud and communications analyst at Oppenheimer. Tim, I'm a little surprised by this in a way because these hyperscaler cloud names have such high valuations. One might argue AI success is already baked in. So why them and not application players to win in AI?
Great question. Well, first, we don't really know who the application winners are going to be. We think most SaaS or most software will be embedded with intelligence at this point, but the business models are not really clear. But we do know that the ARM suppliers are usually winners in these processes. That was kind of the case back in the internet 20 years ago and has been over that time period. And the cloud providers in general, if you have the best infrastructure, people are going to generally ride on top of that infrastructure. And the big three hyperscalers at this point really have the scale to train these AI models and to host these applications.
Looking for Apple to press higher. It's trying to press through these levels right now. Watch Apple.
Like your ServiceNows, your MongoDBs, even your Snowflakes that are dealing in data and trying to create a platform effect for themselves, even though they're not hyperscalers. Are those too risky?
It's all going to depend on execution at this point, and these companies are a layer above the cloud, and that's going to be needed. We're going to basically need to the data. You're going to need to curate the data. There's a whole host of suppliers and a whole new food chain that's going to be required out there. But there's massive opportunity for most companies that have been involved in the cloud for a long period of time, and the cloud may evolve from a technology perspective and probably will to a much more decentralized look and edge-based look over time. But right now, we think we're going to see an acceleration in cloud growth in 24, 25, almost entirely driven by AI at this point, and that whole food chain of suppliers should benefit.
Now, you pointed out DigitalOcean as being at risk, and I wonder if you mean that longer term or if you just mean that it's range bound for a while, because this is a company that focuses on cloud-type services for smaller businesses.
Still no follow through. Apple, Spy.
Trying to keep it as efficient as possible. Are you saying that smaller companies that cater to small business are going to get kind of blown out in the AI-driven era, or just that it's going to take them longer to establish?
Great question. They don't really have much of DigitalOcean in particular. It does not have a lot of cloud AI-based capabilities at this point.
IBM, looking at an ABCD pattern playing out on IBM.
Startups are going to be AI focused over the next few years. Probably 80 to 90% will have some AI capability with them. And DigitalOcean really is focused on startups. But for DigitalOcean in the short term and for a few of our other emerging cloud names, they are much more highly correlated with economic growth. And the economy is clearly, slowing here still a little bit more. They've been, guiding down a little bit. They've not seen much in the way of organic growth in the last few quarters, and we think that will continue.
Well, what ends up happening to, say, not only DigitalOcean, but say a GoDaddy, that even will sell through, say Microsoft 365, right? Does that type of relationship where they're a reseller to small and medium business, mostly small business, change in the AI era, or do they end up becoming a conduit through which some of these hyperscalers reach the smaller businesses that aren't necessarily going to be the focus of their larger sales force?
It's a great question. If you look at a lot of I'll use these business models at a high level, SaaS-based business models, they only really paid about.
All right, IBM looks like a ABC so far. Looking for D, back to the high of the day. IBM looking for a push back up to this high over here at 128. IBM for a scalp or a continuation on the swing.
That's right, John. Not open yet, but we got a sneak look inside at the incredibly sustainable real estate development here. And do not worry, we will hear from an Amazon executive about return to office. All that next, coming up on the exchange.
Stocks are just stuck to VWAP. Very few are breaking higher away from VWAP. Watching IBM here, Oracle showed signs of moving away from VWAP. Now it's coming back. So think about Wednesday and Thursday. Great trading days. Very nice slope to VWAP. Today, just about everything is a flat VWAP. Check your 5-minute charts, your 2 or 5-minute chart, whatever you use short term. Enable VWAP, and you'll see most stocks are just sideways. All the momentum's gone. The momentum was yesterday and Wednesday. You can see flat VWAP overhead. S&P is not able to make it through this level. VIX popping up. $4,200 is a major resistance level. This is OPEX for the month. So I'm not surprised that we're not able to get back above 4,200. 4180 was a previous low, right around 1135, 1140.
Story towers on campus in Virginia, just outside DC. Our Diana Olick joins us from Met Park in Arlington, Virginia, with an exclusive preview. Diana?
Well, John, these buildings will run with zero operational carbon emissions and will be powered by 100% renewable energy from a nearby solar farm. And that's just the beginning. I sat down with Amazon's sustainability chief for an exclusive interview on both the building and back to office.
I think it's incredibly important for a company like Amazon to demonstrate leadership and sustainability and to be out there to talk about where we're testing and trialing things, to also send demand signals to the market that these are products and services that we want.
And the message resonates across 2 million square feet of sustainable space at HQ2.
So this is mass timber, which is an important part of our sustainable building materials story.
From the ceiling to the floor, which was provided by Carbon Cure, a clean cement company backed by Amazon's Climate Pledge Fund. There are 3,000 tinted glass windows for cooling and a light that tells workers when is a good time to open those windows. The building is also using special cooling technology that helps save 7.5 million gallons of water per year.
It's more water than
Apple, no follow through.
There's also rooftop vegetable garden to serve the surrounding community and plenty of amenities for the 8,000 workers who Hearst says will be here at least 3 days a week by the end of the summer.
We're still committed to all the hiring goals that we set out. So we'll continue on that path for really over the next decade. And I think, our policy at Amazon is 3 days a week in the office. So it's flexible.
Now, as for the second phase of HQ2 offices that was recently delayed, Hearst wouldn't give a time frame, but said they are in the pre-construction phase, still going ahead with it and still committed to it.
She added that as for the 8,000 workers coming here this summer, that's actually ahead of plan. They had expected 5,000. John?
Diana, it's so interesting. I was doing some research ahead of my On the Other Hand segment about work from home and return to offices. And in the South, more people are going back to work in person, but in major cities, not so much. DC, Maryland, Virginia, sort of right there in the middle. How are things trending with occupancy and days in the office? Is Amazon sort of out of the norm here or right smack dab in the middle?
Well, it's kind of in the middle. And remember, DC is a government town, and a lot of the government is back to the office and back to work. A lot of these, in fact, most of these workers are already in temporary office spaces in other parts in Virginia. They're just moving from where they are now into the new offices. And Amazon also says, given this space, and it really is something, and the dog parks they have and all the other amenities for office workers, this is kind of a place they're expecting people are going to want to come. So DC is seeing a fair amount of return to office. Obviously, the entire country is still way below pre-pandemic levels.
Yeah, and I'm eager to hear over the weeks and months how small businesses around that campus might be impacted. Diana Olick, thank you. Coming up, Disney firing the latest salvo in his battle with Florida Governor Ron DeSantis. We're going to have the details on how much money the Sunshine State could miss out on from the House. That's next.
Yep, the markets are just not following through.
Dollar yen currently trading at around 137.806 per US dollar.
S&P currently down 0.3% on the session.
And gold currently trading 1.3% up on the session.
S&P's rolling over some more. Looks like we're going to go down and test 4180. That could give you about a 20 handle run back up to the highs. If we get any kind of action on the long side, for now, we're just fading.
Shares of Disney are lower today after CEO Bob Iger announced the company is scrapping plans for a nearly $1 billion office complex in Orlando. It is the latest turn in Disney's feud with Florida Governor Ron DeSantis, which started last year after then CEO Bob Chapek criticized the passage of the state's Parental Rights and Education Act, or the so-called Don't Say Gay bill, last March. But one analyst says the ongoing battle with DeSantis isn't the only headwind that Disney is facing. Joining me now, Tim Nolan, analyst at Macquarie, who downgraded Disney to neutral today, along with senior media and tech correspondent Julia Borton and CNBC.com political finance reporter Brian Schwartz. Welcome, everybody. Tim, how much of this billion-dollar real estate relocation boom is really about DeSantis, and how much of it is just, hey, Disney's cutting costs, and this is a convenient way to put the screws to DeSantis at the same time?
Well, my downgrade was really not related to the Florida situation at all. But it was to say that there are a lot of things going on at Disney with a slowing business, a transition to direct-to-consumer, and efforts to cut costs. I don't know how much the billion-dollar project in Florida is related to, cutting more costs from here, or actually if that might be a matter of it was an effort to cut costs that's not going to happen. So there are political issues that are, probably weighing on sentiment on the stock. I don't think it's a big financial issue for the company. Our downgrade has more to do with the state of the businesses themselves.
Where does Hulu play into that downgrade?
Well, we didn't downgrade because of Hulu,
That's the dollar yen currently trading down 0.65% on the session.
I've seen Bitcoin trading around 0.4% up on the session.
And gold currently trading up 1.2%.
They might actually look to sell that or perhaps extend the current arrangement. But that's at least $9 billion, perhaps more, that Disney will have to bring on board. And who knows, maybe there are some other plans afoot with Hulu. They made an announcement about combining the Disney Plus and the Hulu apps. Combining those services is good for reducing churn in the bundle offering, but it's not so great for ARPU, for the revenues that they generate per user. And maybe there's some more costs to come from Hulu. So a lot of questions. And then, of course, the big issue up in front is when are they going to put ESPN over the top? A huge issue for Disney to deal with. Decision yet to be made on that.
Julia Borsten, what is the tightrope that Bob Iger is having to walk here? I mean, was it the last earnings call that actually called out, congratulated Universal on its success in theaters? I mean, for a Disney that was riding high 4 or 5 years ago, ouch.
I mean, look, Bob Iger always has to walk multiple tightropes, but I think now there are a couple of key ones I would point out. In Florida, he has to walk the tightrope of the fact that the company is incredibly invested in Florida. They are planning to invest $17 billion in their parks, hiring thousands of people in the next 10 years. And even though they can opt not to invest another $1 billion and build a new facility for Imagineers and
All right, maybe a higher low. It does look like a bear flag for now, SPY.
So I think he understands that the state of Florida needs them and that will be resolved over time. But in the meantime, he is walking that tightrope. And on the other hand, you have the TV business. We've heard a lot about weakness in linear TV. There are two pieces of that. One is cord cutting. We're seeing increasing, and in some ways even accelerating cord cutting, which is challenging, which is why they are thinking about and working on taking ESPN direct to consumer. And then of course you also have the advertising market. Yes, they're investing in putting ads on Disney Plus. They have Hulu. They have all these other platforms where they can run ads. But the linear TV ad business is weak because the overall ad business is weak right now. So that is really contributing to the uncertainty. You want to talk about a tightrope, he needs to make sure that they switch over ESPN from being part of the TV bundle. And in fact, maybe being the glue that holds the TV bundle together, he needs to be very careful about the timing and pricing that when they bring that direct to consumer. And Bob Iger has made it very clear he understands the importance of that decision.
Okay, now Brian Schwartz, back to the political portion of this tightrope. Governor Ron DeSantis looks like he's running for president. He's got to appeal to cultural conservatives across the country. And for a long time, Disney has been a favorite target when you want to kind of polish your cultural conservative credentials here. So how does Bob Iger win this, or is Ron DeSantis going to win it no matter what?
Well, I don't know who's going to be the eventual winner of this, John, but I mean, at the end of the day, this is not going to end for Disney anytime soon. And the reason for that is that when Ron DeSantis, most likely when he runs for president next week, this is going to be clearly a staple of his campaign. He clearly believes that he's won this fight with Disney, but he's going to continue the war with Disney when he goes on the campaign trail. And that's something to really keep an eye on. if you're a Disney executive, frankly. I mean, if Ron DeSantis say
Still looks like a bear flag on SPY. Looks like we'll drift a little lower.
one way or another, I do wonder how that is going to impact the company at large, or at least the image of them. And more importantly, I mean, there are real questions about how is that going to help Ron DeSantis in a Republican primary for president. And the polls really suggest it actually could give him some form of a benefit as he tries to go to the right of former President Donald Trump, who right now is the front runner in the GOP primary.
Brian, I think that maybe Bob Iger is Ron DeSantis's sister soldier. I want you to are you with me on that? Because I think, right? Because if you're a Republican, the attack is, oh, you're too in bed with big business. If DeSantis can ride it, I mean, am I right?
Yeah, I mean, in a way, you're right. I mean, look, I think this is something where he's going to be riding this train and using this fight with Disney and this kind of, I think, prolonged war with the company as a staple of his campaign, and really as a way to kind of formulate and can take base voters away from Donald Trump. But on the other hand, I'll give you a little tidbit of information here. A few days ago, I was meeting with a very, very close advisor to Donald Trump. And I can't really say verbatim what he said about how the former president looks at this fight between Disney and DeSantis, because it really isn't good for the airwaves. But I will say that it's clear to me, through this advisor, that Donald Trump is looking at this battle in a way that DeSantis has lost to Disney. And he's clearly going to be using that type of messaging against Ron DeSantis when and likely if he runs for president next week.
I'm not surprised, Brian Schwartz. Thank you. Thank you also, Julie Fortkin and Tim Knowles. Well, that's going to do it for the exchange just about, but I will be back at 4 p.m. on Closing Bell Overtime. Acting controller of the currency, Michael Sue, is going to join us. But up next, you're going to have Power Lunch, Tyler and Contessa getting ready. That is next after this quick break.
VIX just grinding up into the highs this morning. Not much going on here. Very, very obvious lack of volume or lack of momentum today. Okay, more fading. SPY continues to drift lower. There's nobody buying, just people taking profits, sellers at the moment. Don't give your hard-earned profits back. We could continue lower, but we could also reverse very quickly at any moment.
Just seeing CAD JPY currently trading down 0.7% on the session.
Let's also look into the euro dollar. That's currently trading down 0.4% on the session.
And pound dollar currently trading up 0.4% on the session.
Hi, everybody. Welcome to Power Lunch. Alongside Contessa Brewer, I'm Tyler Matheson. Welcome to Friday. Coming up, President Biden's busy weekend. He is in Japan, Hiroshima, meeting with G7 leaders on Russia, China, and more. While halfway across the world,
Most stocks are fading.
ceiling down in Washington reportedly stalling ahead of a fast approaching deadline. Plus, retail's big shrink problem, theft, hitting the bottom line big time. And it's not kids shoplifting stuff, it's organized crime, Contessa.
Let's get a check on the markets now, Tyler, as stocks turn lower after those reports about the debt ceiling stocks. All three major averages are still posting gains for the week, but look at, we're all off down about a third
to almost 0.5% on the Dow Industrial. Foot Locker, the big stock story today, losing a quarter of its value. The company cut its outlook and said sales will slow. It has to provide discounts now to clear inventory, and that's dragging on other sports apparel names, including Nike, down more than 3%, down almost 4%. Look at Under Armour, down 5%. Dick's Sporting Goods, 6%. VF Corp, down more than 9%. Tyler.
Growing tensions here and abroad in focus today. The debt ceiling talks apparently stalling once again. You had to predict there might be a snag with all that positive talk earlier in the week. Maybe not so much. All while global leaders meet at G7 in Hiroshima to discuss issues surrounding China and Russia and more. Kayla Townshend covering both of those stories for us. Kayla, let's start with where the debt ceiling talks stand and what may have happened this morning.
Well, Tyler, negotiators working toward a deal to raise the debt limit and cut federal spending have hit an impasse. Republicans saying they are pressing pause and accusing the White House of being unreasonable. The change in heart comes after just yesterday, top party leaders both said they were optimistic an agreement could be reached in the next week. House Speaker Kevin McCarthy today suggested the administration hasn't budged on spending levels.
Yeah, I mean, yesterday, I really felt we were at the location where I could see the path. The White House is just, look, we can't be spending more money next year. We have to spend less than we spent the year before. It's pretty easy.
The White House, meanwhile, sees Republicans as inflexible, saying the president understands the GOP has an issue with its vote count, and it hopes Republicans understand what the administration needs to deliver Democratic votes. Meanwhile, Treasury Secretary Janet Yellen told bank CEOs in Washington there was no wiggle room from that June 1st deadline, according to two attendees, doubling down on the so-called X date that she's identified as the earliest.
Just seeing the Nasdaq currently down on the session at 0.5%.
Now less than 2 weeks away.
It's also noting Bitcoin trading up 0.36%.
Washington on both sides of the aisle, but let's go across the world to the G7, where the topics.
And the USD JPY currently down 0.6% on the session.
Yes, the leaders of the world's largest economy have been meeting in Japan for the last day, and they're going to be meeting throughout the weekend. Of course, Russia and China loom large in those discussions. First, where Russia is concerned, there's a discussion over the war in Ukraine and how to end it. That's been the discussion for the last year plus. President Volodymyr Zelensky is set to appear at the G7 in person. And now we learned that there's been an agreement to send F-16 fighter jets from the U.S. and allies to Ukraine in a way that would intensify the fighting and hopefully amp up Ukraine's defensive power. And then there is China, of course. This summit is taking place in China's backyard.
All right, so it looks like more bear flags potentially.
Bolstering domestic supply chains, what they call friendshoring, essentially moving these supply chains out of places like China and to places like Japan and Europe where they feel that they can more sustainably make products. We expect to learn a little bit more about those efforts when the summit ends.
All right, Kayla, thank you for that. And speaking of China and this sort of inclination or an agreement that the G7 leaders think there should be less reliance on China and its trade with this communist nation. Let's get over to Eunice now and get reaction to the G7 there in China. Eunice, hello.
Hey, Contessa, well, China today is accusing the G7 of what it described as coercive diplomacy. The foreign ministry today described the U.S. as the inventor of coercive policy. And earlier this week, the ministry had accused the U.S. and mocked the U.S. for shifting what it described as domestic risks onto the rest of the world, including, it said, the debt defaults. Now, in contrast, China's
VIX near the highs of the afternoon session.
a summit here in China, which is being billed as an alternative to summits such as the G7. President Xi invited Central Asian leaders here and also pledged to boost trade and security for the region. He also touted what he's described as a Chinese-style modernization as an alternative to the West.
And Eunice, while they're dealing with this international crime, there are also some reports coming out of China that people are going to social media and really expressing dissatisfaction with their own financial situation within China. Yeah, absolutely. A lot of people here have been very concerned about the economic conditions and exactly what the future holds for them. There have been several Chinese, especially young Chinese, who've been venting their frustration online. In fact, sharing what they describe as bank snapshots or screenshots of their bank statements just to prove how little savings they have. And one of the popular hashtags that we've seen online is "My Real Savings at 26 Years Old." This has been viewed 320 million times, where people have been saying that they have no job prospects, they have very little money, and that they're falling behind previous generations. Thank you for the report from China.
All right, for more on how China tensions, the Russia-Ukraine conflict, and stalling debt ceiling talks will impact the G7 summit, let's bring in Michael O'Hamplin, Director of Research and Senior Foreign Policy Fellow at the Brookings Institution. Michael, welcome. Let's start with Ukraine and the news that, as I understood it, the U.S. is willing to train people on F-16.
Keep an eye on the SPY. This looks like an S&P. This looks like another bear flag. We need to reverse out of this on volume.
Sending those planes to Ukraine. Is that what you're hearing? And what level of escalation does that connote?
Well, to be honest, and greetings to you as well. To be honest, I only heard it just now on your show. But these things do have to break at a certain moment, and certainly F-16s have been in the conversation for months. I would not be at all surprised if we wound up making this next incremental step, which is a way of saying that we're sort of half pregnant with the decision. We are going to start training Ukrainian pilots. We haven't yet decided whether to send the F-16s. You wouldn't start the training unless you thought there was a very high probability that you might send the F-16s, which means we don't have any particular strategic argument against it anymore. So I think the airplanes themselves will follow. And as you said, some of our allies are already prepared to do it. I have some doubts as to whether any of this weapons, weapons shipment and training and general beefing up of Ukraine's military is going to help Ukraine decisively win the war this year.
Let's go there then, Michael, because that's where I want to go, because I read in my note that you feel that the prospect of Ukraine actually, quote, winning and ejecting...
Just seeing information about prior market moves, stocks fluctuated amid a slide in banks and concerned U.S. lawmakers.
Very low, and that maybe within a year's time, maybe sooner, the realists in the room are going to have to say it is time to negotiate some terms where Ukraine may not get all of its objectives.
Yeah, I'm afraid we have to start
On talks
that
in
conversation, and I hope that conversation is happening quietly at the G7, because it's too soon to start to make that decision, even though it's a distinct possibility. I mean, the U.S. intelligence community agrees with me from the Discord leaks, right, and the postings, the illicit postings of earlier this year. But no one can really do it. And
NVIDIA continues to fade. So does AMD.
and so I wouldn't start publicly doubting their capacity or publicly pressuring them to accept that Russia may keep Crimea, for example, for some definite period. But I think our own strategic debates, at least quietly inside the administration, within the alliance, need to start allowing for that possibility. By the way, it wouldn't necessarily mean that we encourage Ukraine to give Crimea to Russia permanently. It could just be a recognition that it's not going to be settled on the battlefield anytime soon. It has to sort of be punted until future generations can solve it at the diplomatic table. So there are sort of third options, which may not be very appealing to President Zelensky, but are still better than, trying to pressure Ukraine.
Okay, bear flag is breaking lower.
But the point is, we have to anticipate this possibility. The G7 meeting is a good place to begin to do that behind closed doors.
Meanwhile, China has remained staunchly sort of in the Russia camp, and it's creating all these complications, Michael, in terms of the tension between the United States and China and the rest of the G7. Russia's one factor there. The trade is a factor, and you heard me just mention to Eunice that the G7 group has come up with language that basically says, yeah, we need to pull back on our reliance on China trade. In the meantime, China has already said it's not going to attend the G20 meeting next week in this disputed region of Kashmir. It says it shouldn't be in Kashmir. And on top of that, you have the trade official from China, top trade official, coming to the United States next week for a very rare
trade talk. Is there hope to ratchet down the tension with this all-important trading partner with the United States?
Yes, but I think that it's going to take some work, as you point out, with all these different forces pulling in different directions. I mean, one reassuring thing, in the last 2 weeks, Secretary of State Blinken essentially corrected his own boss, who earlier had rejected the Chinese peace plan for the Ukraine conflict out of hand categorically, just as NATO Secretary General Stoltenberg had done earlier in the spring. I think both Biden and Stoltenberg were wrong. Blinken was correct. Obviously, Blinken did this after consultation inside the administration, but he basically said there might be something in that Chinese proposal we can work with. There are parts of it we may not like, there are other parts we should try to work with. That's the kind of attitude we've got to have, I think, in dealing with China, rather than just demonizing them or categorically sweeping all of their ideas aside. You mentioned that, yes, they're on Russia's side of the conflict rhetorically, and yes, they're buying Russian oil and gas, although actually we want them to, because we don't want the world market to be deprived of all that oil and gas. So we're complicit in that ourselves. But anyway, China has not sent weapons to Ukraine. There's some suspicion they might be trying to get some spare parts indirectly to Ukraine through a third party. They have not sent bulky weaponry to Ukraine, to Russia in this war. And that's a huge, huge decision. They could change it at any point. And I'm not saying it proves they are well-intentioned or good-hearted. Could just be that they're afraid of America.
According to Quincy Crosby, Chief Global Strategist for LPL Financial, with the walkout of Republican debt ceiling negotiators hindering chances for a variable conclusion before the upcoming X date, that would weaken chances for the Fed to raise rates.
And as you know, what that means is don't depend on China for crucial things where they provide 80 or 90% of the world's supply. That's a bad place to be, because that gives them economic leverage and coercive power over us. But no one's suggesting we should stop trading with China. And I think the United States is still breaking records.
That appears.
Last year was the highest trade ever.
Yeah, and I think that really is the motivation between what the G7 is saying and reducing the reliance, that they want to de-risk the reliance on trade with China.
Michael, always fascinating to talk to you. We could talk all afternoon. Hope you'll come back soon. Michael Hanlon of the Brookings Institution.
In the meantime, Tyler, as we talk about AI and chatbots, it seems like every hour here on CNBC, China's also in an AI race, and CNBC got a chance to test out Baidu's Ernie bot. Apparently, that chatbot is not that chatty. Let's bring back in Eunice. So you got to play around with it firsthand, Ernie, huh?
Yeah, that's right. We got access.
ServiceNow is trying to break out one more time.
Chinese rival, Ernie. And we found that due to political sensitivity, there are a lot of topics that Ernie can't really talk about.
When asked if President Xi Jinping will rule China for life, ErnieBot declined to answer in Chinese and English, suggesting we start a new conversation while suspending the window that had allowed us to type. We made a general inquiry about President Xi's U.S. policy and got warned to test out the chatbot in a civilized way. We switched topics to COVID-19, asking where the virus originated from. In English, the response didn't mention China. In Chinese, it had no response, advising to change topics. Ernie had no comment about why the Chinese government abruptly ended its zero COVID policy, but when asked, could compare itself to OpenAI's ChatGPT. Ernie is more suitable for specific tasks, it said, while ChatGPT is more general in its ability to understand and generate natural language. Just don't ask what the relationship is between President Xi and the character he's often compared to, Winnie the Pooh, or risk getting banned.
And Ernie's challenges really highlight a main conflict that we're seeing right now within China's technology policy, and that is
Still fading.
to be an AI leader, but at the same time is worried about the political consequences of these chatbots, as well as the information that they produce. So the draft regulations are now under discussion. What we know is that they don't want chatbots to subvert state power. A lot of people within the industry see those the wording as quite vague and are concerned about what that potentially could mean for them, as well as the development of the industry. Okay, but was Ernie any good at, say, formulating a good excuse for calling in sick the next day to work, or getting out of a public speaking engagement? Well, I didn't get a chance to ask him a whole lot of questions because we were banned as we were very carefully asking questions. But there were some general questions that it was able to ask. For example, we asked if it could write a poem or a joke about Elon Musk that Chinese people would find funny. It did talk about Elon Musk, but I have to say the joke wasn't really funny. It was actually a bit incoherent.
And let's
But it
assume
did mention Musk.
let's assume there are no funny jokes about Xi Jinping in there. Well, Eunice, thank you. Ernie, after all, is a Muppet. Anyhow, coming up, how big of a problem is retail theft? Target flagging shrink in its quarterly report, saying it expects crime-fueled losses to jump by $500 million this year. Now, other retailers, like Foot Locker, are blaming margins on shrinkage. So is this a widespread and serious problem, or is Foot Locker just stealing the excuse kicked off by Target?
Plus, Deere in the headwinds. The company reports a big revenue and earnings beat, but the stock takes a turn on concerns over higher inventory and slowing demand. Power lunch. We'll be right back.
All right, right back down to the lows.
WTI crude currently trading down 0.8%.
Oh, no progress. NVIDIA, AMD starting to see short covering, NVIDIA and AMD. All right, shorts covering.
So we did hear from GOP debt limit negotiator Grave, who said that the talks are at a pause, and at this time we did see Fed swaps downgrade June hike odds after the debt limit talks are stalled.
Free consultation. Welcome back, everybody. Retail facing a shrinking inventory problem after years of staying mostly silent on the topic of shrink. More retailers speaking out about the issue, and it's not damaged goods from being held in inventory. Shoplifting or employee theft. It is organized retail crime.
Nice reversal here.
Really big problem, and I know that we all saw these flashy videos of the smash and grabs that were happening during COVID. That's not exactly what we're talking about. This has been going on for a really long time. Organized retail crime is often a group of criminals, and you have someone that instructs criminals to go into certain stores and steal certain things. They're stealing items that are easy to resell. So maybe it's not necessarily a high value item. Only 11% of things that are sold are luxury items. Things that can be resold easily on marketplaces, whether it's a Facebook marketplace, whether it's OfferUp, whether it's a more peer-to-peer site. Any of these things are proliferating in their use for honest people, but it also makes it easier for criminals.
Turning stolen goods into cash. So give me some examples of items that you would that would be stolen? Would it be a toaster oven out of Williams-Sonoma? Would it be what?
It could be, believe it or not, it's a lot of personal care items. I don't know if you've noticed at, you know, your CVS or your local Walgreens. I'm not picking on them in particular, but just they have
from
things locked up
UBS strategists.
like deodorant. There's no serial numbers on those. They're consumable products that we all use a lot of and probably don't really bat an eye when we're ordering them online, and they're maybe a little bit less expensive than we might have seen before, and we don't really think about it, but we all might have accidentally
Again, sorry, we are still just doing a mic test here. Seeing from UBS strategists.
All right, nice reversal.
We see reasonable odds that roughly 50% that Congress passes a short-term debt extension. However, given the two sides ruling that out, our assessment could be very wrong. So again, it's according to UBS strategists.
Who's going to track a tube of toothpaste? For the retailers, there's varying laws about what constitutes a crime that should be prosecuted, how much has to be stolen before that happens, and there's different corporate rules about whether employees are supposed to try to stop the thief from getting away in the first place. These are all really good points, right? So there are different felony level thresholds for a dollar value of items stolen in different areas. So the higher the threshold is for something to be a felony, often the more organized retail crime you're going to see in the area. The thieves are smart. If they know it's a felony, if they steal $1,500 worth, they'll go in.
So we did see some corporate news earlier as well. So James Gorman, who's Morgan Stanley CEO.
Cumulative threshold. So you could steal $1,400.
All right, we got a nice reversal here. This is pretty obvious. Institutions buying. First, shorts are covering the first 2 minutes, 3 minutes is probably shorts covering. Looking for more volume, and this for this to continue. If this is more than just short covering, it's a Friday, so you can never really tell. Seeing stocks like ServiceNow going. Okay, it doesn't feel like anything more than shorts for now. This has got to follow through. These last two candles, very tight. Feels like we could roll over very quickly. Yeah, no follow through. No follow through. Getting our hopes up. We need to see a follow through, and volume needs to pick up.
So still doing some mic tests here. Euro dollar currently trading up spot 43%.
This stream is sponsored by TickStrike. TickStrike allows you to actually hear order flow futures, forex, and stock instruments. Get a free trial at tickstrike.com.
So again, we did just see some corporate news earlier.
Yeah, no follow through. No follow through. Just a little short covering that's turning into more selling. Now we're starting to drop the markets again. All right, so there's very little time left for the Bulls to do anything. We've got an hour and a half to go. They could still pull something off, though I don't expect much. We need to see something quick. Otherwise, we could see a little bit more fade. All right, so hopefully you didn't put too much on the line today. We had a great week. Wednesday, Thursday was great. The option today to trade relative strength was an idea, but for the most part, the markets didn't follow through. We had very low volume, while the block trades were substantial, there was very little in the way of momentum, especially in the FANG stocks, which had a good week anyway. Time for a pause, it feels like.
Low tick alert minus 800.
All right back down to the lows. There's just nothing here, folks. Hoping for the best. We're not really getting much. Not getting much from the markets today. You want to put money to work on days where there's momentum, where VWAP is rising or falling. You can see a slight downward slope in the S&P VWAP. S&P VWAP is slightly sloping lower. 4,200 is major resistance. We didn't expect to get above that level. We're right below it by 17 handles. So not much to hope for right now. Just pack it up, call it a day, and we'll see you on Monday. If you're able to do that, I would just call it a day because we're not doing much here. More shorts covering. Not doing much on a day like today. I was reflecting on that last night after the close, how so many stocks were moving higher and how many of the FANG stocks were making higher highs, higher lows, and the momentum was clear, the volume was clear. Today is the exact opposite. There's no momentum, no volume, very few blocks. And I'm sure there's traders sitting out there hoping for a bounce here and a rally back up to 4,200. It could happen, but more likely it's going to happen next week. We've got OPEX for this week and better odds for follow through Monday through Friday next week. So we'll have a new OPEX setting up. Dealers will have about 30 to 40% of the Qs coming off and about 40% of the S&P spiders coming off. So dealers will rehedge next week. Maybe we get some sort of follow through. We'd like to see more calls building at 4,300, 4,250 further out in time to give us a sense that the institutions are lifting the ceiling. For now, we're not doing much of anything. So it's best to just keep your money in your pocket and look for follow through next week. The other thing is, if institutions were going to do something in light of the fact that the Republicans and the Democrats can't seem to come, they're like at a loggerhead right now. In that sense, I don't see much happening until we get a clear signal, which could go down to the wire June 1st, right around that time. It's been a good week. Let's go take a look at the S&P. So you don't want to mess it up by doing something on a day where we have no momentum. Okay, so here's the S&P. We're right up against 4,200. That was the previous high back in February on the 2nd. We're right back up to that. Now, think about this for a second. If this turns out to be a cup pattern and we have a handle next week and we just kind of drift lower down to 4150 and then we break out, that would be one of the better scenarios. Or we just break out and follow through next week. We need to see those calls build at 4250 and 4300 though. So or somewhere up here. We need to see calls building and the call wall shift. The other thing I will say, if they're going to pull this out of the rabbit out of the hat here, it's going to be very obvious. You'll see a string of 6, 8, 10 candles, and volume will pick up markedly. Anything else is just probably shorts covering. All right, Meta is starting to turn. Watch Meta. Shorts covering on Meta. No follow through, just shorts covering. All right, a little bit more short covering. All right, NVIDIA, AMD turning the corner. All right, so we need to see more volume. Service now pulled back once again. All right, no follow through. As suspected, it's just a little short covering. Everything is fading now. Everything fading with a little bit more than an hour to go. No hope for the bulls. We had a good week, culminating with a nice pop on Thursday to the highs. So hopefully you were taking some profits off the table, as we were. All right, most stocks and ETFs are pulling back for the most part. S&P still lagging at the moment. All right, fangs look like a little bit more short covering, but nothing substantial, just a little short covering. All right, a little bit more volume coming in now. There goes NVIDIA. NVIDIA on the move. NVIDIA, see some volume now.
They were already guiding to a pretty significant decline in earnings this year, and now essentially saying that the earnings power of the business is getting, cut in half this year. Very, very disappointing. So, I think the move downwards today is justified.
Sagrita, we heard about inventory shrinkage from Target, Walmart, and crime from Target, Walmart, and Foot Locker. How big of a headwind could that be? Because you listed quite a bit that's not working for Foot Locker. You didn't mention that. How much could that impact the bottom line?
Well, I mean, it's listed as in their risk factors. I mean, typically shrink is going to be a small single-digit percent. I'm not as worried about that. I mean, I think that the bigger question for the CEO now, Mary Dillon, is I think that my hunch is she probably took the job in large part because she saw a lot of the elements that were in her last job, which was Ulta. It's small format, multi-category. There's a lot of innovation in it, and there's potentially room for growth. Huge differences, though, between Foot Locker and Ulta is that Ulta was not saddled with a lot of the bad real estate locations that Foot Locker is saddled with. So they have to work through all of those leases. That's going to take a long, long time. Furthermore, a lot of the brand innovation is happening in footwear and in athletic footwear. But Foot Locker really needs to decide, are they about streetwear? Are they about performance? And ultimately, it's going to be a waiting game to have some of those challenger brands like an On Running or a Hoka ultimately become major players in the space. And they're currently really just challenger brands at the time.
So, Tom, what are the implications for other competitors, specifically in the footwear space? Are you looking at this as an execution issue, Foot Locker specific, or more of an industry-wide problem now?
I mean, I would say it's a combination of company-specific issues and industry-wide issues. It's been no secret really that there's too much inventory in the athletic industry right now. The thing that I thought was interesting on this call was the belief had been that most of the inventory issues were on the apparel side, And Foot Locker said today that their apparel inventory actually is about flat year over year, and it's the footwear inventory that's too high. So that's a little bit of a change, and that's something new. And that's probably something that the industry has to deal with. Foot Locker, company specific wise, they have to deal with getting reduced allocations from Nike. They sell high-priced product to a moderate income consumer, which in an inflationary environment and an environment of lower tax refunds is pretty challenging.
To help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to TDAmeritrade.com/webcast and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim... All right, so far we got a nice little rally here. NVIDIA continues pushing. We've got 59 minutes to go for the closing bell. AMD reversing.
At 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
close. I'm Renita Young in for Oliver Brennick, and we've got a great show for you today. Just to run down a few of the folks here, we've got Jesse Prince, founder of Happy Nest.
AMD still off $2 on the day, but nice little rally so far. Starting to hear some profit taking coming in.
And George Sillis has an overlooked stock that you probably missed during the trading session today. And then we'll take a deep dive on Gulfport Energy. That's ticker GPOR. We've got 1 hour left in trading, so let's check on the markets. Right now, we see all four major indices down on the day. The Dow Jones is down about 0.25%, with the S&P 500 down close to, well, really more so 0.1%. The Russell 2000 is down over 50%, and then the Nasdaq 100 down close to about 0.3%. Now it's time to welcome in Alex Coffey and Kevin Hinks. Guys, let's start out with the macro picture today, and then we'll get along to the market action right now. So, gentlemen, tell me your thoughts on what happened really for the week. Kevin, let's start out with you.
You know, I thought that this week
AMD and NVIDIA continue to look like they're going to print higher lows and higher highs. They look a little bit stronger than some of the other stocks.
this morning, the dollar was marching higher. I think actually we got an interesting comment this morning. You know, a lot of headlines were given to Jerome Powell and Ben Bernanke speaking today, but John Williams, who did the keynote address at that same conference, had a really interesting comment he did about the R-star, the rate of inflation, the rate of interest rates in the long term. Very interesting thing that he said, basically talking about long-term interest rates being lower in the long term. And that, I think, moved the U.S. dollar off some of its highs and a bit lower. Now, you had earnings, some good, some bad. Foot Locker, horrible. John Deere and Company, actually pretty good. So that was all things considered. And then the debt talks, right? And then the Republicans walk out of the debt talks, Renita, and the market softens during Jerome Powell's comments and after that. So we've got a lot of things that the market is trying to consume and digest here, Renita. All things considered, slightly lower on the indices, but nothing catastrophic.
Absolutely, I agree with you. Nothing completely catastrophic. And Alex, so let's talk about that. Jay Powell, Jerome Powell, and Ben Bernanke today, their talk. Now, we saw Jerome Powell take a clear stand that the Fed is considering at least pausing rates at some
No follow through. So you got shorts covering, a little follow through. Need to see a higher low. That doesn't look like that's going to happen for now. Running into the resistance levels.
We had a situation where really the economic data hasn't been as bad as it's feared. It's getting worse. Economic picture is not tremendously great, but it's not falling off a cliff like some of the worst fears have been. But then there's always been that fear then, well, if it doesn't, is the Fed going to keep on the gas pedal, keep fighting inflation, and potentially put the kibosh on the market that way? Well, we got a little bit of a hint, and I would say a pretty firm hint that the Fed is going to follow the market here and look to pause. Granted, there's no major surprise somewhere between now and the next meeting. We saw the odds as measured by the Fed funds futures, and you can look this up on the CME Fed Watch tool, for example. We saw them solidify from about 2 and 3 to begin the day to 8 and 10 today, or 4 out of 5. Depending on which ratio you want to look at, but 81% now that we're going to have that pause. Yet the entire week we actually saw mostly better than expected data. We saw the market rally, and now we have a situation where it looks like the Fed is getting towards the end. So in many ways, I see this week as a whole as a huge win for equity market bulls.
All right. Well, Kevin, let's talk about banks for a moment, because when Fed Chair Jay Powell talked about banks, he talked about the response that the Fed gave to the turmoil that's been happening since March in regional banks. He reiterated the Fed's tools for that, as well as them being separate from the tools for monetary policy. But do you think that that's a message that markets wanted to hear at that time?
Well, I think what Jerome Powell said was a couple things. He said that the tools they used worked.
He also said that the fact that the banking system is going through this, and he said there could be more, he said that may do some of the Fed's work for it. He still thinks that the tightness from lending and from some of the banks may do some of the work in slowing down the economy. That may preclude, like Alex said, of them having to raise rates. Excuse me. But he did say, like Alex also said, the data is going to be the most important. Remember, next week we're going to get personal income and outlays. On Friday, that's another inflation look. We need to see those numbers start to come down. That said, it did seem like Jerome Powell hinted towards pausing in the next Fed meeting. I think that's why you saw those percentages raise for a pause and drop for a 25 basis point raise. So I think Jerome Powell.
Yeah, no follow through. No higher low yet.
But also acknowledge that
NVIDIA fading.
Slowing down the economy.
Absolutely. And so one thing we cannot go without talking about is the retail sector, because today consumer discretionary is the biggest loser in the S&P 500. We know that Foot Locker is plummeting, softer consumer demand, elevated inventories, hurt their first quarter. What other things are analysts saying? Have you seen some more notes, Kevin, Alex, on what's happening with the Foot Locker picture, whether or not this has anything to do with its dependence on Nike?
Yeah, I mean, we got a fundamental update from the company, and obviously it was disappointing. Whenever a stock's down 25%, there's a reason behind it. They announced earnings; it was not enough to keep the street excited. I actually saw the macro read through on that, and actually the spillover effect on Nike to be the most interesting part of this. Foot Locker's got its own issues. Its key partnership with Nike in terms of a huge percentage of the products it sells being Nike products has not been favorable, considering the fact that Nike's biggest focus over the last few years has been, how do we eliminate the middleman and just sell our products direct to the consumer? If you're that middleman, which Foot Locker is, you're not in a great position. They've been looking for other ways to diversify that revenue to varying degrees of success. This was not an update the street wanted to see. But for the market to then take Nike down as well, to me, says that this is more than just a Foot Locker struggle. This is a general macro read-through. We saw some other names like Ulta, for example, catch downgrades today. And that stock had been one of the premier performers, I would argue, over the last 3, 4, 5 years. And it is recently turned down. So it's not just limited to isolated products like Nike shoes or athletic.
All right, nice higher low so far.
Fitness apparel, things that you might buy at a Foot Locker, or things that you might buy on Nike.com or at Lululemon. But it's now spilling over potentially into things that for some are much more staple-like products, like cosmetic and self-care kind of items. And so you combine that with some of the commentary we've heard from other companies. It's going to be an interesting. We see trade down on things like things that you're putting on your face or you're using to wash your body or whatever it may be, that you do so on a regular basis with products that you like. If the budget gets tight enough, you could see trade down effects. It'll be interesting to see how that plays out in a place like Ulta.
Right, it can. You know why? Because you can get some of the same stuff, maybe not the same brands, at Walmart, which did pretty well this week. But what about VF?
All right, looks like we might make a new high now. Look for a test of 419. We're getting through some areas of resistance. These pivots overhead, SPY, S&P pivots just overhead at 41.95. 4,200 is a major level.
A year ago it was $51, and now it's $9. So, I'm sorry, $19. But so this is a stock trading at or near its all-time lows, Renita. So yeah, another really bad day. But like I said, Alex was mentioning summer retail. This is one of them. Look at Dick's Sporting Goods as well, taking it on the chin today. So Foot Locker's problems really reached a broad sector of what's going on in retail. So especially when you look at sporting goods. So yeah, a lot of names. We were so.
All right, do we get above 419 or not?
On retail and the U.S. consumer, and even though Walmart did extremely well, it looks like parts of the U.S. consumer and retail aren't doing nearly as well and boy, they're taking big chunks out of them today, Renita.
Absolutely. And before we go, Kevin, tell me what you're watching for next week.
Well, we get some data out. Obviously, we'll be watching the debt ceiling talks. They really seem to be struggling on the budget spending caps. It seemed to where Republicans and Democrats have hit a wall. But next week, we get the second look at first quarter GDP. That we'll get on Thursday. Durable goods and income and outlays on Friday. Those are always big numbers. Big inflation look. And of course, we need more earnings next week. So a lot to look forward to.
A lot to look forward to. Kevin Hinks, Alex Coffey, thank you so much for joining me. So now let's turn it over to Cameron Dawson. She's the Chief Investment Officer at New Edge Wealth. Cameron,
All right, at resistance.
Joining us today. Let's start.
A push through 219, say 20 or so. We could see shorts covering more.
What was your first takeaway from what happened today?
Well, certainly the first takeaway is that we don't have an immediate solution. We know that time is running out, but we aren't at a point that hopefully we could wake up on Monday morning and have everything be resolved, which means that this likely puts the chances that we go to the brink or even slightly beyond the brink like we did back in 2011. That puts it back on the table after earlier this week there were hopes that we could just have it done and dusted and move on. And so I think that the debt ceiling remains a risk for this market, remains a potential source of volatility, because if the lesson from 2011 can be taken is that it's not just going into the debt ceiling where questions are asked, it's coming out of it. How much budget cuts do we get? What could the impact to global growth be or GDP growth in the US be? And really factoring that into the earnings picture as well for the S&P and broader equity markets.
I'm glad you mentioned that because I saw a note out from UBS saying the S&P 500 could fall about 20% if the debt ceiling is not raised by the U.S. Is that something that you think can actually play out?
Well, that's similar to the magnitude that we saw back in 2011. It was a 20% drawdown that took about 6 months to get back up to the prior highs prior to the debt ceiling. One important thing to remember about that 2011 sell-off is that the reason why it became such a huge buying opportunity after that 20% down is because we started trading at valuation multiples that reached the great financial crisis lows. So it really was a back up the truck kind of moment from a valuation perspective. And even 20% down from here, we wouldn't necessarily reach that kind of degree of extreme cheapness. But of course, it likely would present an interesting buying opportunity for markets if we do see that kind of downdraft. So it all depends on how far this extends as far as the negotiation process and if we see big budget cuts on the other side.
Are you seeing any standout sectors as this sort of plays out at either being...
All right, we're stalling right at resistance, at supply.
...that will likely be most volatile after this happens?
Well, there's certainly some interesting shifts happening under the market surface. So we've seen that this market has remained pretty flat and has been climbing in the past couple of days as we saw a near breakout of the S&P 500. But what's interesting is that underneath the surface, there has actually been a rather defensive tone to this market. So you were talking about consumer discretionary earlier. A great way to watch the defensive tone is to look at equal weight discretionary versus staples. That started to roll over. We also watch things like machinery stocks versus waste stocks. So within the industrials, a cyclical versus a defensive. That's been really weak. And so that's a sign that there is a bid for defensives under this market, meaning things like healthcare likely do better because they have more earnings stability and visibility.
Absolutely makes sense. This is something we were watching earlier in the week, especially as Walmart earnings came out. And then we had Foot Locker come out, which sent that stock plummeting as low as about 26%.
All right, we need more volume.
What are your thoughts on these mixed views?
All right, so we got a few things turning now. Meta is starting to move off the lows. There goes Snap pushing higher. Snap. NVIDIA is coming out of a squeeze. So is AMD.
I think it's a consumer that still has this trend of trade down and tighten belt and really prioritizing as well. That's been the message from Walmart over the past couple of quarters, is saying that consumers are prioritizing the need to have and not the want to have. We even saw that in the retail sales data. So big ticket items such as home furnishings did quite weak within retail sales, but personal care did okay. And so this is still an environment where consumers are spending, and we think that's just a function of the fact that consumers still have jobs. This is a tight job market. Unemployment is very low, and wage growth, though it's not keeping pace with inflation, is still high and higher than it's been in quite some time. So that supports continued spending, but it certainly points to the fact that there is some fraying in the consumer, and this trade down is certainly a trend that likely continues as long as inflation stays high and you see consumers get pinched.
Cameron, I want to ask you briefly before we go about your thoughts on the Fed's response today to the banking turmoil that's been happening.
Still not able to get through this 418.80, 419 level.
But what kind of level of comfort are markets seeking from Jay Powell on the banking turmoil that's been happening? Although it has calmed down a little bit, it's still a problem that exists.
Well, certainly it's a bit of a catch-22, because the more that Powell and the Fed say that banking stress is not a problem and that they've kind of stabilized things, the more upward pressure you possibly could see on yields, which could then exacerbate inflation or banking issues simply because you have those deposit outflows. We think it's very notable the fact that you did see the Fed raise rates 2 times in the midst of a banking crisis, or if you want to call it a crisis, which tells you that they think that they have their arms around it, that they don't see it necessarily having broad financial stability issues yet, or have a big impact to broader economic growth, which just means that it's unlikely to steer them off course of their policy path, which is really prioritizing the fight against inflation.
All right, Cameron Dawson, we'll leave it there. Thank you so much for joining us. She's the Chief Investment Officer at New Edge Wealth. Now, coming up, we'll talk all things Walt Disney after the company announced more cost-cutting measures. We'll find out what it means for the company going forward, and that and more on Market on Close next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the options for volatility course, we explore
All right, Tesla end of day trying to move higher.
potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a.
All right, so we got 40 minutes left to go for the closing bell. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It's Friday the 19th. OPEX for the month of May. Looking for dealers to reset everything for next week, going into June OPEX. So we got a few weeks for that. We got about 40% of the Qs rolling off today, and about the same on the spiders. So we're watching where we pin. Wouldn't be surprised to see a pin below 420 or 4200.
Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Opportunities can be hard to find, like drinking lightning in a bottle. In uncertain times, we tempted to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Market on Close. I'm Renita Young in for Oliver Bennett. And right now, let's get into Disney, because there's been a lot happening today with a few company changes. And to do that, let's bring in Jamie Lumley. He's senior analyst at Third Bridge. Jamie, thank you for joining us here. First, let's talk about what's happening with Disney. We see more cost cuts down the line. And first, let me know what your thoughts are on how it's going about this.
Great to be here. So looking at Disney right now, there's a lot going on. So what we know is that Bob Iger has returned to the company and has at the top of this priority list the job of cutting costs for Disney. On the backs of last year, increasing losses in the direct-to-consumer segment, this is one thing that he is quite serious about in cutting down, and he's made a couple of big changes in recent months. If we look at these sorts of things which are on the docket, there have been projects which have had the pause button pressed. There's been increased discussion on where exactly costs can be trimmed from this business across not just streaming, but overall. And it's clear that Bob Iger means business. We've been hearing from our experts that this is part of a symptom of this environment of the increased focus on profitability for these media companies looking to really get streaming to no longer just be a growth driver, but actually a contributing factor to the bottom line. So right now, it is very clear that there's a lot of things that Bob Iger is working through to get this company on the right track.
Okay, so let's go through a few more of those. I want to talk about scrapping that Florida campus. Tell me what the point is there of this idea and what may replace it, if anything at all.
So in looking at that, it's definitely a very interesting area. Certainly you can look at this idea of this might just be another line item where after further examination, the numbers just don't add up. Or it could be also a question
Okay, a higher low printing.
thinking about in terms of the best return on their spend. Right now, we can also see simultaneously this idea that they're working out how exactly to get ESPN to be fully a streaming option, which has another discussion around, okay, what exactly the costs look like on that front, how exactly are they prioritizing that spend, and where are they within the major shift from the traditional linear distribution for some of their key media aspects to really doubling down on that streaming side of things. So, and looking at the pausing or exiting of these certain projects, you can look at the overall price tag for the amount that is saving, and then also ask, okay, since that project is not going ahead, where exactly are they going to be reallocating that capital?
You're absolutely right, because it looks like Disney has some serious decisions to make about ESPN and its futures. But let's talk about the Disney parks right now, because there was some interesting news that came out today with Governor Ron DeSantis in Florida, government pressure there. What's the outlook for the park segment on a whole?
So looking at the park segment, there are a couple of really interesting things to keep in mind. Number one is, of course, that this has been a segment which has needed to rebound after, of course, the early pandemic closures and really just trying to reignite growth in this business as communities have opened up again. And there have been some encouraging numbers. If you look at the most recent earnings, there was double-digit growth within the park segment, which is certainly a positive for a company which is trying to have growth and have all parts of the business firing on all cylinders. That being said, there was also, of course, the question around both increasing traffic and managing the right things around pricing, as that has been one of the areas that consumers have pushed back on to some degree. But looking at where that business is right now, considering the revenue growth it has seen, and also the context of the fact that these cost-cutting measures are ongoing, there are definitely some encouraging signs for that part of the business.
Absolutely right, because last year Disney did raise its prices for some of its parks.
All right, following through.
Head into the summer, the high season, I should say, for Disney to see more people at its parks, right? So when it comes to that whole portion of the business, do you think Disney might actually go back to the drawing board and raise prices a little bit more? Parks contribute pretty significantly to the bottom line there.
It's a really good question, and I think this is probably part of the ongoing calculus which Bob Iger and senior management are having between both the trying to get people to return to the parks. As you highlighted, the summer season is huge for this segment of the business, but also at the same time understanding that this is still a very uncertain economic environment.
All right, so we got a little bit more than 30 minutes to go.
They want to be putting their wallet spend right now, and if they're seeing too big of an increase for some of these experiences such as parks, there might be some different decisions spend their time and money. So definitely it's an ongoing conversation. It's hard to say necessarily where Bob Iger will come down on this. But looking at where things are right now, top priority is, of course, and looking at the ongoing draw of having people get to the parks and then try to monetize that experience as best they can.
All right. I guess we'll have to wait and see. Jamie Lumley, Senior Analyst, Third Bridge. Thank you for joining us. Now, coming up, we'll be joined by Tom White for Options Corner. He's got his eye on some unusual options activity from today's session. He found trades on Oracle, Activision, and Occidental Petroleum. He'll break down the details on Market on Close up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand.
Markets flat. They're down $1. The S&P is down $1. 10 handles S&P futures. VIX not going anywhere unless they pull some rabbits out of the hat. It looks like we'll close or pin in this area.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better. It just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, take on.
You downloaded the TD Ameritrade mobile app?
Actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Fedelides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Welcome back to Market on Close. I'm Renita Young in for Oliver Rennick. And now it's time for Options Corner with Tom White, Senior Options Contributor. Thank you for joining us.
Good for you.
Of course. So we're looking at a few different stocks today, options activity that you saw. And since we're down on the day, let's start with a bearish trade with Oracle. We know that Oracle, so far, it's up about 54% year to date, or on the year, I should say. And it's had a pretty great run, but what are you looking at?
Yeah, just below all-time highs. They got earnings on the 12th of June, so that might be a potential catalyst moving forward. But if you look at this on a technical basis, RSI level, it's above the 75 level at this point. So it's overbought on a technical level. That doesn't mean it can't continue to move higher. And one of the reasons, after their last earnings, they had a dip in the stock, but it's rebounded quite nicely in there. The partnership they announced in late March with NVIDIA to run their AI applications on their Oracle Cloud Infrastructure Supercluster, or their OCI. They also expanded their OCI to government agencies, including civilian defense and intelligence communities. So a lot of momentum behind a lot of the deals. About 83% of the revenue is based through the cloud and licensing business segments of their business, 10% hardware. So things going right here. But I think as far as unusual option activity goes, I think somebody's taking a bearish view on this stock, maybe thinking that it's a little bit stretched here at these levels. Saw a trader come in there in the July monthly series. They bought over 3,000 of the 97.5 strike puts, paid an average debit of about 225 for those. So the break even on the downside for this trader is down at 95.25 over the next 63 days. Now, that's substantially below the current share price, but as I mentioned, you've got that earnings event on the 12th of June that might be a catalyst to the downside. Now, this could be somebody speculating to the downside. It could be somebody maybe hedging part of their portfolio if they're long these shares. But along with the other names in big tech, this one's seen a nice rally of about 26% this year, and as you mentioned, 53% from year-ago levels.
Absolutely. They're digging more into AI. Yeah. They're digging more into cloud computing. Yeah. So let's talk about a different type of stock right now, Occidental Petroleum. Okay. What are you seeing with that? Warren Buffett thinks it's a good buy right now. Yep. And what do you see with options activity?
I think if you look at the price of oil, it's down 34% from year-ago levels. So it's taken a pretty big hit. But what happened when crude oil last June was trading $122 a barrel, a lot of these companies were making money hand over fist. And what they did was they lowered their debt burden, right? They paid out shareholders. They increased dividends, buybacks. And as you mentioned, Warren Buffett bought another $200 million worth of shares, the 16th through the 18th at this point. So now Berkshire owns nearly 25% of the stock. He said he's not going to take it over. He can buy up to 50% of the shares. But I think if you look at the correlation between a lot of these big oil companies, whether it's Exxon, Chevron, or in this case, Occidental, their stocks have remained relatively elevated based on where you've seen crude oil go over the last year. So that tells you that their bottom lines are still doing really well. The revenue generation, free cash flow, pretty superior. And somebody, I think, taking advantage of this Buffett news that we saw today. We saw a call buyer in there out in the May 26th weekly cycle. So short-term positioning here for this trader, bought over 8,000 of the 60 strike calls, average debit of 60 cents. So that break even of $60.60 over the next week is only about 2% above the current share price. Call volume, about 4 times normal daily average.
Market's just chopping around. APLD high of the day. It's going to be up like 200% on the week.
To buy shares at a rapid pace anytime this stock takes a dip, but a lot of people like to follow him. But this stock's still down a little bit, about 6% so far this year.
It is, and it looks really like it's been rather range bound for the past year or so. So we'll see if it hits any of those levels and breaks out either to the up or downside.
Yeah, and that's probably a positive with the trends that we're seeing in crude oil and a lot of volatility there. It's actually positive that the stock is kind of consolidated a little bit, because it's that differential between Occidental share price and the price of oil. They're going in 2 different directions at this point. You wonder which one's
All right, got volume coming in.
Makes sense. Okay. Now let's talk about Activision Blizzard. We saw a bullish trader taking a bullish stance on Activision Blizzard. It's up nearly 3% year to date. Still some contention about the potential blocking of a Microsoft deal, though.
Yeah, if you looked back on the 25th of April is when that announcement came out. UK's Competition and Markets Authority responded to the deal, kind of basically said we're blocking it. The U.S. has basically not made a decision yet. They're kind of waiting to play this out. But China, their State Administration for Market Regulation, or SAMR, approved the deal. And then earlier this week, the European Commission approved the merger also. So now there's going to be pressure on the UK. We see a lot of option activity in here on a daily basis.
All right.
On the call side, because of that big drop that we saw after this was announced. And
all right, we got a little bit more than 23 minutes to go. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Friday the 19th, last trading day of the month. OPEX for OPEX for Friday the 19th, options, last day to trade them.
That's about 6% above the current share price.
All right, NVIDIA is starting to move.
At all, or maybe they just pull all their product from the UK just to kind of advance this deal more. There has been commentary from both Microsoft and Activision. Their CEO is stating that they'll continue to fight this to see if they can get the UK CMA to approve this deal. But we see a lot of speculation in here. This one's a little bit more longer term. You got a couple months in it, so maybe we'll get some more clarity on this potential deal where you probably see Activision shares rally pretty significantly.
And it's a couple other government bodies that need to sign off on this, right? So at each checkpoint, we might see some kind of activity like this.
Definitely, and especially when the U.S. Puts their say in it. I think they were relying on the UK, and I think they were pretty surprised that the EU actually passed the deal because the regulators over there a lot tougher than the ones here in the U.S.
Yeah. All right. Well, we'll leave it there. Tom White, thank you. Have a fantastic weekend. And thank you. Coming up, Jenny Horn will tell us about American Airlines and striking a preliminary labor agreement with its pilots. And Larry Shover is here. We'll get his read on futures as debt ceiling talks stall. That's up next on Market on Close.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding
S&P.
enter a ticker symbol in the symbol
Been choppy back and forth, buy and sell, buy and sell.
Continue adding all the symbols you want in your watchlist, then select save. The existing list
All within a range, about 10 handles, plus or minus.
from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better. And just
All right, got 20 minutes to go.
Forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control.
All right.
Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Market on Close. I'm Renita Young in for Oliver Brennick. Let's check in with Jenny Horn, markets correspondent, senior markets correspondent, also co-host of Next Gen Investing. Jenny, you've got your eyes on American Airlines today. This stock is down, like 66% from last year this time? It's taking a fall today. What is happening?
It is taking a tumble, and I have to say that, Renita, when you look at the airlines, the first 3 months of the year, they were performing relatively well, and I think a lot of this could be correlated to some of the weakness we saw with the financials really turned sentiment around for a lot of these airlines, with American now down about, 19% from its 52-week high and down, obviously, today, but pacing still actually to close out this week up 5.5%, so all things considered, we'll take what we can get here. But they did say that the union that represents their pilots have reached a preliminary labor contract per the union. Now, the Allied Pilots Association said the next step that include them presenting this preliminary agreement to its board. Now, American did not quantify a value for the contract, but said it provides now pay and profit sharing that match top of the industry while also offering some improved provisions. Earlier this month, the pilots did vote to authorize a strike if necessary, and this follows, of course, last year when we saw the
I'm looking for a squeeze.
that represented a 19% pay hike over the next 2 years. Now, an agreement between American and its pilot would follow Delta's contract with its own pilots who are being represented by a different union, being approved earlier this month as that contract raised pay by 34% through 2026 and offered job protection measures as well as an improvement to their benefits and vacation offerings. This really being seen as a way to get more pilots in the door. They're expected to hire across the industry about 8,000 pilots to prepare for this busy summer travel season. Industry officials, though, also saying that Delta has now set the industry standard for these pay increases to the pilots.
All right, NVIDIA squeezing, AMD squeezing. There goes ServiceNow coming out of a squeeze, starting to ramp higher.
If you actually look and read into some of Delta's contract, they actually said the senior captains of their airline will be making $590,000 a year, and then the senior first officers will be making starting at around $300,000 a year. And hey, I am all for pay increases, especially in this highly inflationary environment, especially if you are controlling an airplane. I think at that point, pay them as much as they want, but those are pretty hefty salaries. So then you have to then question what that means for American and Delta's balance sheets.
That is a really good
All right, it needs to drive. We need to drive this bus higher.
for the rest of the year. You know, we can
A pin anywhere between 4180 and 4200 is what I'm looking for.
still drives a lot of these stocks, especially travel, and especially a stock like Southwest, for instance. I don't know how many people do business travel in Southwest. We know that that's pretty huge on American and Delta, but we really appreciate you coming here. Thank you so much, Jenny Horn. Now let's pivot back to the markets with Larry Shover, head of international markets, Exchange Capital Resources. Now, markets start off pretty strong today, Larry. Then we went into the red after those debt ceiling talks stalled. What are you seeing out here today?
What I'm seeing is that you have the S&P's up 7.5%.
All right, we need to break through this level here, 419. Volume should follow. 4195 would be nice. I know, Frano, you got calls that are there.
It seems right now that the market is interpreting this and it's not going to be smooth, but a deal will be reached before they miss a payment.
Let's look at the leaders and the losers. First, the leading sector. What's driving the energy sector today? What's happening with crude oil?
Yeah, so crude oil is an interesting story because we opened the day, I think, up almost 2%, and then just fell off. And it appears that, the risk that we saw in the morning, where everybody was like, buying risk, no problem, crude opened higher. The debt talks went to a standstill, as it were, and crude followed the equity market. But that said, a lot more news came out with regards to Russia and their output, Saudi Arabia and OPEC as well. So all that's underlying everything, and comparative inventories are a little bit higher than most people expected, and that's what caused the down move in crude.
Let's talk about the biggest losers, consumer discretionary. We saw this.
No follow through yet. We keep running into this resistance and supply zone.
Beating down stocks like Nike. It's other
14 minutes to go.
Do you think this is primarily tied to this macro environment and how it's impacting the consumer, or some planning on the company's part?
Yeah, no, I think it's the former. At some point, the consumer, in other words, like, we haven't felt the full impact of higher rates and what that has done to the data, and we'll start to see that fairly soon. But I think the consumer discretionary is like the canary in a coal mine type of thing, where people are just putting the brakes or halting spending a little bit. I know employment is still really strong, at least per the numbers we've seen. However, higher rates and also higher gas consumption, tax on consumption, and of course, consumer discretionary will be the first to fall.
Larry, let's talk about rates. Fed Chair Jerome Powell signaled that the Fed would be willing to pause, right? How close and how likely do you think he is at actually pulling back rates? So pause and then cut, or pause? What do you think?
You know, I think it's pause and look at the numbers. I mean, like right now, I think the operative question is like, we've had a big repricing of rates in the last week. Will that be able to hold the next couple of weeks, given data, given the FOMC meeting? I mean, that's the critical unknown. And so I'll have to say, you know, we're in restrictive territory right now with regards to rates. And so any move higher from here, it's going to cause a much bigger bar to climb over than previous. So my take is that we're at terminal, and I guess the challenge, are they able to keep it at terminal through 2024 like they said? But I don't think rates are going to go any higher. I don't see a rate hike in June.
All right, we'll leave it there. Larry Schober, thank you so much for joining us here, Head of International Markets at Exchange Capital Resources. Now, coming up, Kathy Jones and Nathan Peterson from Charles Schwab will give us the macro breakdown ahead of and after the hearing, however, from Jerome Powell today. Stay with us. We'll be right back.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics, and what drives the stock takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
All right, we're trying to push a bit higher low. 10 minutes to go for the closing bell. Flat VWAP telling you pretty much everything you need to know today. Buying on bounces, overhead resistance, no momentum, and just fading a bit here.
When traders tell us how to make thinkorswim even better, we listen. Like Jack, he wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Market on Close. I'm Renita Young in for Oliver Rennick on this cold Chicago afternoon. But right now, let's welcome in a couple of folks from the Charles Schwab Center for Financial Research. We're talking with Kathy Jones, the Chief Fixed Income Strategist at Charles Schwab, and then Nathan Peterson, Director of Derivatives Analysis at the Schwab Center for Financial Research. Thank you both for joining me today. Kathy, let's start with you. We heard from Jerome Powell today, of course. Do you still think his hike and hold playbook is still in place right now, or have we crossed over into a different tone?
Well, I think the tone is different, but the playbook's the same. So what the Fed's told us all along, all year, is their plan was to hike and then hold for a while and recalibrate when they see inflation come down. I don't think today's comments did anything more than reinforce the idea that
All right, we're headed to 4,200. Looks like 41.95 maybe.
that seems to be the growing consensus, although not 100% consensus among the various Fed members, and then to recalibrate down the road. But they haven't really taken out the possibility of another rate hike in the cycle, or even more for that matter. I think, though, the reason is the Fed doesn't want to prematurely ease, doesn't want to send a signal that they're soft on inflation. Credibility is a huge issue. And there's still a lot of focus at the Fed on the labor market and how tight it is. And I think a lot of folks at the Fed would like to see evidence that that's loosening up. Now, there's lots of reasons we see for them to cut rates down the road or to stop at this point. But I think a pause is more likely based on the idea that the Fed needs time to assess the cumulative impact of all the rate hikes to date, and then, and the impact, if any, of the debt ceiling issues.
I'm glad you brought up the debt ceiling issues, Kathy, because we've got to talk about how you see this playing out. I see some analysts, like at UBS, saying that if the U.S. stalls, then this may be about a 20% drop in the S&P 500. But what are you looking at? How do you think this would play out?
Well, we're hoping that there is no actual default, because that would be unprecedented. And obviously, the closer we get down to the wire, the more disruptive it is for markets. We've seen a huge amount of volatility at the short end of the Treasury curve because there's so much uncertainty about the exact drop dead date and whether people will get paid the interest and principal.
All right, pushing a bit higher. We got 7 minutes to go for the closing bell.
Keep the markets pretty volatile until we see what happens. If it's a replay of 2011, which seems to be the way it's evolving, we'll get a last-minute deal and markets will settle down. But in the meantime, you can expect a lot of risk-off sentiment until some progress is being made.
Nate, is this the main thing that's leading markets today into the drain? Or is it more so the consumer discretionary sector? Tell me, what do you think is hurting markets mostly today, Nate?
Well, I think it's a couple of things. Partly is, some of the commentary that the talks have stalled. Some of the commentary out of Yellen saying that we may need to see some of the regional banks do some consolidation there. And then I'd also think that, we've got expiration going on today, our standard monthly expiration, which normally leads to some outsized volatility. But if you look at the setup for the week, markets have been doing really good. Equities have been doing really good this week. And so here it just feels like we're doing a little bit of a breather. And then when you get headlines that the talks have stalled or what Yellen is saying, that just gives some of the traders an excuse to go ahead and put some money to the sidelines heading into the weekend. And so, it's not that big of a move down today. It just feels like a little bit of a breather. It feels like the expectation is that we still...
All right, we're getting very close to pin territory, 41.95.
Given what's going on technically and what has been going on within the NASDAQ 100 there. So just a little bit of a breather. It's not unusual to see these talks kind of go down to the 11th hour as we've seen in the past.
You're right. It's not unusual. And also, I want to say that you said you saw quite a bit of action leading up to today. We saw a few of the bigger stocks that were overbought this week, certainly seeing that come down today in some way. But you are watching the volatility index as well. Why are we seeing a subdued level today?
It's been subdued for a while, and there's a couple of reasons for that. Number one, the market largely feels like, if you look at the probabilities, that the Fed's done. We had a 37% chance that the Fed would do a 25 basis point hike in June. Now that's dropped to 15 today. Even at 37, the Fed's never done a hike or a cut when it's been below 65 over the past decade or so, 65%. So there's more clarity around basically where the Fed is going to stand. Economic data hasn't fallen off a cliff. There hasn't been any big disruptions outside of regional banks. We saw the Atlanta GDP forecast for next quarter at 2.9%. And then if you look at the daily moves, the actual realized volatility of the S&P 500 over the past 6 weeks or so, it's been what below a 16 VIX would imply. So a 16 VIX, given where we've been coming out of the pandemic, when we've been pretty comfortable, like where 20 was the bottom, some might think that, a 16 is complacent. It could be a little bit complacent. I feel like, markets are getting really comfortable with uncertainty, and that makes me a little bit uncomfortable when I see that. So on one hand, you could say it's a little bit complacent. The VIX futures on the though, it does pick up, and we get up to a level of about a 24 when you get out to September. So, VIX traders aren't completely for volatility.
All right, well, Kathy, so I want to ask about market sentiment. As we head into the summer, big traders, they tend to sell the high-risk assets. A lot of them set it and forget it. What kind of advice are you giving investors about how to position themselves as we do head into the summer?
Yeah, we haven't really changed our guidance much in recent months. So we've been suggesting extending duration of the fixed income markets into the 5 to 7 year area.
All right, so we've got 2 minutes left to go for the closing bell.
So if you lock in the yields that are available at that point on the
Have a great weekend, everyone. I see a lot of people leaving at the close. Congratulations.
further rise in rates by the Fed. We don't think that that's the most likely outcome, but if this cycle extends and we don't get the rise in unemployment and drop in inflation the Fed's looking for, there's a risk you could see some more rate hikes down the road or more quantitative tightening. So we like the near area for duration. We want to stay up in credit quality because we see a lot of risks to the economy. You've got negative leading indicators for 13 months, weakness in manufacturing, and real rates are high, and there's a lagged impact of all that on the economy. So want to stay in the investment grade area, in the higher quality bonds, treasuries, government-backed securities, investment grade corporates, investment grade municipals.
All right, Nathan, tell me what you'll be watching for next week. We do have some data coming out. Kevin talked about it a little bit earlier, but what are you watching?
It looks like the biggest report is that PCE, in terms of the inflation data that we're going to get on Friday. Of course, we'll see what happens with the debt talk negotiations there. But if you're a trader near term, I think you need to keep an eye on the NASDAQ 100. And it has been seeing some relative strength. It was the first to break above resistance before the NASDAQ composite and before the S&P 500 yesterday. Part of the reason the S&P is able to do that is because of those mega cap techs, because of their contribution, are able to kind of lift the S&P out of its resistance zone there. But what I'm looking for here over the next 2 weeks, because we're heading into June, which is seasonally not that great for stocks, I'm watching the NASDAQ 100. It doesn't feel stretched just yet. What I mean by that is, you look at the likes of a Microsoft, which is now positive, Google, which is pushing toward the flat line. It doesn't feel like that momentum is quite done, absent any surprises on the debt negotiations.
All right, everyone. For those of you still here, thanks for everything. Grant, take care. Stephen, take care. Susie, Frano, Money Magic, Beagle, for those of you here in the late session. Nick, PS, Cousin Vinny, thanks, Schmuck. Doug, good to see you today. Nice job. David, take care. Have a great evening. Have a great weekend. Mac, take care. Thank you. Have a great weekend, everyone. Thanks, Mikey, for all your posts. All right. And all of you who have left early, I know I'm going to miss a lot of names. So, Doug, David, thank you. If Mondo's out there, if you're listening, Mondo, we're worried about you. Just let us know how everything's going. Otherwise, have a great weekend, everyone. You'll see the Sunday video around 2 p.m. on Sunday. Take care. Have a great evening. We'll see you on Sunday.